The Bank Nifty almost exactly there, went there and then turned back, turned down around. Here, on the low of 51,000 needs to be defended. We left off at about 51,960 yesterday. And on the way up, resistances are 52,577. And then you got the 61.8% retracement, which is 52,835. Yesterday's high is 52,577. So that's the first level. The Bank Nifty went there and then pulled back a little bit. So let's see. For the broader market as well, I think it's looking a little painful now, and portfolios are hurting because mid caps, small caps, it was a bit of a crunching fall that we had, and it's not as if at the margin earnings are showing any, but they were not expected to be good, but they're, I think, a little more subpar as compared to even expectations. Gift Nifty will come up on your screen, giving you an indication. It's a flat kind of a start, 20-odd point higher start. Surabhi.
Oh, absolutely, Prashant. I was also looking at the surge in yields, right? Because it's rather uncanny. The equity market hasn't fallen that much, but the bond market seems to be sensing something. And it took me back to the comment that Ed Yardeni made on this very show yesterday. And I think that's a question that markets are beginning to ask and price in, whether the 50 basis points was, too aggressive too early, whether that was a quote-unquote mistake. If you look at the probability and the odds right now of the November meeting, then earlier there was absolutely, no one expecting a pause. Everybody was in the camp of at least 25 basis points, if not 50 basis points. But now there's a 13% probability, if you go by the FedWatch tool, of a hold in November itself. So I think this new reality with the strong data is what the bond market in the US is pricing in, along with all the commentary that we're getting in from the Fed officials. NVIDIA is making all the headlines. Now it's $3.5 trillion in market cap. And, earnings is a very fast-moving train in the US. There's lots of interesting names coming up today. There's GM, there's IBM, Verizon, Tesla, Boeing. So I think big tech and large corporate American earnings report card will continue to drive the global headlines. Let's come back closer home in our neighborhood, Asia, this morning, just to get the hot boards up. Yeah, I'll come to the FII numbers in just a second. But if you look at the Asian picture, it's very mixed today. There's buying in mainland China and Hong Kong. There's a lot of selling in other regional markets like the Nikkei, like even Australia for that matter. So Asia is not, following that one consistent beat. Let's see which way we go. The Gift Nifty obviously is talking about a green start right now. Now let's come to the flows, and good news and some cheer here. We cheer every time that selling figure is not as high as 5,000 odd crores from the FPIs. Yesterday it was a far more modest 2,200 odd crores, and domestic institutions offset it very nicely with a nice buy number of about 3,000 crores. Earnings. That's what it's all about. Just talking about the highlights of the post-market action yesterday. And I've just picked up one or two stocks of sectors which are in focus or trends that are in focus. So Bajaj Housing Finance, obviously no issues over here on asset quality whatsoever. It is a housing finance lender, and the AUM growth was 26%. But if you start looking at, the asset quality issues, if you remember RBL Bank from yesterday, today I'm going to watch out for Union Bank of India in a lot of detail, because at a granular level, that asset quality is flashing red all over the place. Provisions are higher, slippages are up 120%. Let's see how the market reacts to this one. And also another high-profile sector, the capital market segment, 361 declared numbers, and they've missed the mark, at least on a quarter-on-quarter basis. So let's see. Yesterday, remember, a lot of the stockbroking stocks had a lot of selling on them. Let's see what happens today as well. Today's results tally, it's a long one. Hold your breath. Bajaj Finance, ICICI Prudential Life, Aditya Birla Real Estate, the erstwhile Century Textile that's been launching so many projects around us here in Mumbai, Canfin Homes, M&M Financial, IIFL Securities, long list, Varun Beverages, Persistent Systems, and Zomato. On Zomato, beyond earnings, today's that board meeting when they'll discuss the QIP. So let's see what details come out and why they're looking to raise close to $1 billion in terms of equity capital. So that stock is in focus. And then, of course, the big headline at 10 o'clock is going to be Hyundai making its India-listed market debut. Now, you already know this by now, that the expectation is that it's going to be a muted start because of various factors, because it was an OFS. It's only the promoter selling about 17% stake. If you go by the so-called grey market premium, it's not been too much. The issue price was about 1960. People are talking about maybe a 60 to 70% pop. So, give and take around the 2000 mark, 2020 thereabouts. Let's see how it goes. But a lot of the long-term watchers say that this is not a listing pop story. It's more of a long-term play. The retail portion was not fully subscribed, but of course the issue went through thanks to institutional buying. So it's a big moment at least for the auto sector with this mega listing today. So definitely all eyes on Hyundai.
Well, that's right. I think if you're talking about the grey market premium, Surbhi, which is now in a premium, last week briefly it went into the red. So at least, that's it's expected to be a flattish to maybe a mildly positive start. But, you have the troika today that's actually against us because crude oil prices popped up a little bit, went closer to around $75 per barrel mark. You had the dollar index that's moved to above that 104 odd mark, and the US yields as well did see a pop of closer on 12 basis points odd. So the troika, so to call it, well, that's against us today. The bulls, though, they are hoping to defend the lower end of the range, both on the Nifty as well as the Nifty Bank. Until now, they've got lucky, at around the 24,500, 24,600 mark. Risk reward actually has favored the bulls, so they'll be hoping to defend at least the lower end of the range. We'll have the Nifty Financial Services Index that plays out its weekly expiry as well, so that'll be another monitorable that we'll be looking at. How are the FIs and clients positioned? Well, the clients, they continue to build on the long positions. And in the last 1 week, well, they've added closer on 40,000 contracts. So closer on a 20% increase in the total long positioning that they had. While the FIs, well, they were short. They were at around 1.5 lakh contracts on the short side. In the past week or so, they've added closer on 10% to those short positions as well. So both of them are the opposite ends of the spectrum. The clients have been going on adding their long positioning. So that is heartening to see. The levels to track now. The Nifty crucial support comes in at around that 100 DMA, which coincides with the recent lows that you're seeing, 24,500, 24,600. Important mark. Even if you're looking at the options data, well, that will tell you resistance comes in at around this 25,000 mark, 25,100 mark. So a couple of data points out there. The PCR has come down to around 0.8, 0.81. And we have seen call writing that's come back into play. And because of that, the bears, they're getting very confident that this range is going to be defended. So you'll get confident only once from a bullish perspective, once we get past this 25,100 odd mark. The Nifty Bank, yesterday it showed signs that it wants to run away. It briefly went above the 20 DMA, but unfortunately, it couldn't conquer that on a closing basis. So the 20 DMA becomes a bit of a resistance, while the 50 DMA, which is a couple of 100 points away from current levels, that, in fact, is an important support for the Nifty Bank. So we'll have to keep an eye out on the 50 DMA and hopefully it doesn't get breached. Well, moving to HDFC Bank, that's the big constituent, right, of the Nifty. And that yesterday performed. It was up 2.5%. But the ADR was up close to around 4.3% out. So let's see whether or not HDFC Bank, after underperforming for the last 18 to 24 months, does it want to take on the mantle and now support the Nifty? That's going to be an important monitorable as well. Besides HDFC Bank, the other two stocks that I'm looking at is Nalco, both as well as Tata Chemicals. Both of them have come out of the F&O ban. Nalco yesterday was outperforming even in a weak market in comparison to its metal peers. That's because of those alumina prices which have scaled up. So keep an eye out on both these two names.
Okay, all right, Nigel, thank you very much for that. So keep an eye out on some of these names. Robert Sockin is with us, global economist at Citi. Robert, good morning. Good to have you with us here. Thank you very much for your time. I think we're 2 weeks away from US elections, and I don't know what how Citi and the team at Citi sort of viewing it. Is the market pricing in a Trump presidency, or do you think it's still too close to call? What's the sense?
Hello, and thank you, as always, for having me. It's really nice to be here. I think the last point you made is exactly the right one. It's still really close to call. We don't have a house view within economics. We're tracking the polls as closely as everyone else, and it still seems to be a very close race. It does seem in some types of polling that Trump maybe have made up some ground over the last several weeks. But if you look at the key swing states, all of those swing states look to be within the margin of error. And so it could be the case that either of them end up winning because those swing states are the most important to watch. So, the market sentiment, people, when you speak to them in the market, they seem to be feeling more of a Trump victory. But when you look at the polls, it's still an extremely close race.
Oh, yeah, absolutely. And yesterday, Robert, morning, our time morning, I guess it's evening for you. And yesterday it was all about McDonald's, right? I couldn't stop watching those reels on repeat with Mr. Trump there dishing out French fries. So, yeah, it's really happening as far as the election goes. But from a market perspective, while obviously we're tracking rates and what the Fed is going to do and the economy, but once the results are out, is it going to matter in a material way at all? I mean, it's volatility from here till the result announcement date. What after that?
Yeah, and this is a really key question. And I would make 2 points. One, in terms of the outlook for Federal Reserve policy, the Fed is not going to make assumptions about who is going to win the election. And whenever somebody wins the election, they're not going to make assumptions about certain policies that are going to be passed. Because, candidates can say a lot of things on the campaign trail. It doesn't mean they'll translate into actual policy. So really, the kind of rules of central banking are you take the lay of the land is given once those policies are set and passed, and then you incorporate them into the outlook. So I think that's very important. The second factor is we don't know the exact makeup of policy after that's going to happen after the election under either candidate. It's going to depend on the makeup of Congress, and then B, as mentioned, how what they've said on the campaign trail and in the past translates into policy. So, for example, people are talking about with Trump that certain policies may end up being inflationary, such as he may put on a lot of tariffs, maybe across the board tariffs. This is something we have to monitor closely, but we don't know the extent to which these policies will be implemented, and if they are, when they will ultimately be implemented. So I think there's still a lot of uncertainty about who's going to win and then what that's going to mean on the other end. And we have to see, once somebody wins, what the actual policies they try and put through end up being.
All right. Hi, Robert. Always good to see you, Wayne. Robert, what are you factoring in, though? I think earlier when we chatted, you were factoring in 2 more cuts for the remainder of this year. Do you stick to that? And also, what about the Indian markets? We have been thumping the table that, India's giving a good amount of policy outlook. We're giving a good amount of growth as we move to around the $10 trillion mark. But the FI selling continues. And now I think the holding would have come down to around 15 to 16%, which is a multi-year low. How are they positioned with regard to the Indian markets? This needs to stop at some point of time. So policy and FI positioning in India. Please go ahead.
Yeah, great set of questions. And first on the Fed, I think the bar for the Fed to do nothing in November is very high. You are seeing some of that percolating around markets where some people are thinking the Fed could pause soon given the strong string of data that we've seen. I think given that they started with a 50 basis point cut and that policy rates are still far above neutral, it would be very hard to move from that positioning to a type of a pause in November. So I think they're going to cut 25 basis points in November. Again, the bar to do nothing is very high. And then after that, it's going to depend on how the economy evolves. If the economy continues to look as it has over the last month, which is really feeling a lot like a soft landing with a strong consumer, a stabilizing labor market, then the Fed is going to move at a more gradual pace. My base case would be they would still cut 25 basis points in December, even with that type of outlook, because they're still far above neutral. But then after that, it's going to depend a lot more on how the data evolve, and maybe they move to a much slower pace in 2025 if the data continue to hold up very well. Now, of course, for the Indian markets, we've talked a lot about on the show. India has been one of the best performers in our forecast. We've seen global resilience around the world. I think India is very well positioned to be a strong performer in the global economy. And I do think as global interest rates are going to continue to fall, you're going to see a pickup in global manufacturing activity, something that we really have not seen fully get started in this cycle. You've had some fits and starts, but the manufacturing sector globally has been relatively soft. And as that manufacturing sector picks up globally and global trade picks up, that's going to be another tailwind for India. So I do think long-term, India has a lot of positive forces working in its favor. And I do think as interest rates come down and global trade and global manufacturing improves, that's going to be another important tailwind for the India economy.
Surabhi, on the point about U.S. interest rates, right? There was the Stanley Druckenmiller interview in which he quoted Jim Grant, who writes the famous rates daily. He said the Fed is actually the forward guidance. He said the bar for the Fed to do nothing in November is going to be very high. He says actually the Fed is not looking at inflation. They're actually working on the basis of their own forward guidance. They're kind of trapped by the forward guidance
because
they
declared
told the market
100 basis points by the end of the year.
We're going to do it. Now they're trapped. Now they, so
eat your words, so to speak. But Robert, thank you very much for putting it out there. And these are interesting times. Let's see if indeed they deliver that 25 basis points, even though the data may not be pressing them enough to do it. Thank you for joining in today. Well, Robert was quite optimistic on the Indian economy. Right now, here's a slightly more cautious call coming in on the immediate term earnings. And this is our equity call of the morning. Sanjeev Prasad of Kotak Institutional Equities says, second quarter FY25 earnings season offers little to cheer so far, with fairly muted underlying trends across sectors. He says, more pertinently, the results highlight our long-standing concerns about risks to both profitability and volume in several sectors, from disruption and companies' profitability-centric strategy. He says the market has either ignored or cheered these issues. He makes a few changes to the recommended large cap model portfolio by including HDFC Life and increasing the weight on Apollo Hospitals and TCS, and also removes delivery and reduces weight on HCL Tech and SBI Life.
Okay, all right. We'll take a quick commercial break here, but let's quickly tell you what the corporate interactions which are lined up here in the program over the next 2 hours or so. We have the management of Cyient DLM joining us to talk about their second quarter earnings. That's at 8:30, 9:05. We'll have Ajay Singhani of EPAC Durables, and this is on the back of a tie-up that they've done. Our market master is Anand Shah of ICICI Prudential AMC. 9:30, we'll have the management of CG Power. The stock sold off 6% yesterday. Amit Dikshit of ICICI Securities will be speaking with us at 9:40. Expectations of the steel sector. 9:50, Yogesh Malhotra of Gravita India on the back of their second quarter earnings. 9:55, and of course we'll have the big listing Hyundai, and we'll have Prakash Diwan joining us, and we'll also have Ashwin Patil of LKP Securities joining us to talk about that. And of course 10:15, it's the economy with Lata. She'll have Suresh Ganpati of Macquarie and Harsh Vardhan of Bain and Company to talk about, the consumer, and are we in a bit of a funk in terms of a slowdown. So that's the lineup here coming up.
Well, time for a quick break, but we have a lot of stocks that we're going to be tracking for you. We get to that in just a bit on the other side of the short break, but let's run you through the list. We're looking at Bajaj Housing Finance, Ultratech Cement, City Union Bank, Route Mobile, Cyient DLM, EPAC Durable, Ola. You have Epigral. All of them will be reacting to positive news flow, while Union Bank and 361 WAM will be reacting to negative news flow. We'll get into detail on the other side. You don't go anywhere.
Welcome back. You're with us on Bazaar Morning Call. And as far as the implied open is concerned, it seems that we could start with at least some green on the screen. Let's see if that remains intact. Because like I said, cues across Asia are very mixed. You have the Chinese markets moving higher. A couple of the other big ones like the Japanese markets in Australia, they're all lower. But what about individual stocks? It's earnings season and our team is standing by with the CNBC-TV18 list of stocks to watch for the day. Guys, good morning to all of you. Let's start off with, once again, the BFSI space. Abhishek, how did Bajaj Housing Finance fare?
Well, the disbursements were weak over there, but AUM growth is pretty strong, which helped the PNL as well. So the disbursements were down 1.15% on a YY basis and almost flat on a sequential basis. However, the AUM growth was at 26.3% YY and about 5.7% quarter on quarter. This drove the PNL. So the NII growth was 7.3% quarter on quarter. The other income growth was robust at more than 26% quarter on quarter. The PAT grew by 21% YY, but 13% quarter on quarter, which is pretty strong. The net interest margin expanded on a sequential basis to 4.1%, which compares to 3.9% in the previous quarter and about 4.4% in the same quarter last year. And asset quality has remained stable. Gross NPA ratio is at 0.29% versus 0.28% in the previous quarter. Back to you.
Right, thanks a lot for that, Abhishek. Well, I'm looking at Ultratech Cement, and yesterday the numbers were disappointing. The stock ended with a cut of around 2%. Now, the con call was post-market hours, and the management sounded quite confident. And I'm looking at a lot of brokerage notes. Mostly what they indicate is two factors. One is that it's the pick of the pack. If you have to play cement, you have to play the big boy. And the other one is that profitability is likely to have bottomed out. Let's run you through the key highlights of that con call. On the cost side, they've been saying that in the next few years, they're going to save 300 rupees per ton, increase renewable energy, increase usage of waste heat recovery system, and operating leverage will play out as well. On the pricing trends, prices currently are 2% higher than what it was on an average for the past quarter, so that's good news. And the industry dynamics, they're expecting a bounce back in the second half of the year. So they are targeting double-digit growth for FY25, while the industry should grow by around 7 to around 8%. So they'll keep their market share because they'll be growing faster than the industry. They've also said they've already commissioned 10 million tons. They'll commission another 6.5 million tons. And on the inorganic side, on India Cements, they are awaiting CCI nod out there. Kesoram, they said the NCLT hearing is scheduled for the next month. So in all probability, this transaction will close out in the fourth quarter of the year. And on JP, they say that that asset remains under arbitration. Just the broad read-through that you got from those numbers is that it's more positive than negative, and the stock has corrected close to 10% in the last 1 month. So expecting a tinge of green on that one.
Okay, so Ultratech is going to be on our radar as well. But for now, back to Abhishek. Quite a few lenders have started flashing red on asset quality, slippages rising, provisions rising. Abhishek, tell us about City Union Bank as well as Union Bank of India.
Well, to begin with City Union Bank, their business momentum was pretty healthy with respect to deposit growth. It was at 4.5% sequentially. The loan growth was about 2.5% sequentially. The net interest margin has expanded, and that is surprising factor. A 13 basis point expansion in net interest margin is unheard in the banking sector in this quarter, especially when cost of fund is rising. So the net interest income growth is about 6.8% quarter on quarter. PAT growth is about 7.8% sequentially. The slippages remain stable over their annualized slippage ratio coming down to 1.47% versus 1.53% in the previous quarter. Their asset quality also saw an improvement. Gross NPA ratio down to 3.54% versus 3.88% in the previous quarter. Now, Union Bank of India, the business momentum remained weak over there. Deposit growth of just 1.5% quarter on quarter. Loan growth actually declined on a sequential basis by about 1.7%. Slippages were about 5,219 crores and the write-off was about 4,160 crores. So it looks like one corporate account might have slipped into this account, this quarter. So that which was written off as well. So it looks like MTNL might be the account that might have slipped in this quarter. The exposure over there of Union Bank of India was about 2,500 crores. Asset quality remains stable. Gross NPA ratio at 4.36% versus 4.54% in the previous quarter. The net interest margin has come under pressure. It's declined to 2.9% versus 3.2% in the same quarter last year and about 3.05% in the previous quarter. Back to you.
All right. Abhishek, thank you very much for that. So lots of banks and financials. 361, the wealth manager also reported numbers. So let's go across to Vamakshi for details. Vamakshi, morning.
Well, good morning, Prashant. Not a great set coming in from 361 WAM. Total revenue saw a dip of almost 2% sequentially. It came in much lower than what the street was expecting as well. Largely, the dip sequentially is being led by the transaction and brokerage income, which saw a dip of almost 15%. But on the other hand, the annual recurring revenue saw an uptick of almost 6% sequentially. However, the yield on this revenue saw a bit of moderation to 68 basis points. Operating expenses, on the other hand, surged by almost 13% sequentially. This is much higher than what the street was expecting. Resultantly, the cost to income ratio too surged to almost 50.8%, again higher than what the street was expecting, and the operating profit as a result dipped by almost 13%. The average ARR AUM saw an uptick of 12%. We're seeing healthy inflows in the ARR, which is up nearly 81% sequentially, but the AIF portfolio, which is a part of the AMC business, saw an outflow, and this is a bit of negative. That is because this is a higher yielding book. We have a brokerage note coming in from Investec as well. They've got a hold rating with a target price of 1,050. They say that 361 has been delivering strong PAT growth on the back of strong transactional income, but the sustainability of this transactional income still remains a question. So overall, not a great set for this company.
Okay, all right, got it, Vamakshi. Thanks very much. We'll keep that stock on the radar. Let's head across to Upasana now. She's looking at earnings from Cyient, DLM. And of course, the combined project that EPAC is now launching, getting into a lot of the consumer electronics in a big way. Upasana, tell us more.
Good morning. First up, let me start with Cyient. DLM companies reported in-line set of numbers. Revenue stood at 389 crore with an uptick of 33% on a YoY basis. And this revenue growth was mainly driven by companies' key segments, that is defense and aerospace. EBITDA margin stood at 8.12% with an uptick of 7 basis points on a YoY basis, and company's PAT stood at 15.4 crore with an uptick of 5% on a YoY basis. Now coming to company's order book, it stands at 1,979 crore, which was down about 13% on a YoY basis and 7% sequentially. Next up is EPAC Durable. Hisense India partners with EPAC Durable to manufacture air conditioner and home appliances in India. EPAC Durable will immediately invest firstly in a new manufacturing facility in Sri City, that is in Andhra Pradesh, and the projected production capacity is 1 million RACs by FY28, and production will soon start by June 2025 is what the company has indicated. Hence, both these stocks remain in focus today, and I expect both of them to open in green.
All right, Upasana, thank you very much for that. Route Mobile is the next one that we want to focus on. Reema is here with details. Reema, morning.
Hi, good morning. So things are still slow for Route Mobile. This is a CPaaS company. It helps enterprises connect with the bank, the enterprise connect with a consumer. Every time you make an order, you get that SMS saying your order has been delivered, you've made a payment. So all that messaging which happens either on SMS, that's the traditional route, or even on your OTT platforms, for instance, WhatsApp, is done by a company like Route Mobile. But things have slowed down for the company for the last 4 quarters. Even this quarter, you've seen a flat revenue growth, and on a year-on-year basis, it's only up close to about 10-odd%. But I'm going to go with green for Route Mobile because compared to the prior quarters, there is a little bit of a quarter-on-quarter pickup in revenues. That's point number 1. 2, the stock has been flat for the last 1 year owing to demand coming under pressure. The company in the press release says they're optimistic about Q3 given the festive season. Margins have expanded on a sequential basis, aided by a little bit of an exceptional item. The profit has also seen a jump. But for more details on the environment, there is a conference call at 4 p.m. which will be important. Back to you.
Got it. Thanks a lot for that, Reema. Well, let's wind this down with Sudarshan on Ola and Epigral. Morning, Sudarshan.
Morning, Nigel. So we'll start with Ola. It has updated exchanges regarding the complaints was received for its vehicles. It says it had received 10,644 complaints from Consumer Protection Authority, of which 99% of those complaints are resolved. And apart from this, there is another positive news. I was checking the Vahan data, and in the month of October, market share currently stands at 36%, which is highest in last many months. Second stock is Epigral. It has announced its opening of QIP QIP issue. Sources say company is looking to raise up to rupees 400 crore and base size is of rupees 250 crore and green shoe option is 150 crore and indicative price is rupees 2093 per share, which is a discount of just 1% to its CMP. And regarding QIP proceeds, this company is looking to use the money that they are going to raise. First, repayment and prepayment of certain outstanding borrowings. Second, to purchase fixed assets. And third is general corporate purposes. So that's the reason I'm going with green for both these stocks.
Okay, all right, Sudarshan, thanks very much for that. Yeah, Ola is interesting. Now they're claiming they've resolved over 99% of the complaints. Let's see if it has any positive rub-off impact on the stock at all. Quickly recapping our list of stocks to watch then. The ones that have positive news flow around them are Bajaj Housing Finance, Ultratech Cement, City Union Bank, Route Mobile, Cyient, DLM, EPAC Durables, Ola Electric and Epigral. The ones that have negative news flow around them are Union Bank and 361 Wealth Management. All right, that's our stock list. So expecting more green than red, at least on some of those newsmakers. Let's now figure out what's the latest in the world of commodities. Manisha is joining in with a roundup of all the action. Manisha, hi, morning.
Morning, and thank you for that, Surbi. Well, it's an all-time high continuing for the gold prices today as well. The U.S. election jitters and Israel retaliation against Iran are a couple of factors which keep supporting the prices here. There also have been a couple of reports overnight, one from Citi, another from Bank of America, both suggesting that $3,000 an ounce in the next 6 to 12 months is a possibility. Of course, there could be some near-term correction by the year end. That is when a lot of people start closing their books, but a longer-term view is still on the higher side. Silver as well is trading at around 12-year highs. Most of the metal prices seem to be doing well also because of the strong China economic data, the LPR cut. That has led to zinc prices trading at a 2-week highs. Aluminum right now is trading at a 4-month highs. The Chinese buying has been on the stronger side as well. So that really seems to be supportive. And even as the crude oil prices gained up by 2% overnight, in the Asian markets, it's 0.5% down right now. So the volatility continues and it continues to trade within a range.
All right, Manisha, thank you very much for that. So that's commodities and metals in focus. We'll take a quick commercial break here. We're going to come back, connect with Amnish Agarwal of Prabhudas Lilladher for some fundamental stock talk that's coming up in just a bit.
Well, from a sector point of view, I think the challenge always was the FDI restrictions, as rightly mentioned by Shireen. I think what is important is there is some amount of clarity insofar as the regulations are concerned. I think that's one thing which is behind our back because that was also a concern. Multi-brand, single brand, I think what can do, who can do, all that.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, let's have Amnish Agarwal, the head of research at Prabhudas Lilladher, who joins us. Hi, Amnish. Thanks a lot for joining in. Well, let's talk about Bajaj Housing. What do you make of the numbers? The stock listed, it went closer around the 200 rupee mark, then it corrected to around the 135 odd mark. The numbers are pretty okay, though. Your view on the stock at current valuations?
Morning, Nigel. You see, Bajaj Housing Finance, it listed at a significant premium, and after that, I think stock has cooled down a little bit. But if you look at, say, purely the numbers and the valuations it is trading at, the stock would still be something like, I think, at least 6.5 times approximately on the price to book on FY 26-27. So even now, I don't think the stock is cheap, and over a period of time, I don't rule out stock settling to levels which are lower than the current ones.
Oh, okay. Amnish, hi, morning. Staying with financials, this is turning out to be a very interesting season for a lot of banks, right? So I think City Union Bank today stands out because it's the one that's not showing any shockers on asset quality. On the other hand, there's Union Bank, provisions are rising. I think Abhishek was telling us one of the key accounts like MTNL could have perhaps slipped. We saw what happened with RBL Bank yesterday. So in the tier 2 lot, some of the numbers that have come, if the stocks are under your coverage, any thoughts?
You see, City Union Bank, I think first of all, their NIMs have been quite good. The provisions have been increased by them, so the PCR will improve, and some of the technology initiatives which they have taken. So they are likely to result in better growth in the year, coming, say, year or two. So we have actually upgraded City Union Bank to a buy, no big change in the target price. But however, the stock gives you a potential to make, say, 20-25% over the coming 12 to 18 months. So if you look at, say, all the mid-sized bank, I think City Union Bank is the one which looks good. And I think even Federal Bank is worth looking at. But I think the numbers are yet to come out and we will get more clarity. But yes, it is going to be very volatile times for, you can say, banks, because most of them are having NIM compression. Then there are doubts as far as your MFI book is concerned, many of these. So I think the volatility is going to be there in case of many of these banks.
Amnish, since you're talking about banks, what about the big boy, HDFC Bank? The street is looking for pockets where to hide, stocks that have underperformed, valuations are okay. And now it appears that things are, the stars are aligning, so to call it. HDFC Bank, yes, it was an outperformer. It's done nothing for the last 24 months. Your view on it?
If you look at the long-term averages, today HDFC Bank really looks attractive from the longer term. Yes, in the near term, the growth rate might be stunted. You have got, you can say the LDR is high. Now it is sub 100%, I think 99.8 for the current quarter. In the near term, yes, the issues are there. But if you are looking at, say, next 12 to 18 months, so HDFC Bank, I think the growth rate should start gradually picking up. That is one. Secondly, on price to book, the stock seems to be attractively priced. And given the fact that it has not done anything much, so from the hiding viewpoint, I think it's a good place to hide with the potential to make, I would say, decent money. But the viewpoint for some of these frontline banks, one should be looking at, say, 12 to 18 months kind of a viewpoint. In the near term, yes, because the valuations are very attractive and they are not showing any sort of froth. So there's a possibility that if the market correct, the correction in these stocks might be on the lower side.
Okay. All right. Amnish, stay on. We'll come back to you with some more questions, but a lot of earnings have been coming in. So let's straight away get to it. The first management and company on our radar is Cyient DLM. Now, Cyient DLM reported a performance that was more or less in line with street estimates for the second quarter. The revenue and EBITDA jumped more than 30%. The order book, however, declined 13%, but the defense segment witnessed growth of about 82% on a year-on-year basis. So what are the trends looking like for the second half? We have Anthony Montalbano, Chief Executive Officer at Cyient DLM. Thank you very much for joining in, sir. So if we could just start by talking about that dip in the order book, what are you expecting in the second half? How are you likely to end the year? And just give us some idea, because you've also done an acquisition recently. You've bought an EMS company based out of North America. So what's the thought process there between growing your international business?
Yes, absolutely. So, yeah, to start with, it was a big quarter in terms of the acquisition of Altec, which does bring us into the North America market, and is our first, manufacturing opportunity really outside of India. And we also believe that this specific capability really gives an expansion of our current business with the type of clients that we have today that we're supporting in India. This is an operation that is very complementary in terms of the type of capability into mission and safety critical electronics. And we believe that there is a very strong synergy case as we look at the business we have that can go into impact that operation. And then also they bring us a level of business diversity. As you mentioned, we are very solid in aero and defense. They also bring us more diversity in medical and industrial, which is some of their top clients, and with some top logos there. So that's an important piece of the business.
Anthony, sorry to come in over there because it's a short call. So just on the acquisition, I think you've paid about $23 million for this. What is the expectation in terms of synergies with respect to revenue? What is the current revenue size of this company? Is it profitable? And by when will that start reflecting in your numbers?
Yeah, we'll start showing the details on our next quarter's results. But then the numbers are very complementary. They have, the business is about a $35 to $40 million per year run rate is where it's at today, and it's providing similar EBITDAs of high single digits, low double digits, so 9-10% EBITDAs, which is in line with our business today. Right. So it's very complementary in terms of top and bottom line when you look at the combined aspects of the business.
Anthony, hi, morning. So for the full company, including this acquisition, FY25, what would revenue growth and EBITDA margins be? And give us a sense for is asking for 26 a little too much? Or would you be able to...
Yeah, I think we'll start to provide some of the details next quarter, and that'll provide some impact on how that starts to look for the rest of the year. I will comment though regarding not counting the Altec at this point as far as how H2 is looking, including some of the questions on the order book. We do see a much stronger H2 in terms of delivering on the overall business that we have forecasted for the fiscal year, including the growth rates, and also H2 is when we also expect to see more of an impact on the order book. And this has also been another record quarter from a revenue perspective for us. So this continued revenue growth does. That's been a key driver for the business.
So the 30% you told us after the first quarter, it'll be more than the 30%. I mean, I'm not including this acquisition. You're saying H2 will be much much stronger.
Our organic expectations are to provide a CAGR of about 30% overall growth. Right. Last year we delivered, I believe, 43%. This year, we will not be at that high, but when you start looking at the combined growth rates over a 3-year period, our goal is to be delivering about 30%. And right now, the revenue that we are delivering and are forecasted to deliver for H2 should align to the.
All right. Hi, Anthony. Morning. Good to see you in. This is Nigel on this side. Give us a couple of more details with regard to Altec. For last year, did around $37 million with margins of around 10.5%. Say if you have to give us a 3-year time horizon, where do you see this number headed? From around 37 million, since the targeted market is high, there's a big opportunity out there as well. What should this entity grow at? And where do you see the margins headed as well? Scope for improvement, because it's margin accretive.
Yes, no, it absolutely is. What I will comment is that we believe the specific addition will be complementary to our business overall. So, the growth rates that we have set for Cyient DLM are, we feel are pretty solid. And then when we also look globally,
you want to give us a number, Anthony? You want to give us a number from 37 million? Say in the next 3 years, do you see it go to that vicinity of around $60 million? Is that a possibility?
Yeah, we'll start to provide a little bit more outlook in the coming quarters on that. I think at this point, the goal is to get the integration in place and really bring the go-to-market pieces of the business, which are complementary. But they've had solid growth, solid bottom line.
Got it.
Been supporting that for decades. Yeah, so we're quite enthused.
You're sounding quite confident both on the organic and the inorganic side, but from a stock market perspective, the street would like to know what's the promoter's view on the company as well, because they had sold some stake, 14% stake in the month of August itself, and they bought their stake down from 66% to 52%. What are the communications? Are they done with their selling? Would they hold on to this 52%, or is there likely to be some more supply?
So at this point, there's definitely not any plans to further dilute the stake in Cyient DLM. And as discussed, the where that money was used in the sale of that stake will actually drive some investments in semiconductor, and so that's more of a front end part of the business when you look at it from how products come to market. And even as that matures, it actually creates opportunities for DLM as well. So it's really just it really provides more focus on the business by breaking out the semiconductor piece and being able to invest and scale that. And then we see downstream impact for Cyient DLM as well.
Got it. Anthony, good to speak to you. Organically, you're sticking to your guidance with regard to the acquisition. You'll provide us color in the coming quarters. And as of now, the promoter entity doesn't plan on selling any more stake. Appreciate you speaking to us here on CNBC-TV18. Wishing you a good day ahead, Anthony.
Great. Thank you.
Well, for the time being, I'll tell you what, we'll slip into a short break. Technical experts waiting for us on the other side.
And I think the sector overall has been growing pretty well. So if you look at FY23, our e-commerce sector was actually valued at almost $80 billion. So there's been an increased amount of growth.
Indian aviation companies today and the regulator and the government is dealing with in the last 4 days, we've had a situation of 20 plus hoax threats, bomb threats, which have not turned out to be, fortunately, true. But you've had them disrupt airline schedules. You've had them disrupt customer, travel plans. And it's a huge economic cost to an airline as well. Now, how do you deal with this at BA? I mean, how often is this an issue for you?
I think we've well-established protocols, not just at BA, but internationally with airports to deal with these kind of threats. And there is a kind of an assessment you do to understand whether it's a threat that, leads to the grounding of an aircraft or whether it's not something that's credible. I can't really comment on Air India's situation other than I think, airlines have to take the appropriate action that they feel is the right thing to do, and I would support whatever decision they take.
But is the threat assessment done at the airline level, or is it done in conjunction with the regulator as well as the
airport and the airline
agencies?
and the security agencies will be, very much involved. And we use all of the assets that are at our disposal to make the assessments.
And is there an escalation that you've seen in this sort of a threat?
I haven't seen something on this scale in quite a while, but I couldn't really comment on, the specific issues here because I'm not close to it. But other than we've well-established protocols that we enact to make sure that, we stay safe.
Online shopping is easy, fun, and can even be addictive, but it comes with its hidden traps. Who isn't familiar with messages or notifications urging to buy something we were not even looking for, or that we may have missed out on a limited time offer? These are what the consumer
Okay, welcome back. We're looking at, of course, market ticking down to the pre-open session. Lots of movers yesterday, which actually more down than up. So let me actually address a few. Amnish, of course, is still with us. Amnish, weigh in on two names. One is India Mart, I don't know if you have coverage or if you've looked at this name. Stock sold off aggressively. And the other set is Tata Chemicals, which got ramped up because of that buzz or whatever around a potential listing of Tata Sons. No confirmation, nothing. But also, of course, I think what helped the move yesterday was the fact that it was in the F&O ban. It's out of the ban now. So just your sense.
Yeah, hi Prashant. First of all, no view on India Mart at this point of time. And as far as your Tata Chemicals is concerned, I think there is no fundamental reason which would suggest that the stock price should move up from here like this. I think the news around the listing of Tata Sons and you can see some changes around that has been around from quite some time. And I think the rub-off effect of that should be, I think, not only on Tata Chemicals, but on other Tata Group stocks, which doesn't seem to be there. So I think from that angle, slightly difficult call to take.
Okay, all right. We'll leave it there. Amnish, thank you very much for joining us and running us through all of that perspective. Thank you very much. Well, I think we'll take a quick commercial break here. We're going to come... Okay, I think what we'll do, we'll have the technical trades coming up. Mitesh and Sudarshan are joining us with exactly that. Gentlemen, good morning. Good to have both of you here. Mitesh, the sense now, I mean, big, hugely volatile day, but finally down about 100 points. What does one do this morning?
Good morning, Prashant. So I think I would say hanging on to the support level somehow. I think, just kind of managing to close above levels of 24,750 and in that zone of 24,750, 800, despite the fact that on 2-3 occasions we have kind of breached that level on an intraday basis. So just holding on, but the structure hasn't improved. So, one, if you can continue holding on to this level, the one outcome could be that it could just chop around with not giving you a closing below 24,750, and then on the upside 25,200 becomes the supply pivot point. And after a few days of choppy consolidation, you might look at an upside breakout. Two, in case you get a breakdown, which looks like a slightly more probable event right now, then I think we might correct to about 24,370, 350 zones.
Okay, all right, got it. Sudarshan, hi, morning to you as well. So what's the setup like and what are the index calls today?
Yeah, good morning. See, the Nifty is trying to find some kind of a direction and it's not succeeding. So we have this choppy market movement, we have volatile intraday moves. So there is no view on the market because it's already breached that 24,750 level. Now all we have to do, so what's the trade? The trade is that if the Nifty decides to go down, and it could easily, then I don't actually recommend going short. We can have volatile upswings in between. That will be difficult. If the Nifty stabilizes here and starts showing upside momentum, after it goes up a 50 or 100 points, then probably a buy is justified. But at current levels, it's just wait and watch.
Okay, wait and watch. Let's quickly get to stocks then, if the index view is not clear. Mitesh, morning. Your list for the day?
Good morning, Sulpi. I have a mix of buys and sells. On the buying side is HDFC Bank. In fact, that's one stock, which is the reason for the outperformance of the Bank Nifty, and which is also managing to keep the Nifty, afloat above the support level. So HDFC Bank, I think, could test the recent highs of 1780. So buy here with the stop below 1700. A buy on Page Industries with a stop below 44,140 for targets of around 45,300, 400. And a couple of sell calls. IOC is a sell with a stop at 163.5 for targets of 152. And Aditya Birla Fashion is a sell, a conditional sell. If it breaks 321.5, it's trading about a couple of points above that. So sell below 321.5 with a stop at 327.5 for a first target of 310.
All right, Sudarshan, let's get your picks as well.
Well, I'll start with Tata Chemicals, which Prashant was discussing in a different way. At least technically, Tata Chemicals remains a buying opportunity with a stop at 1130. I have one intraday short, that is Coforge. That had a big decline yesterday for whatever reason. Coforge is an intraday short with a stop above 7,200. Two more buy ideas, Eicher Motors, which is giving signs of life, consider buying with a stop under 47.40. And Axis Bank from the banking group. If at all the market needs to go up, wants to go up, the banks will outperform. Consider buying Axis Bank, stop under 1160.
Okay, Sudarshan and Mitesh, thank you very much for that. We'll talk again soon. We'll take a break. We are back with a pre-open session. We'll have the management of EPAC Durables joining us to talk about a tie-up that they have done. That's coming up in just a bit. Stay with us.
dark patterns. It refers to user interface practices that can be deceptive and misleading. And almost every e-commerce platform uses these dark patterns, from your e-pharmacies to online marketplaces to food delivery apps to even quick commerce platforms. And social media has been flooded with people posting about these practices, and a lot of these posts are from angry and frustrated users. For example, a woman claimed she received a notification from a quick commerce platform saying that an emergency contraceptive pill was missing from her cart and that she must add it. Another user on another quick commerce platform claimed that an item was automatically added to the cart at checkout without his consent. The Consumer Affairs Ministry has recently issued guidelines identifying 13 specific dark patterns that companies must avoid. These range from manipulating user privacy to misleading pricing practices. It has also warned that violations could see businesses facing lawsuits under the Consumer Protection Act of 2019. Let's take a look at top 5 dark patterns that you should be aware of. First is privacy deception. That's when apps trick users into sharing more personal data. For instance, some apps may ask for permissions, but the functions being accessed often have nothing to do with the app's primary purpose, like loan apps asking for access to your camera or your photo gallery. Second is basket sneaking. This is when an unwanted item is added to your shopping cart without your consent, often just before the checkout, and in turn increasing your total bill. Another one is false urgency. This refers to practices like limited time offers which push a user to make a purchase immediately without allowing much time for reflection. Then comes bait and switch. This happens when you are promised one outcome but end up with something completely different, like clicking on a link thinking it may open to a news article, but it is an advertisement. Then there's also subscription trap. This is when users unknowingly sign up for recurring services and then find it difficult to cancel these subscriptions or get a way out of it. So be careful when you're using an app, read the terms and conditions to understand what you're signing up for, and double check your carts and keep your private information safe.
But I just want to quickly recap all the IT earnings that have come.
Okay, welcome back. I think we're about a minute away from the pre-open session, so we'll get you the rates in a bit from now. Now, the big story, which I think it's the selling from FPIs have been so large that it's moved away from pink papers to the white papers in that sense, right? $10 billion worth of FII selling in October so far. Now, I had the opportunity to catch up with Manish Chokani on this and some other important topics. The consumer slowdown, which we've all been talking about, how real is it? And of course, the big one, which is a potential Trump presidency and what it may mean for markets. So listen in to some of that conversation.
A bit like 2008, except the base is very different. Much larger. We're 3.5 times of that time. And also the fact that there's a lot of domestic money, otherwise this would have been a deeper correction. Yeah. But having said that, foreigners own 15-16% of India. So it's about $800 billion at least of stock which they have. So they've sold 10 billion. It's like poor chaps have traded 1% of what they hold. We shouldn't be grudging them that. In the context, in the last 6 months alone, we've raised $30 billion in our markets, of which 15 has come from companies raising it for building new capacities or whatever. Right. But 15 has actually been promoter and private equity selling. So if this sort of selling can get absorbed, it creates confidence that this is actually a two-way street. I'm not trapped like I'm in China or in Africa. Now the worry is that with the K-shaped recovery, the top end has gone and bought their bigger homes and their bigger cars and their holidays. What happens to the bottom of the pyramid?
That is the problem?
It is a problem. And clearly...
It's coming into stock view.
It is in stock view. I don't think you're going to... Once you bought a Mercedes, you're going to come back to the market 5 years later, right? Once you bought a larger home, you're coming back to the market 20 years later. And the pool of those top-end homes in India is still very tiny. Like I call it Australia, Philippines and Africa. So the domestic wealth creation has been large. So it's not like consumption will fall off a cliff. But at certain point you hit a stall speed because you've gone through the Australians and you've gone to the topper end of the Filipinos and you can't keep drawing a straight line on an Excel sheet and say this will continue forever. So the asset allocation mix in favor of financials is for sure, but this rate of consumption growth is not, I think, so easy. You need a second wave of impulses to come out. And like I said, the first impulse wave has come. The second impulse wave, normally you get either a catalyst by way of an important industry or an important commodity going up, which probably will happen with precious metals, gold, silver and all, and there's a lot of it in India. That gives you another wealth effect and maybe another booster over there. But the government part which is lacking is on jobs, regulatory reform, skilling, which they're trying to do with the apprenticeship thing. If I go back to financials is number one. Okay. This whole energy, renewable energy kind of is area number two. The whole hard assets is area number three. And in that, what else have I done recently? Let me think. So I have renewables. I have an airline stock, for example, believe it or not, that there is a, hopefully a revival in that as well. I mean, from an individual investor perspective, there's enough to do. And it's not a market which is going to crash and therefore you say, I want to sit on cash. Next Diwali, if we get double digits from the index, I would be surprised. I think at some point, and there are a lot of stocks. Even remember, we've spoken in the past about EMS. Some EMS stocks are down 40%. And it's not like the story's over there. Some of them are over 100 multiple. Some of them are not.
Okay, pretty interesting. So, Mr. Chokhani there is saying that there's still plenty of ideas going around in the market. But Prashant, back to the point on consumer. So, what was the exact view? Because he was giving this analogy of Australia and Philippines.
So, yeah, I mean, so the top end are Australians, and he says, well, that's done. Right? Yeah. They all maxed out. I mean, the spends are maxed out. And the second rung is the Filipinos. He says the upper end of basically the upper middle class, that's done. The middle class is about 100 million.
Now we're talking mass, sort of mass consumption.
But mass is even lower, right? Okay. I mean, that's essentially the Africans, what he referred to, right? He says, well, and that is where the problem is. So this K-shape which we are talking about is now after about 2-3 years of the top end of, absolutely the top end and the upper layer of the middle class consuming all they can. I mean, this slowdown is coming into view, and he thinks it probably will last because you're not going to, as he said, I mean, right, simple stuff. But I think what I found interesting about that is the fact that he says you need another wealth effect. Stock market wealth effect has been huge. You need a new source of this wealth impulse, and that may come from precious metals. Indians own a lot of gold. Yeah. Gold prices are going up sharply.
30%
His call is gold will go even higher.
Whoa,
that can give a sort of another new impetus for people to feel wealthy. That's the wealth effect, to be able to go out and consume and spend.
That's an interesting angle, and of course you'll hear more from that interview as the day progresses. But right now, let's put the spotlight on the big story of the day. It's a bumper listing, the largest ever IPO in India, and a listing from a large auto OEM. Hyundai Motors is on the radar. We have Parikshit joining in. He's been tracking the entire trajectory. And a lot of mixed views, Parikshit, on this one. Tepid listing, quiet listing. But I think it's more than today. This is a big story, right? That's turning a milestone.
Indeed, and it is the largest ever IPO in India's history. Hyundai is raising $3.3 billion from the IPO of its India entity. We're at the NSE right now, and the pre-listing ceremony is going to begin shortly with speeches from the management. You're absolutely right. The retail investor sentiment towards the IPO subscription had been rather muted. It had been around 44% of the retail portion. A lukewarm response indeed, and that's what because all the proceeds from this IPO are going to the parent entity, and it's not exactly clear how India Hyundai will gain out of this IPO. But what bankers of the company and certain brokerages this morning are saying that Hyundai has been a company which has been quick to predict market trends in terms of technology, in terms of the move towards SUVs. They have a favorable product mix. In the past, we've asked them about the lack of a hybrid powertrain, a flex fuel powertrain, and they said that they have all these technologies in South Korea, and if the market demands, they can immediately deploy such products in the country. So the strength of the Korean parent, a strong portfolio mix, the fact that they will have 4 new EVs by 2030, they will be investing in charging infrastructure, is something that people are looking positively at, and many bankers believe that this will add long-term value to the company. So even though it might be a modest debut on Dalal Street this morning, the long-term health of the company, the long-term trajectory of the company is also intact, even though the festive sentiment right now for the passenger vehicle segment is slightly muted. We may just say 4 to 5% growth for the whole fiscal, but at the end of the day, brokerages are expecting somewhere between 6 to 8% growth for the industry over the next few years.
Okay, all right, Parikshit, thank you very much for giving us that perspective. And of course, we're going to come back to you when that bell is sounded out at 10 a.m. when that mega listing does take place. But in the meantime, before we hit market opening, let's quickly get in another corporate conversation going. EPAC Durables is in focus. The company is looking at joining forces with Hisense India to manufacture air conditioners and other small appliances as well. To talk about this, we have with us Ajay Singhania, MD and CEO at EPAC Durables. Mr. Singhania, thanks for joining in. So we know that you're coming together, you want to do the whole range, room ACs and I think appliances like washing machines, etc. And you're setting up a new manufacturing facility for this, I think in Andhra Pradesh. But what's going to be the investment involved? And is Hisense only bringing the technological know-how, or are they also bringing in some money? Give us more granular details on this alliance.
Yeah, so good morning. See, first of all, this new alliance is about EPAC setting up a brand new dedicated manufacturing facility for Hisense at our Sri City location. So this would be like a subsidiary of EPAC. And while we invest close to 30 million in first phase, the idea is to set up a capacity of at least 1 million air conditions to be produced by 27-28. And the production would start from June of 25. Along with air conditions, going forward, washing machines and then even phase 2 refrigerator and other small appliances are also planned. While we invest in manufacturing, Hisense would invest in toolings, designs, the technology and the market. So more important is the market, because India is like a new venture for them. So the whole idea is to create the market in India for us to supply this product. And then going forward, we are also looking at expanding the market beyond India to the globe. So the Hisense has this view of expanding the Make in India product reach outside of.
No, we understand that this is, Make in India for the world. But Ajay, you mentioned 30 million in the first phase. Is that $30 million? Did you mean
$30 million
in the first phase? So when does the second phase kick in? And what's the total investment we're talking about over how many years?
See, the idea is to keep growing. So first phase is something which has now been chopped out, that we'll start with an initial investment of close to $30 million. And then going forward, definitely more investments would be required as we build up capacities for refrigerator and other products. So more investments would come in. But to begin with,
Revenue, Ajay, I'm sorry pressing you because we're just running into market opening. First phase, you're putting in 30 million. What's the revenue projection on this 30 million?
See, like we shared yesterday, we are looking at achieving a revenue of at least $1 billion in the next 4 to 5 years. So that's the whole idea. With a million ACs and 500,000 of washing machines reaching by FY27-28, we definitely believe that within 3 to 4 years, a top line of $1 billion can be achieved with this kind of investment.
Okay, got that.
At the same time, more important for EPAC is that our current manufacturing facilities, which are adjacent to the new facility coming up, would be further utilized to supply components to this new facility. So it would lead to better utilization of our current facilities in terms of capacities, in terms of components getting supplied to the new facility.
Okay, tell us about margins. I mean, are the margins going to be in the ballpark of, I think, in the last quarter, you were at about 6.7%. So is that the target range here as well? How is this going to be?
See, year-ended, so rather than quarterly results, we look at the last year, we achieved almost 8.11 kind of EBITDA margins. So our guidance has been that we'll try to retain similar margins here, and going forward with this alliance also, we are looking at maintaining similar margins. But at the same time, what's more important for us is getting access to their technology, their sourcing capabilities, which will in future definitely help us improve our margins on the current business as well.
Okay, all right. Thanks a lot for joining in, Ajay. Well, that's the big breaking news that's come in there. Ambuja Cements will be acquiring Orient Cement. The stock in the last 2 days has moved up from around 300 rupees to 350. But as we speak, they're going to be acquiring this stake for close to around 395 rupees. Orient Cement is a stock that we should be looking at. I think the total valuation that they're talking about is close to 8,100 crores. And that 8,100 crores will be for a capacity of around 8.5 million tons. So very approximately, it appears that they're going to be spending for 1 million tons. They're going to be spending close to around 1,000 crores, very, very approximately. For Orient Cement, the problem is they haven't been able to add capacity. And the street was sniffing this, for the last many, many months, that it's going to be a bit of a battle. it'll be interesting to see what happens from here on, because one would have thought that actually Orient Cement would have folded it up into Ultratech Cement. But that's not the case, because it seems that Ambuja Cements has gone ahead and paid top dollar for this asset. Remember, it's a very, very good asset, and it has capacity that they can go ahead and add as well. From around that 8.5 million tons, it could go to around 11.5 million tons or thereabouts. That was already on the drawing board with regard to capacity coming in Karnataka. But this is the big news that's coming in there. Orient Cement, to give you a few more details, they have a lot of capacity. Most of their sales are in South as well as in West. So that's about the split out there. And also, it's a profitable asset. It's been doing quite well over the recent past, but growth has been the issue out there. We'll try to get you some further details. But
I was just looking at, and I remember, Nigel, because when you had that conversation with the management, and to get sort of the insight into the psyche, it was very clear that the Adanis have big, big ambitious plans in the cement space. There's literally the Birlas, and now you have the Adanis. Some more, by the way, details from the release. So the transaction's happening at 395 rupees per share, 395.4. And the release says that it will take Adani's total capacity to 97.4 MTPA. And it will help them get to that target of 100 MTPA by March of 2025. That's the volume assessment that they have at this point in time.
So one more acquisition under Adani's belt, right? I mean, and this was, in a sense, there was strong buzz for, and we discussed it, Nigel. A very strong buzz that this is sort of may come. But the point is, it had been coming for so long that I think from a market perspective, so you had one big run-up in the stock price and expectation that something was coming, and then, of course, it all fizzled out. And in the last 4-5 sessions, if you look at it, the stock moved up from about 290-ish to about 350, which is the price yesterday. So in 4 sessions flat, it had, about a 16-odd% kind of a move. So the buzz was there, and it's now sort of finally come through. The pre-open, I think, the news hit the screen once the pre-open ended, I think. So, you're not seeing a reflection of the move in the pre-open. So this is still largely a pre-deal prices that you're seeing. And I think once the market opens in the next 2 minutes or so, we'll have some more we will have the actual reaction starting to come through. So acquisition to be completed, some more timelines, etc. coming through. They aim to acquire about 8.9% from certain public shareholders of Orient Cements. So perhaps, deal with promoters, but at the same time dealing with some other large individual shareholders or institutional shareholders perhaps to acquire more of the company.
Just to give you a few more details, Prashant, if you look at it, 8.5 million tons goes for around 8,100 crores. So it would mean that an EV per ton, it is at around $115 per ton. But what the management is saying that it'll add close to 16.6 million tons, because they're saying 8.5 million tons is operational and already 8.1 million tons is ready to execute. So we'll have to find out, how much are they going to be incurring for that. But the important part is it provides 6 million tons potential addition capacity in North India, leveraging Orient Cement's high quality limestone reserves in Rajasthan as well. So as of now, the valuations don't appear cheap at all, $115 per ton. And every time the management, I recall I had gone to Hyderabad, which is where they have their office. And I said, will you sell if the check is good enough? It appears the check is good enough, because at that point of time, the stock was at around 130 rupees per share.
Okay, now, never a dull day. Big acquisition story breaking this morning, and we'll continue to get you perspective. Get you a couple of analyst reactions and experts as well as we go along. But we got markets to track. It's absolutely flat. So 24,760 is where the Nifty is opening at. You got the Nifty Bank, which is up about 0.13%, 51,893. And you got the Sensex, which is starting absolutely flat as well. Mid-cap index is up about 0.14%. And that was where there was the crunching fall. You got the first reactions on Ambuja, which is it ticked in the green and then ticked back into the red. But I think the name to watch, of course, is Orient. And that'll also come up on your screens. A quick look, and then we'll kind of move around. Yeah, so 5% move. So 290 to 370 in 5 days, basically. That's what's happening. There's a 16 rupee up move on Orient Cement. Actually, we should track Orient here on the screen. The Nifty heat map is also on your screen. And it is, I think, evenly split between sort of gainers and losers. And by the way, the market has moved up a little bit from the lows. and we're up about 15 or 16 points at this point. Surabhi.
So the transaction is happening at 395. I mean, Adani's are buying at 395. The stock currently obviously is still, there's a gap about at 369, 370. So there's that gap that the stock has been trying to fill, moving in the last couple of days as well. By the way, CG Power has recovered very nicely. Remember the 6% cut yesterday? This morning, it's up about 4.5%. So that's an interesting reaction. EPAC Durables, you just heard the management speak to us a while back on that high sense alliance, 5% up on EPAC Durables. City Union Bank is the stock of the morning, 8% higher because it's come up with pristine numbers, no complaints with growth, with asset quality provisions, nothing. And the market's really taking that with both hands. Ola Electric, there's a bit of a recovery as well, 3.5% higher, as it clarifies that it's apparently, the claim is it's settled about 99% of the consumer complaints. Those are the early newsmakers. Back to the large cap screen just to track the moves over here. Okay, on the upside, on the Nifty then, Bharti Airtel, Power Grid, Infosys, Ultratech Cement, Tech Mahindra. These are the names on the upside. There's Adani Ports. A little bit of, basically Reliance is also supporting, and there's a little bit of buying on the tech side, Tech Mahindra, Infosys. These are names on the upside, but on the downside, you've got Kotak Mahindra Bank still sulking, down about 1%. There's a Bajaj Auto cooling off after yesterday's 4% move. And SBI Life and HDFC Life, the life insurers are starting the day on a quiet note. That's the split on the Nifty, very sort of soft out there. But, now it's about 30 points higher, 40 points higher. So let's see if the bulls can build on this.
Okay, all right. We got, Anand Shah now joining us. He's head of PMS and AIF investments at ICICI Pru AMC. He's a market master of the day. Anand, good to have you with us here. Thanks very much for your time. The cement deal, which is breaking, another one under Adani's belt, Ambuja acquiring Orient Cements. What do you make of it? I mean, you're going to comment on this transaction or the space? You're welcome to. Go on.
Hi, very good morning, and thanks for having me here. So what's happening in the market in general, and more particularly, instead of creating a lot of capacities, the equity market valuations are so high and equity is so cheap, we are seeing a heightened M&A activity, no doubt about it. This sector has been consolidating for almost decades, if not years, and for a couple of decades where the large players are becoming larger. So I think to that extent, today where we stand on cement sector, the profitability is fairly low. Demand has been sluggish for last couple of quarters. So all those apart, what is keeping the market excited about this sector remains the M&A activities.
Anand, hi, morning. So earnings have started trickling in, and that's the new debate on the street, right? Whether it's going to be worse than the subdued expectations or not. And very mixed early trends coming in. What's your thought? I mean, are we going to see big downgrades post this season? What are you working with?
Indeed, the results indeed are weak, barring banks, which have been, again, there it's a mixed bag, and some of the banks have been able to surprise positively, but barring banks, I think most of the cases we are seeing challenges as far as earnings is concerned. So if you look at market and step back, I think last 4 years have been earnings-led market movement. More so recently, I think our belief is the markets is actually moving ahead of earnings, and there can be some disappointment. So where we stand today, I think some correction in the equity markets will make it a lot more safer, given that our outlook on earnings, especially for this quarter, next quarter, remains subdued. We'll need to see as we move forward what sort of steps government takes to stimulate the economy, or what are the benefits, because what we are seeing is US, Europe, China, all three large blocks of economies are also stimulating. They are cutting interest rates at the same time. So we'll have to be mindful of what's happening in the global recovery, especially China, and at the same time what we do further to boost consumption, particularly, which has been very weak for a while now in this country. So that's the challenge today as we speak, that earnings are soft and might be softer, and the market's been at the all-time high.
All right. I mean, a lot riding on this festive season, right? Because H1 has been soft, H2 and this festive season a lot riding in that sense. You know, just a few other stocks, Anand, I want to highlight before I come to you for more questions, with more questions. City Union Bank, Surabhi, I don't know if you highlighted, 9%. It's a big mover on big volumes. We can have these stocks up. Actually, it's the second largest volume traded name across on the NSE. If you can have those stock up, please. Yeah, so 165 on City Union Bank. Look at that. Orient, by the way, has completely fizzled out. It's the biggest volume mover, but it started 4-5% higher. It's up about 1.25%. But volumes, but price has come off. CG Power should be highlighted, 5% now on CG Power, 8.15. It sold off 6% yesterday. Ola Electric is up about 2%, so 84 rupees. There is Shree Cements, which is up 2%. So, I mean, actually, we should keep an eye out on some of the other cement names as well. So that is up 2% right now. Shree, that is. Adani Green is up 1%. Deepak Fertilizer is up 2%. Newland Laboratories is up 2.5%. Just Dial is up about 1.5%. Jyoti Laboratories, but I mean, volumes are tracking lower. Market breadth is sort of firmly down, 2:1 in favor of declines right now in terms of advances declines. And to look at what is down, Mazgaon Dock, which went up yesterday sharply, is down 4%, is the biggest volume-led loser. Amber, which was, I think, 20% higher, limit up. It's the second biggest volume-led loser. It's down 4% though, but big volumes. PNC Infra. PNC Infra was limit down yesterday. It is down another 11% this morning. PNC Infra is up on it. Look at the volumes, 4 million shares on PNC Infra. And I was talking about Tata Chemicals in the morning. Tata Chemicals is down 3%. I mean, it went up sharply yesterday, but it was in the F&O ban. It's out of the ban. And as a result, it's, you're able to sort of take a trade one way or the other. It's down 3.5%. 361, poor numbers. Vamakshi had highlighted 4% cut there. BEML is down 4%. Garden Reach went up sharply. That's down about 3% or so. And there is Gravita India, a company you will hear from in the next 20 minutes. That stock is down about 5% or so. Viatech Vabag is another one. It went down 6%. It's down another 3% this morning. Sterling Wilson Solar is down to 600 rupees. Had a sharp move. Sold off yesterday a little bit, 2.5%. But that is down this morning as well. Anand, I mean, you know, it's losing money is one thing, but seeing some of your gains erode is also painful. You know, potential sort of paper gains, which you kind of sit on, but that's part of the game, Anand. But have you taken money off the table anyway, where gains have been outsized and you really thought that maybe it was a bit too much?
Indeed, that's all in the active funds management. We keep on doing that. But just to touch upon what you've been talking about, I think it's not new. While the Nifty touched all-time high sometime in third week of September, even at that point of time, we had 255 stocks out of Nifty 500, which are down 10%. If I'm not wrong, more than 90 stocks were actually down more than 30% from their all-time high. So notwithstanding the way Nifty was, I think internally the market was fairly correcting since the election result. So clearly, it's not surprising to us that the broader market is sort of soft or maybe declining, while Nifty is holding on basis few sectors or couple of companies which are heavyweights in the index. So coming back, that's what I was sort of talking about, that the earnings is, I think, what will be looked out for. This quarter might be weak, but we will have global headwinds turning into global tailwinds. We will have recovery from festive and otherwise, post-Rabi crop. And the second half is always a busy season. So we can have some bit of pickup in the capex cycle also. So all in all, I think all focus on fundamentals, focus on economy, which should augur well
Got it. By the way, let's just go back to City Union Bank for a bit. This 10% surge in the stock, and I just want to put the numbers out there once again. In a season where asset quality stress is the big worry point and watch point for most lenders, City Union Bank has actually done really well. If you look at the percentage, I mean, gross NPS as a percentage, that number has actually come down from 3.88%, so almost 3.9%, has come down to about 3.5%. And unlike a lot of others where slippages are just shooting through the roof, going up by 100, 120%, that's not the case with City Union Bank. The slippage ratios again come down to 1.47% from 1.53%. And all this coupled with an expansion in margins. Remember, we went in the quarter, again, with the worry about how much margin compression will banks start seeing. Well, no such issues for City Union because they've actually managed to expand the NIM just that little bit. And that explains the surge on the stock today. Anand, on the lenders, so I mean, like I've been highlighting, it's very, very mixed trends, right? Kotak had its own issues, and then, there's HDFC Bank, which obviously is standing tall this quarter. What are you working with? Would you buy anything afresh? Would you stay away? What's the advice? Because it's no longer a homogeneous universe.
Indeed, I think stock picking will be the key across sectors and notwithstanding even in banking. And look, the banking sector actually has come a long way from where it was in terms of asset quality. Obviously, the growth has been subdued on the back of slow growth in the deposit market. But in terms of asset quality, I think the Indian banking industry today stands fairly comfortable. Across banks, be it state-owned banks or be it in private banks, the gross NPA and the net NPA numbers have come off significantly over the last 4 years. And that augurs very well. The capital adequacy is strong. Margins got elevated and now they've sort of stabilized. So I think banking as a sector to us looks like one of those quality businesses, franchise businesses, again, bottom up, depending on which bank we're talking about, where the valuations are still reasonable. Any comparable sector with such ROE and such growth today is trading at a much higher multiples, be it price to earning or price to book. So I think we remain overweight as we speak today on banking sector in general and select banks in particular, which we do a lot of bottom-up research.
Yeah, but this is a season of sharp reactions. RBL down 17 yesterday, City Union up 10% today, Kotak down 5%. So it's really all over the place. Let's quickly actually bring in our colleague Abhishek to detail out why City Union Bank has really hit the bullseye in the second quarter. Abhishek.
Well, it's against the trend in the industry with respect to, slippages and asset quality deteriorating for many players. City Union Bank, on the other hand, has actually improved its asset quality, lowered the slippages and improved its net interest margin as well, which is heartening to see. So if you take a look, the business momentum has been pretty healthy for them. 4.5% growth with respect to quarter-on-quarter deposit momentum and about 2.5% loan growth that they have had. And this has augured well for them. Net interest margin has improved to 3.67% versus 3.54% in the previous quarter. And I think amongst all the lenders, this is the highest net interest margin improvement in a lender that you are seeing in Q2 FY25 on a sequential basis. NII is up 6.8% quarter-on-quarter, PAT is up 7.8% quarter-on-quarter. The annualized slippage ratio has declined on a sequential basis to 1.47% versus 1.53% in the previous quarter. Even their asset quality has improved massively to 3.54% gross NPA ratio in Q2 FY25 when compared to 3.88% in the previous quarter. Macquarie has written on City Union Bank they have an outperformance rating and a target price of 185 per share. They say that growth engine has turned on. They expect ROA to remain at about 1.5 to 1.8% despite higher credit costs that they foresee going ahead. Risk reward looks favorable given the fact that there is potential growth right now and ROA trajectory is good right now. Back to you.
Okay, all right. Got it. Abhishek, thank you very much for that. And Anand, we'll thank you as well for joining us this morning and giving us some thoughts on the market setup right now. The market seems to be okay. I mean, just to flag off the Nifty once again, 38 points higher. One stock that's definitely capturing the market's imagination with its sharp moves and the performance is CG Power. Remember, yesterday after the results came in, the stock was down almost 5%. Today, it's undoing a lot of that cut. Now, the whole chatter around CG Power in the last, I think, 12 to 14 hours has been on margins. The stock fell yesterday because the margins cooled off quite a bit, coming in down to the 12% mark versus 15%. But in the conference call, the management is saying that, the margins will go back to earlier levels and perhaps this is a one-off. So let's start right there. We have plenty to discuss with Mr. Amar Kaul, MD and CEO of CG Power and Industrial Solutions. Great to have you, Mr. Kaul. First chat Thanks for joining in. So let's really start there and get the whole market concern out of the way, and then we'll talk about the big picture. On margins, the dip, I think, happened in the industrial systems business, right? So what makes you confident that this will turn around in how much time? And what is the target margin level? Let's say exit FY25, what is the margin level that you'll target at the blended company level?
Right. So if you see, thanks for having me here. Important is to go a little deeper into what are the margin story there. So what you see there, a dip is not truly dip because this is more of one-off. And the investment that is a special investment that we have done into strategic businesses, right from acquisition expenses to developing our future potential, both in industrial as well as for the power business, and that's where you have a dip seeing there. But if you look at, honestly, if I take out those expenses and look at the adjusted PBT, you go back to normal. So honestly, I'll not be worried about the industrial business so far, and there's a pretty strong strategy behind it.
So you were at 14% margin last year, full year margin. So when you say this is a one-off and you go back to normal, then what's a normal range? What will you target by the end of the year?
So we will be going, of course, I will not give forward-looking numbers to this, but I think important is the action that we are taking right from our go-to-market strategy. Now, industrial, we have been saying, okay, market has not been so good, but what we are doing is control what we can control. And that is something like go-to-market strategy, acting on the areas where we have not been present, and that's where going and opening the doors. And also ring-fencing the customer with the full solution. Rather than being a product company, we want to be there as a solution company and on energy efficiency area.
Yeah.
So that's going to drive. And second area that we are strongly focusing
Amar, hi, morning. Amar, we have a long run. We have questions. Could you? Sorry to push, Prashant here. Morning, and good to see you again. What can margins be? Give us a sense. How much can the recovery be? Looking for a number.
Yeah, so it'll go back to where it was probably a quarter or 2 quarters back. So, and it'll keep improving from there on.
So same quarter last year, you were at 15%. I mean, I'm saying quarter. But at the end of the year, full year, you were at 14%. So can we expect 15%?
It'll go somewhere in that range, yeah.
Closer to 15%.
Okay.
Let me touch upon the other thing, which is the board approval to raise money, 3,500 crore QIP. And what is, so you already have about 1,300 crores of cash on the balance sheet. So what is the need for the QIP? Give us a sense, and where will this money be used to? When are you planning to do this? And could you give us a sense of, why? Yeah.
So yes, your point is right. We do have about 1,300 plus crores of cash sitting there, and we have the investment commitments. If you see in the semiconductor area, we already have made commitments for acquisition of radio frequency component business. So there's a commitment on that. There are more potential acquisitions in the pipeline to keep growing on that. And then when we looked at the cash flow at the end of the year with those commitments, so we'll be at an area which may become a question at some stage towards the end of the year. And the expansion we want to do both in the power sector as well as on the industrial side. And you'll see those things coming up because the demand is so huge. Even with more and more investments, we need to still expand the capacity. So today, if you see, yesterday the board approved up to 40,000 MVA capacity. I think we would look forward to doubling it in next 1 to 2 years. So those investments we'll need this money for.
All right. Hi, Amar. Good morning and good to see you in. This is Nigel on this side. So break it up for us. You have 1,300 crores. You're probably looking to raise 3,500 crores. So the 4,800 crores, how much of it will be used for CAPEX? How much of it will be used for inorganic?
So see, right now our commitment of about 1,300 crore plus is on the acquisitions and only on the acquisition piece of this. And plus, as I said, there's a pipeline of candidates that we are looking at for potential acquisitions as well. And then I would say approximately we need at least the visibility that I have right now is almost 1,500 crores additional immediately on the capacity expansion with the way market is going.
Got it. All right. Amar, CG Tronics, it contributed only around 20 crores to the top line because obviously that acquisition just got closed out. So, how do you see this asset scaling up? Because the targeted market is massive. So what would the revenue targets be on this asset?
So see, it's a step by step. We need to have patience for this coverage. The good news is we got a small development order from Railways coverage locomotive, which should get executed in 9 to 10 months. Another tender has opened for 7,500 crores, which we have participated. Hopefully, in between December, January, that should get materialized. And so that's what starts the whole journey. And the potential that we see in this company and the synergies with the rest of the CG business can be phenomenal. So I cannot give you the number right now on 20 crore, but I think it's just the beginning of the bigger things to come in future.
So on a quarterly run rate, it should start clocking around 40 crores odd?
Oh yeah, I think that should be easily correct. I will be much more than that.
Okay, you want to give us a number? On a quarterly run rate, what should we brace for?
Not right now, any number on that. But as I said, 7,500 crores is the tender. Even if we get 10% out of that, which has to be executed in 12 months' time, you can do the math.
All right, very quickly, with regard to your vision for the company since you've taken over, you're talking about capacity addition, you've done some inorganic growth, and also you're looking at some diversification. Give and take everything, I'm reading a couple of brokerage notes. They are saying that the earnings should compound by around 30% over the next 3 to 5 years. Doable?
Absolutely. I respect your shareholder investors' opinion as well.
But
this I just want to go back to the acquisition bit. So you said 1,300 crore for acquisitions. You said your pipeline of acquisitions and capex will require about 1,500 crores.
Yeah, approximately at this point of time. The market is pretty dynamic, so we'll keep adding.
And the acquisition and this pipeline would be in what area? Because you're kind of diversifying away from just being you already have not away from transformers, right? So could you give us a sense of what the pipeline consists of? What businesses? What kind of businesses? What segments are you looking at?
If you see, yes, we forayed into semiconductor industry, which is of course the future of the industry, and we are not getting only the manufacturing and testing into the country, but we are also getting the design capability so that we are on its own. And if you see semiconductor, it's used everywhere, right? We buy IGBTs today, we import it from outside the country. All that is going to be manufactured here in the country. So we'll keep expanding and investing into those areas to make sure there are synergies across the overall CG.
So, that's exactly what I was coming to, because to get into semiconductor design, you acquired a small company called Renesas, right? So what should we expect on semiconductor? There's the OSAT facility construction that I think is underway already. Give us some timelines. And then what is exactly the thinking with respect to getting into the design side of it? Because that's obviously where the higher margins are. In terms of expecting some revenue, what are the timelines you're working with? And out of this money that you're raising, so 3,500 crores is the QIP money, then there's cash on the book. If you could give a rough breakup, how much towards, say, organic or inorganic growth in semiconductors, how much towards your traditional business, some idea of how you're going to use the money, capital allocation over the next, say, 1 to 2 years.
So if you see, the OSAT business is already progressing. The construction is on way. The management team is already in place. And as for the plan, 2026 is when we'll see the revenue coming out of that. And that's absolutely on the time that we have. Now with the design acquisition of Renesas for radio frequency components business, that opens another area. Now, obviously, it's under the regulatory approvals, which will take, in my opinion, 4 to 6 months at least, because there are multiple agencies to get this together. So having said that, the breakup that I said right now, the clear visibility that I have is almost 1,500 crores we will be needing for capacity expansions, which is internal. We already have commitment for almost 1,300 crores for these acquisitions, investing into those. And then we want to make sure that we are not running out of cash. And that's the reason for raising the money, QIP. So
1,500 crores towards, internal expansion of existing businesses, 1,300 crores towards acquisitions. Can you, give us a breakup in terms of how much semiconductor, how much, for instance, the railways, which is becoming such a huge part of your business. Do you have that visibility right now?
So the breakup is not very clear right now. That's what I said, it's the high order figure. And as we get clarity and we keep talking, we'll keep sharing with you.
All right, Amar, it's good speaking to you today. You have taken over and there's a lot of responsibility on you. This is a stock that was at around 10-15 rupees a few years ago. It's at 800 rupees, but as you've mentioned, you have a long runway in terms of your capacity that you're putting up, inorganic growth, as well as diversification. We're looking forward to chatting up with you in the coming quarters as well. Thanks a lot for joining in. Well, let's get back to the big deal that was just announced. Orient Cement getting gobbled up by the Adani Group. Well, the deal has been done at a valuation of around $113, $114 per ton. Take a look at the stock prices before we get our analyst who's going to join in. Orient Cement, massive delivery-based buying in the last few days. The stock is down 2% now. Just take a look at it. The intraday chart actually should come up for you. And Ambuja Cements, they are paying top dollar for this asset. You know, $115 per ton. That's quite on the higher side. If you look at it. But to help us out with a quick analysis on that front, we have Jyoti Gupta, the Senior Research Analyst, Nirmal Bang Institutional Equities, who joins us. Hi, Jyoti. Good morning. Thanks a lot for joining in. What do you make of this asset? It seems the street clearly sniffed it, so we're not seeing that big positive reaction. But at around $113, $114 per ton, what do you make of it?
Thank you so much, Nigel, for having me here. The deal was almost through 1.5 months back, what I sense, and that's why there was a bit volatility in the stocks. So if you see, on the face of it, this deal looks expensive, but if you look at what Ambuja is going through, I think it makes a lot of sense, because what the company really is facing is clinker shortage. They don't have reserves. ACC has aging plants. They have consumed their limestone reserves for over 60-65 years. What they really need is reserves. So if you look at it, I mean, in terms of reserves, I think it's a fair deal. Yes, expensive, but it's a fair deal. So, and of course, it will give a lot of, good plants. I think good plants, efficient plants is a bonus in this case. Had it been any other deal, possibly it would have sounded expensive to me, but not at this current valuation, because they've got good reserves.
Okay, all right. So you're saying that the valuation is on the higher side, but is justifiable because of the kind of asset. Is that correct, Jyoti?
Yes, because Ambuja doesn't have reserves. ACC is a drag in terms of their cost. They need to optimize on their cost, and if they have to achieve a 500 rupee per ton improvement in their cost, they need plants which are proximate to markets and need enough reserves to to make cement and be able to cater to the proximate markets.
Jyoti, you have had your ear on the ground, and me too. The point that could be a deal breaker, so to call it, was this mine in Rajasthan that they have, the limestone mine. And the street was wondering whether or not the acquirer will be able to take that mine. Now, we have the Adani Cement press release, which is saying that they have this mine in Rajasthan and they can add another 6 million tons. So they believe it's doable. Do you think that everything is clear now and they get this mine all clear?
Actually, Orient had a surface right. They were supposed to get surface rights for this mine by FY24 end. I believe this mine would be transferred to them. Should not be a problem. They will get.
So you don't believe it's an issue?
It's not an issue, right? In fact, what really was the issue was the reserves in Telangana, where they were actually looking for forest clearance. I think that is where that was a problem. I think that is resolved, I believe.
So you believe that it will get the regulatory clearance? That will not be a deal breaker now?
Shouldn't be a problem.
Jyoti, I want you to comment on this as well. We recall when Adani Cement went ahead and bought Sanghi Industries, there was this big guidance that was put up, and not all of that has played out. But, because they did that deal with Sanghi Industries and the profitability was limited to some extent. Now, on Orient Cement, they are saying that they expect the ROS to be at around 15%, and they're expecting the EBITDA per ton to go to 1,500 rupees per ton. You buy that? You think that's possible?
So you see, just buying one asset does not provide you with 1,500 rupee per ton. You see, there'll be a lot of changes that would require to be done at the strategic standpoint for Ambuja. Because some plants of ACC which have aged, which have kilns over 80 years, there is a drag in terms of cost. So obviously, achieving 1,500 EBITDA per ton at a console level without closing a few ACC plants will not be possible. You will see those kinds of numbers only by end of FY27 or maybe mid of FY27 once you have completed a consolidation, which I believe should be in the second half. By end of first half of FY26, you will see, I believe you will hear some more acquisitions as well. And the other thing is Rajasthan results is not coming to immediately. It will eventually come to you in maybe in 3 quarters time or whatever. So till that time, you still need to optimize on Sanghi. There is some issue on the second line in terms of Sanghi, which they are going through. You know that currently they are stuck with their mines in the south, where I believe the mine in Wadi is closed. There is a struggle in terms of clinker in Karnataka and also some plant in the east. I think overall has to be a lot of decision strategic changes that needs to be done in terms of optimizing. Immediately 1500 per ton, no. This will come over a period of time, maybe another by end of FY, maybe in the beginning of FY27. You can. This is very much possible to happen.
They're guiding for that, FY27 itself. Jyoti, final question before we let you go. You know, whenever there is a deal, you have party A doing a deal with party B, but people say, what about party C, D, E, F? You know, because then they say, this deal is done at around $115 per ton. That asset is available at $50, $60 per ton. And you know, in South, there could be many sellers because profitability of these companies, my rough estimate tells me it will go down to around 200-300 rupees per ton in this past quarter at best. Some of them could even report a loss. Now you have a big buyer who's bought Orient Cement. Do you think some of them could come to the table? Could there be any potential assets that get gobbled up in the coming months? I believe that, you know, in West India, that could be one asset that could get folded up. I think both of us would understand which that asset could be, which there has been a rumor for a long time. But in South, do you think that one of these assets could get picked up and now it gives you some valuation comfort with them?
Yes, actually, Adani is already in discussion with a couple of assets. We just have to wait and watch which one is going to close down. So yes, and those assets are bleeding. I think what you should look at when Adani is buying, please don't look at the plant and machinery. Even when we used to look at, when we were valuing, we're not looking at plant and machinery, we are looking at the reserves. If you have reserves, which is as good as 50 years or lasts you at least 60, 70 years, is what the valuation. And I think that makes a lot of sense. So be prepared. I believe there are a couple of deals which are going to close by first half of FY26, because 180 million ton that he's saying will also require you to close a few plants in ACC, or rather be replaced by new capacities. So what you're looking at in South, and I also know what was the bids which are being offered. I think it will be a fair deal as long as you have enough reserves. I think it makes a lot of sense too. We will see a few deals coming up in the next 6-7 months.
You know, Jyoti, it's always such a pleasure listening to you, and you bring such fresh perspective. Prashant and Nigel, both of you are sharing an inside joke about what is this asset in West. So tell us also what. But we'll touch upon that.
I think in West, and there'll be one in South as well. But you know, we'll keep it at that.
All right, Jyoti, thank you very much. It's a pleasure. Thank you. Appreciate your time here on CNBC-TV18. You know, I saw a flash, and this is not good. So this is government sources saying, and this seems like deja vu, because if you remember, sometime back you had the, I think this is a few months ago, the oil and gas minister, essentially commenting about CGD profitability and the margins that they're making, etc. Remember, I mean, that episode lasted a couple of days, stocks completely tanked. And I think we've got now government sources saying market expectations need to be more nuanced on CGD profitability, right? This, in a way, flies in the face of expectations that city gas companies will immediately hike prices, etc. And that's why I'm saying this has a certain sense of deja vu. City gas companies' profits may normalize with APM gas cuts. Normalize lower. I mean, I think that is a clear hint coming in from the government. And this is the second time in the last at least 6 months, because that earlier episode was about 6 months old. And that was, of course, from the minister himself on the record. And at that point, I remember we'd spoken with the PNGRB chaps and asked them what this would mean, etc., whether a directive has been issued to them or some such. But, you know, that is what is coming through. The only sort of silver lining is that city gas companies have already sold off so aggressively. And this is coming into already a completely sort of beaten down space in that sense. So more on this as we go along. We'll have our reporter join us as well. But look at the market on the other hand, right? The Nifty is up 70 points. So we've got a surge coming, and it's a pretty strong one at that. 24,842 now on the Nifty. And I must say, the gains are being led by banks. ICICI Bank, the intraday will tell you 25 index points, Nifty points coming in from just ICICI Bank. It's followed by Infi, which is adding about 12 points, and HDFC Bank, which is adding about 12 index points. It's followed by Bharti and Reliance, each 10 points. I mean, Bharti 10, Reliance about 9 odd points or so. So this is what's happening on the index. 66 odd points off the lows by quite a bit, but will we be able to sustain is the question. We take a break, we are back, and more stock-specific action on the other side when we return.
All the big ones, whether it started off with HCL Tech, and then we had Infosys, Wipro, LTI, Mindtree, and throw in mid-cap names like Mphasis as well. So here are some of the key takeaways. Now, broadly at the headline level, the numbers were fine. Q2 has played out in line with street expectations. So on the top line, you would see that most of the companies delivered, like Infosys delivered versus expectations, TCS delivered, HCL Tech and Wipro were a beat. The margin performance was mixed this time vis-a-vis expectations. So on one hand, you had a TCS and Infosys missing the mark, but again, Wipro and HCL Tech's margin performance was higher than consensus expectation. There are two key trends which have emerged. One is continued momentum in BFSI. It started in Q1 and it's played out in Q2, and the management commentary seems to suggest that it's more broad-based this time. Some of them are talking about discretionary spending picking up in the BFSI segment, and almost
Welcome back. Okay, looking at some more trends right now. That gain, which was about 35-40 points, is now expanded to 60 points in the Nifty. So it's good going over there. The leaders today include Shriram Finance and ICICI Bank. So two BFSI names that are leading the tally on the Nifty pack. Then come in some of the IT movers and shakers. So Infosys, Wipro, Tech Mahindra. There's a fair amount of buying over there as well. And then you have the big heavyweights. Look at ITC, Lever, and of course Reliance itself. So all of them put together are sort of all chipping in, and that explains the move that we're seeing on the Nifty now. So no really big issues over there. If I talk about some names beyond the Nifty, then one stock that's catching the eye is Hindustan Zinc. Remember, of course, we had the management conversation as well, and Nigel was telling us about the blowout performance, and the management remains quite optimistic. So 3% up on Hindustan Zinc, 3.5%. And I remember that last question, remember on whether any divestment is going to happen and whether it will happen in this calendar year or not. So, not sure.
This time, Mr. Mishra, he knew what I was going to ask. He said, we are not selling, the government will sell first. They'll do that OFS first. Just one quick point on Hindustan Zinc. The stock used to be 750. It's come down to 500 because there was no float. Now there is a little bit more float post that selling, but still I think only 2-3% is traded. And the reason Hindustan Zinc is doing well, it's the only way you can play silver. Silver's at $34 an ounce. That's only one way to play. That's Hindustan Zinc. And, they're going to do 750 tons in this year itself.
All right. Well, let's address that city gas distribution news flow as well. Sapna is now joining in. Sapna, I was saying earlier, this feels a bit like deja vu. We had that oil minister comment 6 months or so back, which caused a ripple. And now government sources telling you that market expectations about CGD profitability needs to be sort of adjusted, normalized in that sense. Tell us what you're picking up.
Absolutely, Prashant, you read it right. So the understanding basically is that, yes, the CGD players have had a pretty good run and they are still having a good run. But in terms of their, their continued profitability on the higher side, may post this APM gas cut, gas allocation cut, it may just be possible that some normalization, quote unquote, in the profitability may be visible, which is not a bad thing, as per the government view, so to speak. Also, needs to be kept in mind, just to balance this out, in the sense that three players have already made representations to the government last week, and within that, Prashant, is one point I would like to highlight is that, maybe it's also a matter of interpretation. So when you're talking about the new well intervention or gas from new wells in terms of legacy fields, 20% premium pricing, which is part of the Girish Parekh recommendation. That is what cabinet had approved in FY24. there basically the company is saying that this 20% premium pricing should be done actually on the ceiling rate of $6.5 and not the APM rate of 7.48. So as of now, the APM rate is 7.48. So a 20% on that actually turns out around $9 odd. That's how the gas pricing will happen for them. In terms of the incremental, the cut that has happened, the incremental gas that is to be sourced from the new wells. So that is one aspect where they have put up, and more or less government is indicating that things are not too bad. They have also been cutting allocations for the gas plants as well as for the gas majors themselves, like the internal consumption of GAIL and ONGC. All of that has been coming down.
Yeah.
So this is
I guess Sapna, Yeah, Sapna, I guess the message seems to be loud and clear from what you're telling us, what sources are telling you, that if you want to charge market pricing, make sure your input is also market prices linked and not regulated or administered pricing. Got that, Sapna? Thanks very much. That's an important development and we'll keep tracking it. But now let's move on to the big event of the morning. We're minutes away from that big IPO listing of Hyundai India. If we look at the pre-IPO session, the stock is about 1% or so lower, 1960 was the issue price. And of course, the street has been abuzz with the fact that this is probably going to be a tepid listing. The retail portion was not fully subscribed. Ashwin Patil, equity research analyst at LKP Securities, joins in to talk about not just today's view. Obviously, we're looking at a medium to long-term view. This is a very large enterprise that's looking to list in India. Ashwin, so the concerns have been well documented, right? It's an OFS, the Koreans are selling 17% equity, taking the money out. But what's your view? I mean, does this at all make sense for someone who's looking to add to auto positions from a medium-term basis to the portfolio?
See, I think that, Hyundai is a second best option after Maruti because, it's a pure play and has been in the industry since more than 2.5 decades. So they know the intricacies and, all the nuances of the auto passenger vehicle industry in India. They're the number 2 player. They have got a market share close to about 15%. And the market decline has not been that stark as compared to Maruti also. And they have got strong numbers. Their margins are close to about, in Q1, they reported 13.8% kind of margins as against Maruti's 12.2%. So, their product mix is also very strong, as in 68% of their volumes come from the SUV segment, while for Maruti, it's about, it's quite less as compared to them. But the small car segment, which is decelerating, that is, for Maruti, it's at about 39-40%, and for Hyundai, it's just at about 12%. So, and 68%, as I said, come from SUV segment, and 20% come from exports. So, they have got a very rich product mix. And they have got a very, good, product line pipeline coming up, with 4 new models coming in next 1 or 2 years. And the Creta EV is one that everybody is waiting for. And they have got a good product mix in form of CNG. They are coming up with a good CNG product pipeline as well, ICE as well as EVs. So I think, they have got very good return ratios as well. So it's a good bet to be into from a medium-term to long-term perspective, I guess.
Okay, I think we've got the Hyundai management pictures. Now, let's stay with the pictures because the bell-ringing ceremony anytime now. And let's have the price on one side and because I think we should be able to view this as the largest ever IPO in India. Makes it to the market. There you go. That's essentially, so you got the car, you got the people, you got the price, and you got the logo, all in one frame. And you got the first the gong and the bell going off anytime, and in the next couple of seconds. So it's going to be, at least at start, as was expected, at a slight, it's going to be flattish, right? 1900 odd is where the indication is the stock is going to come to the market. And it's about 29-26 rupees lower than what they sold stock at in the IPO. And look at the volumes already on the NSE, 4 million shares, and of course on the BSE as well.
That's a Creta, right? There's a Creta rotating around there. I think so.
I think that is the Creta. I think there's a Creta. And if you remember, they told us that there will be the Creta EV, which is going to come to the market pretty soon. I think they said by the end of the year, by December, that should hit the market as well. So you got the NSE boss and you got the Hyundai boss, and of course the contingent from Korea, which is here, and I think you got the price starting to trade. So yeah, it's ticked up into the green. It's slightly higher, and it's flat. Absolutely flat. About a quarter higher, a third lower, It's made it to the market at 1934, and the issue price was 1960. So that's essentially what you have on the Hyundai IPO as it starts to trade. 1% down now, 1938 or so. It's a big moment. I mean, it's the issue price, the opening price is the opening price, and we'll sort of continue to talk about that. But it's a car brand which most Indians are familiar with. For so many, it perhaps has been their first car as they moved on, and of course maybe graduated to higher models of Hyundai, and they are now part of the listed universe here in India. Big one, and it's gotten done.
Oh, absolutely. And I remember, I think the brand itself, it'll be part of public memory and private memory for so many Indians out there, right? The revolution that they caused with their Santro and then Santro's thing. And the story goes on. The question is really, what from here? The listing has happened. It's 11 rupees lower. Let's bring in Prakash Diwan into the conversation as well. Prakash, before you joined in, Ashwin was just telling us it's all about the new launches, right? And that's my real question to you. Yes, they're doing much better than Maruti in the SUV space. But the question is, going forward, can they keep taking on the onslaught from, let's say, a Kia, which is a sister company? Can they keep taking on the onslaught from Mahindra and Mahindra? Can they really go out there and get market share on SUVs? And then the whole EV battle as it's building up. If you were to buy Hyundai Motor right now, if anyone were to buy it, that would be based on what kind of market share and sales projections?
Good morning, Subhi. So I think it's very clear. This is a business that you would have to look at from a very long-term perspective. I mean, even when you talk about the history, you're talking about flashes of salience that have happened over the last many years, and you would expect that to continue over the next few years. Now, whether you want to pay a price as steep as this, that's the big question for whatever businesses that they expand or launches that they have. My sense is there's enough supply of newer models from everybody out here. Whether it's Tata Motors, whether it's the new renewed interest with Mahindra, it's Maruti making a comeback. So it's going to be a very competitive market like any other market globally. So you'll have to realistically anticipate that Hyundai would also find it quite challenging to continue growing at the same pace that they've grown in the past. So my sense is it's going to be an average player. There's nothing exceptional about their launches that will make them number one or market share-wise leadership positions in beyond certain segments or sub-segments. So yeah, I mean it's a good auto play to have on the bourses, but you look at the supply of stock that's available. I mean you will always find it extremely difficult. Their idea was an OFX. They never needed the money to grow the business in that sense, and they've done that. So whether as an investor it serves my purpose is the question, and the answer is probably not. So I'm not too excited about buying into Hyundai. You can buy the cars, maybe not the stock.
Ashwin, so let's drop the contrast, right? If you want to own passenger vehicle stocks in India, you've got Maruti, you've got M&M, you've got Tata Motors, and now you have a Hyundai. I'm talking about top of the line names here. What would your pecking order be?
My pecking order would be M&M at the top, because they have got a superior portfolio on the SUV side. Their farm equipment segment is also, I guess, going to do good considering, good monsoons. So at the top would be M&M. Then maybe like Tata Motors would be there because, everybody is aware, they are getting a good kicker from JLRs. And of course, I mean, they have got multiple levers as such. In passenger vehicles also, they are doing good. In commercial vehicles, I think, there'll be green shoots available. We can see them by the end of FY25 or maybe like in FY26 first quarter. So Tata Motors should perform well from, maybe like 2 to 3 months down the line, they should start showing good performance again. And third, I would be, going on for Hyundai and then Maruti because of the points that I said earlier, like superior product mix, then good launches coming up, then higher, contribution, as I said, from the SUVs that goes under product mix again, and strong ratios, and the market share is also not falling to a great extent. They may pick up market share, who knows, with the Creta EV coming up. So I think third would be Hyundai, and then I would go for Maruti in that order.
Okay. You know, on the subject of valuation, Prakash, comment on this. I'm going back to a comment I remember starkly. We had Mayuresh Joshi of William O'Neill in the studios a couple of days back, and he said, look, because the Hyundai management themselves said, you know, it was a conversation with them, and they said that if you take out the post-COVID pop, that whole sort of, you know, revenge buying, pent-up demand, then the steady state growth rate has been about 5% for the industry, for the car industry here in India. So maybe, you know, that's not too bad. That was their argument. But then I go back to what Mayuresh said, and I think it was a very big point that he raised, that in an economy that's growing at 7%, do you want to be buying a business growing at 5%? So just comment on this, and then on the valuations as well. At what price would this look good at all? And then, you know, how would you look at taking exposure to four-wheelers, if at all you will?
Yeah, no, I think that's a very valid question. And as investors, we need to focus on what's the return on the business rather than, you know, how the cars seem and, you know, the products stack up in terms of market share and all. So very interesting, this thing that the penetration rate in India as compared to China. So we still have about 8 cars per 100. China is probably at about 27. The US is at about 60. So, you know, you have all those metrics which tell you that there's a very strong headroom for growth for this market. But at what price? And the taxation structure in India is such, that even if you and I keep buying cars every 5 years, it's not necessarily that the company will make money. You know, the cost of production, the taxation structure, the distribution costs, all of that, the upkeep costs, you know, there is so much of load on that. All of these are fairly loaded in that sense. So it's not a very high margin business anymore. So, you know, that's exactly why the premium car segment is growing faster, because you still have some leeway there. You have double-digit margins coming in, you know, the kind of maintenance money that, O&M money that the landmark tends to make and things like that. My sense is Hyundai is valued richly in terms of, you know, whatever growth rate that they can do, irrespective of how, you know, the market share happens. The market size itself is not going to let them grow too fast. And margins are going to be always going to be having a lid on in terms of, you know, what they can do. So 5%, 7%, 8% growth is at best you could. And that's exactly why the valuations globally are so low. Globally, PE multiples are still single digits or probably just, you know, about 11, 12. And here you are paying 20, 22 times. So that itself tells you that there is a shortage of supply of good paper. And that's why there's demand. And the institutional approach tells you exactly that. So valuations are a bit stretched. I don't think there's much of headroom for the PE expansion to happen.
No, I know. And then there's a question of supply overhang as well, right? The promoters have sold about 17.5%. They'll have to sell more in the market to meet regulatory norms in the next coming few years. Gentlemen, thank you very much for joining in, sharing some lights. We just want to wrap this discussion by perhaps we can throw those graphics up. There are some foreign brokers, by the way, who've come out with pretty strong targets on Hyundai Motor India. Nomura has initiated coverage with a buy. Their target is 2,472. They're optimistic on the product mix and sort of the volume trajectory going forward. And Macquarie also has an outperform rating. They've just started coverage, 2,235. Some of these foreign brokers are keeping a more optimistic view on Hyundai Motor India.
You know, there are some very interesting flashes coming in from... We should have the flashes up if we can, please. Ashwini Bhatia, SEBI, whole-time member, SEBI, is making some comments. There's a Morningstar conference which is underway this morning. And he's speaking at that conference. He's opening, there's a keynote speaker. Look at the comments. India accounts for the largest volume of F&O globally. This is a crown we should not wear. I mean, it's a very, very sort of punchy statements which are coming through from Mr. Bhatia this morning. He says investors are protesting why SEBI has tightened rules. F&O cannot be a national pastime. I mean, if there was... you know, it's such a great way to put it. You agree or not, but it's just such a punchy way to put it. Really gets the message across in terms of what SEBI's thinking is. He's saying that cannot be a national pastime. Investors should make serious investment and contribute in wealth creation. He goes on to say, and we'll put out more stuff, but I'm reading out what's coming in. He says, working on a discussion paper on SME IPOs. Remember, Mr. Bhatia is the one who passed an order in the case of, you know, Traffic Soul. Traffic Soul was a company which is an SME company. They were planning to list on the SME exchange. You know, they collected money, and after the money was collected, BSE essentially raised questions, and then SEBI, and the order was signed by Mr. Bhatia, put out a order essentially asking the company to put the money in an escrow account and asked BSE to investigate and submit a report within a month, I think it was. So he's saying that working on a discussion paper on SME IPOs, which should be out soon. He says disturbed with how IPOs are being oversubscribed, not comfortable with what's going on in the SME space. Retail investors advised to be extremely careful about the SME space, and he kind of goes on. The speech is still going on, but I think that one line, FNO cannot be a national pastime, I think is a powerful way for SEBI to really communicate to the wider market what their thinking really is on that particular subject. But we'll build on this as we go along over the rest of the day. We'll take a quick commercial break. We are going to come back with It's the Economy. My colleague Lata will get chatting with some special guests. RBI, remember, has issued draft rules saying a bank and its subsidiary cannot both be the same, and that is like lending loans. Lata is going to talk about this with Suresh Ganpati of Macquarie and Harsh Vardhan of Bain and Company. That discussion follows in just a bit.
That the BFSI momentum will sustain going into Q3, and this is about 30-35% of the industry revenue. And the second trend is there is a pickup in hiring. Remember, the IT companies went through a long period of headcount rationalization, almost 1.5 years, and now finally you are seeing some hiring pickup. It's seen as an indicator, a forward indicator of demand picking up. But what's the way forward now? Now, come Q3, the outlook is a little bit more muted, largely on account of furloughs and lower working days. So you have a Wipro, which gives you a quarterly guidance, and they're talking about a -2 to a 0% growth in December quarter. Now, Infy's full year guidance, which got upgraded this time, still bakes in about a flat growth in Q3 and Q4 if they have to achieve the middle end of the guidance. Also in the coming quarter, in Q3, you'll have the wage hikes. So companies like HCLTech, Infosys, LTI, Mindtree, Wipro also will have a 2-month wage hike impact. So that will hurt margins for the companies going ahead. Now, keep that in context with the kind of up move the stocks have seen. So on an average, companies are up between 20 to 40%. Names like Infosys, which corrected sharply post numbers, that stock was up nearly 40% since the rally began in June. And this is how the valuations stack up. Infy so it's TCS still right on top of the pack. Infosys retreated a bit after the correction. HCLTech and TCS's valuations are pretty much at par right now, and it's Wipro which is lagging behind. So Wipro's valuations are at a discount, and that's one of the reasons why we've seen the Wipro stock price do well post the numbers came in line with street expectations or marginally better.
So the government of India has a particular ambitious project wherein they want to connect all the villages through optical fiber cable. The tender was submitted by all the participants, including Polycab, and we are expecting the final conclusion by the authorities in the current month. We have participated in all the tenders, and it is now on the authorities to finally conclude and award the tenders. So the government of India has a particular ambitious project wherein they want to connect all the villages through optical fiber cable. The tender was submitted by all the participants, including Polycab, and we are expecting the final conclusion by the authorities in the current month. We have participated in all the tenders, and it is now on the authorities to finally conclude and award the tenders.
Welcome to It's the Economy. Earlier this month, Reserve Bank put out draft rules which said a bank and its subsidiary or group company cannot do the same activity. More specifically, there should be no overlap of lending business between banks and their group companies. So, does this mean Kotak Bank and its group company Kotak Prime cannot give car loans together? That won't be allowed. ICICI Bank, ICICI Home Finance, both give home loans, won't be allowed. HDFC Bank and HDB Financial, both give personal loans. And then you can go on, PNB and PNB Housing, Can Bank and Canfin Homes. Will all this not be allowed? I have with me two experts, Suresh Ganapathy, banking analyst at Macquarie Capital Securities, and Harshvardhan, the senior advisor at Bain & Company. Suresh, just state the problem to our viewers. What are we staring at? And in any case, 2 years are there, right, before the rules apply?
Yeah, sure. So I think the message is pretty clear that the Reserve Bank of India doesn't want any conflict of interest, and they don't want competing businesses to be done at the subsidiary level. So very clearly, they're trying to say that you differentiate these businesses. And now the challenge here, which is not clear, is basically whether you differentiate the business purely in terms of product, or you have a case and argue that you can even differentiate in terms of customer profile. Where one institution can argue that, look, the kind of loans that I am trying to do through my NBFC, I would have anyways not done through my bank, and therefore this has to be treated separately. Again, that's where the regulatory clarity is not there, and that's what the banks are going to try and ask Reserve Bank of India what needs to be done. As far as we are concerned, based on our initial reading of the circular, many banks will either have to sell their NBFCs or stop doing certain businesses through the NBFCs, or merge the NBFC with the bank, which is making the problem a little bit more serious at this point in time. Yeah.
Okay. Mr. Harshvardhan, can you elaborate? What does RBI sense mean? Like, for instance, can Canfin Homes lend to, say, non-salaried categories? And can bank lend to only salaried people? Or affordable homes? Can such distinction be made? Likewise with Kotak Prime and Kotak, can a distinction be made between whom you are addressing the loan to?
Yeah. So Rata, the way I read the circular is that they are making this distinction on the basis of business, neither products nor customers. So if you define housing finance as a business, then they are saying you can do it in only one. Or if it's corporate lending, you can only do it in the bank or in the subsidiaries, not in both. So my view is that it's absolutely clear. Now, historically, they made an exception for housing finance. So I don't know whether that will continue. But to take a step back, Lata, this began, if you remember, when they issued the new bank licensing guidelines in 2012-13, remember? Because that was the first time this logic of not allowing subsidiaries to do something that you could departmentally do within the bank was first kind of explicitly spelled out. And since then, I think RBI has been actually reiterating this. And this circular, I see it as a further sort of re-emphasizing that logic that they had articulated that time. Now, a lot of these banks that have these NBFC subsidiaries predate that time, meaning they were set up a long time ago.
Yeah,
and so
like HDB was set up before the rules.
Yeah, all of them. In fact, since that time, and you should check facts on this, I'm not 100% sure, but I don't think after this 2013, RBI has allowed any bank, any NBFC registration. So all those that were set up before that, they have kind of allowed to continue. Now they are effectively, in my mind, saying, look, I'm going to give you 2 years within which you decide what you're going to do with this. Because after that, either, as Suresh was saying, you merge it with the bank or stop doing some businesses or conduct it in one or the other.
Yeah. 1 minute, Mr. Harshvardhan, my bigger problem is, will they be okay if I just listed it? For instance, HDB, if it is listed, I have no problem. Can Bank is listed. So Canada Bank and Can Bank can do the same business. Or even if you are listed, if I have a 75% majority in you or a 50%, then you will be, treated as
no,
a subsidiary.
Then they are saying, if you list it, but bring the bank stake down to less than 10% of its own capital of the listed country, then they are okay. Because then it's a pure financial investment. But you can't say I've listed it, but I still hold 51% and continue to do this, because then it's your subsidiary. That's the way at least I read it.
Oh, really? Suresh, then there is problem, na? HDB Financial, I don't think HDFC will be able to even, I mean, they're obviously on the path to listing, but I don't think they're looking at 90% OFA, 90% sell-off of equity.
Look, I think
for
the
that
problem
matter,
is,
Can Bank, PNB, yep.
Yeah, Lata, that's the problem here, right? It's like a similar circular to project finance and ECL norms. On one hand, you're saying you have to do project finance, and then you will come with ECL, where the project finance is going to be a subset of ECL norms. Same is the case here. On one hand, you have an upper layer NBFC which is forcing you to list, and then you have got another norm which is coming and conflicting, saying now you will have to sell it off, effectively bring it down to 10% stake. So I think these things are a little bit more confusing. So let's put it this way, that tomorrow HDFC Bank decides to keep it as a 100% owned subsidiary, right? There is no compulsion to list or merge with itself. Then why go ahead and do listing because of the upper layer NBFC rule? So in January, you come and list because of an upper layer NBFC rule. Then the new regulations come in and HDFC Bank takes a call that I will merge with itself. I mean, it just defeats the purpose, right? So it just doesn't make any sense. In my opinion, the way I read here is that it's a waterfall process. The first step is to detect whether it can be or should be a subsidiary or not by doing competing businesses or not. Once you pass that check and then you realize that no, you can continue to be a subsidiary, then the upper layer NBFC norms will apply and therefore you will have to list. So the first step is competing businesses and the next step is listing as per the upper layer NBFC norm.
Now, I'm still not sure whether after the listing, what stake you will be allowed to hold. Will you be allowed to hold just less than 50?
No, the second step comes in only when you're not a competing business. Sorry, go ahead.
They have also laid out the investment norms, right? Where they talk about 10% of banks. Why would they make it? Because my sense is the clear intention is that if you, even if list it and wants to create an arm's length entity, then you better go below 10%.
No, sir, it doesn't say 10. They say banks' investments, including an allied businesses, capped at 30%. So I think...
No, for non-financial. I mean, it's again complicated. So I think 10% of banks' own net worth, 10% of the listed investing companies' equity and so on and so forth. But there is another issue, Arata, if you allow me, I'll point out.
Sure.
There is this whole NOHFC construct, right, which is for businesses that are non-banking businesses. Now, this is also something that they brought out in the new bank licensing. Now, the underlying regulatory logic is very clear, and this is a globally accepted logic that banks' capital should not be impinged on by non-banking risks.
Yeah,
and so banks cannot. Now, the issue in India, a lot of banks own insurance. Now, insurance risks are very different from banks. So like you have done it for these businesses, common overlap businesses, if you insist on that logic of NOHFC as well, then these big banks will have to move the insurance stake into some holding company. That is even more complicated, isn't it?
Oh, yes. So HDFC Life, SBI Life, all this will be an issue. Suresh, any thoughts?
Yeah, but Lata, I mean, there's so much of contradictions here throughout the process. If indeed the objective was an NOFHC norm, while HDFC and Kotak, all of them obviously have these life insurance and NBFCs way before this new concept came in, why was IndusInd Bank given an AMC license? I mean, they got a license as late as 3 months ago, right? I mean, if you want to move towards an NOFHC norm, you should have not given a license to any of the new entities to have this kind of a structure. So it is just very conflicting in the way certain things are being approached at this point in time. Therefore, we need more clarity.
Yeah, the advantage is it's draft. So maybe we will get some clarity probably post November 30th after they get all the, November 20th, I think, after they get all the comments. Maybe Reserve Bank will come with a little more clarity, but it is just very confusing. Mr. Harshvardhan, would you want to add anything more in terms of what they speak about investments in AIF? See, banks' investments, including in allied businesses, capped at 30%. Banks shall not make any investment in Category 3 alternative investment fund. Over there, is there anything that you will worry about among?
Category are essentially hedge funds. So I think RBI probably has risk concerns there. And so they just don't want banks to do that. And they already issued a circular about, not investing in credit as which are lending to your own borrowers, etc., etc. My sense, Lata, is that all of this has been fundamentally motivated by concerns of regulatory arbitrage. Why is this issue about subsidiary doing business that banks can departmentally do not being permitted? Is that RBI probably senses that this is one way of banks that are kind of arbitraging between regulations. Let's take a business like loan against shares. Banks have severe restrictions, but an NBFC owned by bank can do it as much as it wants. And ultimately, as I said, the RBI probably perceives that the risk comes to the bank as a owner. They are the providers of capital. Many of them even lend to their own NBFCs. And look, I always believe that RBI sees more granular and richer data than you and I see in the public domain. So maybe they are seeing something.
Yes, fair enough.
Yeah.
Oh, yes, they wouldn't put in rules unless they are seeing a path to danger.
And remember, another thing is the incentive of arbitraging regulations is the strongest when underlying banking is under liquidity pressure, which is the case right now.
Yes.
So maybe that's also one of the reasons why this probably is the time that they have brought out. I see this circular just as a clarification of what they have been saying for a while now, for at least last 10 years.
Yeah, but more clarifications are needed, sir. Suresh, last thoughts?
Yeah, look, I think, all these large banks, Lata, have some of these large NBFCs. So there are some serious implications coming out of it from the circular in case they really have to divest or merge or list or whatever they have to do, because a reasonable proportion of value is coming from some of these NBFC companies, and therefore it's going to be a tougher process for all these banks with these existing entities, because they will really have to rechange some of their structures in case the Reserve Bank of India is hell-bent upon, let's put it this way, going through the circular in the current shape and format. So maybe some exemptions are being done. Otherwise, it indeed will cause quite a lot of flutter with respect to the parent company shareholders for sure.
Okay, yeah. So the advice from both our experts, Harshvardhan and Suresh, is watch the space. We have to look for the clarification and Reserve Bank's intent, because it can mean a lot to a lot of listed NBFCs and listed banks. Maybe they will get more time to either divest completely, bring it below 10%, or absorb it, completely merge. But watch this space. It is very closely linked to the share prices of the banks and NBFCs themselves. Thank you very much, Mr. Harshvardhan and Suresh, for adding clarity and telling us where clarity doesn't exist. Wrap up on Bazaar on that note. Chartbusters coming.
Well, from a sector point of view, I think the challenge always was the FDI restrictions, as rightly mentioned by Shireen. I think what is important is there is some amount of clarity insofar as the regulations are concerned. I think that's one thing which is behind our back, because that was also a concern. Multi-brand, single brand, I think what can do, who can do, all that is sorted. And I think the sector overall has been growing pretty well. So if you look at FY23, our e-commerce sector was actually valued at almost $80 billion. So there's been an increased amount of growth.
Indian aviation companies today and the regulator and the government is dealing with. In the last 4 days, we've had a situation of 20 plus hoax threats, bomb threats, which have not turned out to be, fortunately, true. But you've had them disrupt airline schedules, you've had them disrupt customer, travel plans, and it's a huge economic cost to an airline as well. Now, how do you deal with this at BA? I mean, how often is this an issue for you?
I think we've well-established protocols, not just at BA, but internationally with airports to deal with these kind of threats. And there is a kind of an assessment you do to understand whether it's a threat that, leads to the grounding of an aircraft or whether it's not something that's credible. I can't really comment on Air India's situation other than I think, airlines have to take the appropriate action that they feel is the right thing to do, and I would support whatever decision they take.
But is the threat assessment done at the airline level, or is it done in conjunction with the regulator as well as the
airport and the
security
airline
agencies?
and the security agencies will be, very much involved. And we use all of the assets that are at our disposal to make the assessments.
And is there an escalation that you've seen in this sort of a threat?
I haven't seen something on this scale in quite a while, but I couldn't really comment on, the specific issues here because I'm not close to it. But other than we've well-established protocols that we enact to make sure that, we stay safe.
Online shopping is easy, fun, and can even be addictive, but it comes with its hidden traps. Who isn't familiar with messages or notifications urging to buy something we were not even looking for, or that we may have missed out on a limited time offer? These are what the Consumer Affairs Ministry calls dark patterns. It refers to user interface practices that can be deceptive and misleading. And almost every e-commerce platform uses these dark patterns, from your e-pharmacies to online marketplaces to food delivery apps to even quick commerce platforms. And social media has been flooded with people posting about these practices, and a lot of these posts are from angry and frustrated users. For example, a woman claimed she received a notification from a quick commerce platform saying that an emergency contraceptive pill was missing from her cart and that she must add it. Another user on another quick commerce platform claimed that an item was automatically added to the cart at checkout without his consent. The Consumer Affairs Ministry has recently issued guidelines identifying 13 specific dark patterns that companies must avoid. These range from manipulating user privacy to misleading pricing practices. It has also warned that violations could see businesses facing lawsuits under the Consumer Protection Act of 2019. Let's take a look at top 5 dark patterns that you should be aware of. First is privacy deception. That's when apps trick users into sharing more personal data. For instance, some apps may ask for permissions, but the functions being accessed often have nothing to do with the app's primary purpose, like loan apps asking for access to your camera or your photo gallery. Second is basket sneaking. This is when an unwanted item is added to your shopping cart without your consent, often just before the checkout, and in turn increasing your total bill. Another one is false urgency. This refers to practices like limited time offers which push a user to make a purchase immediately without allowing much time for reflection. Then comes bait and switch. This happens when you are promised one outcome but end up with something completely different, like clicking on a link thinking it may open to a news article, but it is an advertisement. Then there's also subscription.
A royalty of 3.5% of the revenue, passenger vehicle revenue, to HMC, and in lieu of this royalty, of course, we get all the cutting edge technology, electric vehicles, future technologies as well, the use of brand. Post IPO, we believe that this royalty payment will remain the same. It is not going to increase, and so that is one. The second is, of course, the Namyang R&D Center. It coordinates with the local R&D center. Like, for example, we have our HMIE in Hyderabad, the R&D center. You would have already seen that we have already announced that we are going to improve the capabilities of India in terms of R&D. So I think that is a very critical part of the way going forward for us. Thank you.
गर्ग सर, एंटी प्रॉफिट हिंदी से लिस्टिंग के लेवल्स पे आपकी क्या प्रतिक्रिया है, इनिशियल रिएक्शंस क्या हैं, अगर आप थोड़ी बात कर पाए तो।
देखिए, बिल्कुल एज मैनेजमेंट हमारा हमेशा से ये उद्देश्य रहेगा कि हम अपना बेस्ट करते रहें, ग्रोथ, कंपनी को ग्रोथ के पाथ पे ले आते रहें, इनोवेशन करते रहें, नए प्रोडक्ट्स मार्केट में उतारते रहें, इलेक्ट्रिफिकेशन करें जिससे लॉन्ग टर्म शेयर होल्डर वैल्यू रहे। ऑफ कोर्स प्राइस हमेशा इन्वेस्टर डिसाइड करेंगे, और एज मैनेजमेंट हम हमेशा कमिटेड रहेंगे कि लॉन्ग टर्म इन्वेस्टर वैल्यू क्रिएशन के लिए। धन्यवाद।
थैंक यू
सर। नमस्कार, मैं सौरभ पांडे, जी बिजनेस से। सबसे पहले आपको ढेरों शुभकामनाएं आपकी कंपनी की लिस्टिंग पर। हम आपसे समझना चाहेंगे कि जिस प्रकार का सब्सक्रिप्शन आपके आईपीओ को मिला, किस तरह से आप इसे देखते हैं, क्या उम्मीद के मुताबिक रही, और आगे बढ़ते हुए जो है कंपनी की रोड मैप क्या होगी, और शेयर होल्डर्स के लिए आप क्या लेके आने वाले दिनों में?
तो देखिए, ये जैसे आपने सुना होगा कि ये एक भारत के इतिहास का सबसे बड़ा आईपीओ था। तो ये एक हमें बहुत ही खुशी है कि जिस तरह से हमें सहयोग मिला है सॉवरन फंड्स का, FIIs का, और सबसे ज़्यादा इम्पोर्टेंट जो हमारे भारतीय बाजार के जो निवेशक हैं, जो हमारे लोकल इन्वेस्टर्स हैं, उनका जिस तरह से, चाहे वो म्यूचुअल फंड हैं, टॉप 9 से 10 म्यूचुअल फंड देखिए आप, किस तरह से उन्होंने सहयोग दिया है, इंश्योरेंस कंपनीज हैं, हर तरह से हमें बहुत ज़्यादा सहयोग मिला है। रिटेल इन्वेस्टर्स, अब ऑलमोस्ट 1.48 मिलियन रिटेल इन्वेस्टर्स ने पार्टिसिपेट किया इस आईपीओ के साइज में। तो हमें बड़ी खुशी है कि जिस तरह का हमें रिस्पांस मिला है इस आईपीओ से, और वो हमें इस उत्साहित करता है कि हमें मेहनत करनी है और हमें और कंपनी को आगे ले जाना है, ताकि जो ये शेयर होल्डर्स का हमें जो भरोसा मिला है उस पर हम खरे उतर सकें और हम कंटिन्यूअसली कंपनी को ग्रोथ दे सकें, नई नई इनोवेशन कर सकें। ऑफ कोर्स, जैसे हमने बताया कि लगभग 32,000 करोड़ का इन्वेस्टमेंट जो है वो ऑलरेडी प्लान्ड है, लाइंड अप है। पुणे में 6,000 करोड़ का प्लांट जो है तालेगांव में आने वाला है, जो कि अगले साल सेकेंड हाफ में स्टार्ट हो जाएगा, तो उससे हमें और स्फूर्ति मिलेगी। तो हमारे बहुत ही स्ट्रांग प्लान्स हैं भारत के लिए, और हमारा मानना है कि ये IPO एक बहुत बड़ा कदम है हमारी कंपनी को और ज्यादा भारतीय बनाने के लिए, और बेसिकली सबसे भरोसेमंद भारत का ब्रांड बनाने के लिए। धन्यवाद।
Well, that was the Hyundai management detailing, the way they see things for the time being. The way the street sees it is that they don't like this IPO. Maybe, in fact, it was too expensive for the street's liking. It was entire OFS, so massive supply out there. And also 2 points, getting into the IPO, they paid a big dividend to the parent. 15,000 crores went back to the parent. And they increased the royalty rate to around 3.5%. I think that's something as well. That's hard sentiment. For the time being, the stock at the low point of the day. The markets as well is a little bit lower as we speak. But I think it's a good time, Mangalam, to get to our first management. Gravita India. All right, we'll just
get Gravita India in the meanwhile. One would have thought that with the kind of valuation that Hyundai is demanding, there may be, some rub-off on all the other auto players as well. That hasn't been the case. In fact, there has been some normalization, and we've seen some moderation in demand come by as well for a lot of these auto players. So that's something we'll definitely watch out for. The third quarter, extremely crucial for gauging the consumer health of the country, because the first couple of quarters, you can say that there was disruption related to elections, etc. The second quarter, there were rains, etc. Now the monsoons have been normal. Election and all those things have been done with. Now the proof of this pudding will definitely lie in the eating. The festive season comes by. That will really be the true test of how the health of consumption is. As of now, we are seeing a bit of a decline. But as promised, I think we have the management of Gravita with us.
Well, that's right. Gravita India, that's the first management on our show. They reported a mixed set of numbers because margins came in healthy, but the volume growth was a little bit lower than what Kotak was estimating. Also, if you see the overseas business as a percentage of the total contribution, it's come down to around 30%. We have with us Mr. Yogesh Malhotra, the CEO of Gravita India, who joins us on the show. Hi Yogesh, good morning and good to see you, Ben. Well, let's get a couple of basic numbers out of the way, because the stock, after seeing a big run, has come in for profit taking. Now it's down close to 7%. Volume growth for the past quarter on the lead business was close to around 8%. And if I take the summation of lead, aluminium as well as plastic, it was in that vicinity of around 7 to 8%. For the first half of the year, I think it is close to 20%. For the year, what kind of a volume growth are you looking at? If you could help us out with that. What is the VAP contribution and the overseas business? 3 numbers is what I'm asking you for.
So on a quarter-to-quarter basis, there could be some changes, but we give a rolling 4-year guidance. And for the next 4 years, that is till FY28, the guidance is 25% growth in volume terms, CAGR. And that remains intact. And this is at the back of some favorable policy changes like extended producers' responsibility, battery waste management rules, reverse charge mechanism that has come up only recently, which makes higher availability of raw material for the organized sectors.
So you're saying even for this year, Yogesh, just to clear the point, even for this year, you'll do 25%?
So quarter on quarter, there may be some changes, and year on year, there will be only some small changes. But yes, it will be in the same vicinity of 25%.
Should we work with 20 to 25% to be safer, or do you think that 25%?
Yeah, so 22, 23% to 27, 28%. So it will be in the same range only.
22 to 27% will hold you at this number. The overseas business as a percentage has come down to around 30%. Is there a slowdown in the overseas business? If you could give us a sense on that front, where do you see this number stabilizing at? And also VAP as a percentage of the mix, I think it's holding at northwards of close to around 40%. Where does that stabilize? Overseas business and VAP.
So around 45% of the total revenue is coming from VAP currently, and we want to take it to around 50%. So that also remains intact. In fact, the new target is to increase it beyond 50% also. And as far as the mix of domestic versus overseas is concerned, it will keep on changing from time to time, depending on where capacities are coming up.
Right.
So on a healthy rate, it's around 35% from overseas and 65% from domestic.
All right. Okay, we take that point. Just on VAP and export contribution itself, how does all of that tie into your EBITDA per unit? Because I'm looking at lead, closer to 21.5 per kg. You have aluminum, which is 17.5 per kg. Where does this number settle at? And what does this mean for your margin lines?
So on a sustainable basis, the lead EBITDA numbers are around 18 to 19 rupees per kg. Aluminum around 14 to 15, and plastic around 10 to 11 rupees per kg. But these will keep on shifting. We've earlier also mentioned that because of our global presence, we take advantages of where the prices are higher and then take advantages of that in terms of bottom line numbers. And if you see in the current quarter also, something similar has happened. So we have diverted some of the material into India where we get better margins. So that is also why the domestic sales have gone up. But on a sustainable basis, these are the numbers. And also there is going to be some pressure from the raw material point of view. But we expect some economies of scale, some operational efficiencies. And as I mentioned earlier, please.
Yeah, no. What we're trying to get at is that with all of this, where do we see your margins? Because they're about 10.7% in the second quarter. With the mix that you're changing, with the offsetting of economies of scale from the cost pressures that you have, where do margins stabilize, and what is the trajectory from here on?
So the margins in terms of EBITDA per ton of different verticals would remain almost the same. There would be some slight increase of say around 0.5% in each of the verticals. But as the mix will change and the new verticals are more profitable, like plastic and rubber are more profitable, in percentage terms, you may see some increase going forward.
How much could that increase be?
Around 1 to 2% overall in the next 3 to 4 years. And it's not an immediate change, but in the next 3 to 4 years, you will see some changes.
All right, but plastic as of now is doing 10 rupees per ton, right?
Yes. Yes. So plastic is at a very basic stage. This is just seeing the shift that is taking place because of extended producers' responsibility, where we are developing new products to meet the market demand. And it may take some time, but eventually it will give you higher returns. But it's 10 rupees per kg on an absolute number. In a percentage number, this is much higher than lead, which is around 8% to 9%. In plastic, it is around 12%.
Got it. And your ROS will be maintained in the mid-20s?
Absolutely. It would be upwards of 25%.
All right. Another factor that I'm observing in the first half of the year is your working capital days. That's improved to around 86 days. Where does this number settle down? Because I recall when it used to be more than 100 days, it's come down to 85, 86. For the year, what should it look like?
So absolutely, because now this domestic shift is taking place where we are also going into more tolling arrangements. So the overall inventory days are going to come down. Again, in the next 3 years, we want to bring it down to around 65 to 70 days. And that will increase. I mean, that will come down to that level in a linear manner going forward. So this will create some free cash flows for us. I mean, if you look at the last quarter also, we've generated free cash flows of around 35 to 40 crores. So it will continue to come.
All right. Very quickly, the finance minister has allowed RCB on metal scrap. That's a positive for the industry, right? If you could just sum up in 30 seconds, how does this help you?
So absolutely. I mean, there are generally two economies running parallelly in India. One is the economy that is paying taxes, the other one that is evading GST, etc. So with this mechanism in place, I think that evasion of GST that is taking place will come down. It's a very it's a very good for the organized sector, and this will ensure that the raw material availability for this organized recycling industry increases. And even if you look at the last quarter, we have doubled our overall domestic procurement in India. So we see this going forward also, the same trend will follow.
We appreciate you joining in, Yogesh. The stock has been a big outperformer in the last 1 year. Last two sessions, it's given up close to 10%. But the key numbers that you're giving us is margins will hover around current levels. You're guiding for volume growth of 22 to 27%. And ROS will be northward of close to around 20 to 25%. Well, on that note, though, we'll slip into a short break. On the other side, we have another management waiting for us. That of Raj Ratan Wires. Mr. Choudhary is waiting for us. Stay with us.
Users unknowingly sign up for recurring services and then find it difficult to cancel these subscriptions or get a way out of it. So be careful when you're using an app, read the terms and conditions to understand what you're signing up for and double check your cards and keep your private information safe.
But I just want to quickly recap all the IT earnings that have come through this week, and we had all the big ones. Whether it started off with HCL Tech, and then we had Infosys, Wipro, LTI, Mindtree, and throw in mid-cap names like Mphasis as well. So here are some of the key takeaways. Now, broadly at the headline level, the numbers were fine. Q2 has played out in line with street expectations. So on the top line, you would see that most of the companies delivered, like Infosys delivered versus expectations, TCS delivered, HCL Tech and Wipro were a beat. The margin performance was mixed this time vis-a-vis expectations. So on one hand, you had a TCS and Infosys missing the mark, but again, Wipro and HCL Tech's margin performance was higher than consensus expectation. There are two key trends which have emerged. One is continued momentum in BFSI. It started in Q1 and it's played out in Q2, and the management commentary seems to suggest that it's more broad-based this time. Some of them are talking about discretionary spending picking up in the BFSI segment, and almost all of them are confident that the BFSI momentum will sustain going into Q3, and this is about 30-35% of the industry revenue. And the second trend is there is a pickup in hiring. Remember, the IT companies went through a long period of headcount rationalization, almost 1.5 years, and now finally you are seeing some hiring pickup. It's seen as an indicator, a forward indicator of demand picking up. But what's the way forward now? Now, come Q3, the outlook is a little bit more muted, largely on account of furloughs and lower working days. So you have a Wipro, which gives you a quarterly guidance, and they're talking about a -2 to a 0% growth in December quarter. Now, Infy's full year guidance, which got upgraded this time, still bakes in about a flat growth in Q3 and Q4 if they have to achieve the middle end of the guidance. Also in the coming quarter, in Q3, you'll have the wage hikes. So companies like HCL Tech, Infosys, LTI, Mindtree, Wipro also will have a 2-month wage hike impact. So that will hurt margins for the companies going ahead. Now, keep that in context with the kind of up move the stocks have seen. So on an average, companies are up between 20 to 40%. Names like Infosys, which corrected sharply post numbers, that stock was up nearly 40% since the rally began in June. And this is how the valuations stack up. Infy so it's TCS still right on top of the pack. Infosys retreated a bit after the correction. HCL Tech and TCS's valuations are pretty much at par.
Welcome back. Earnings flowing in thick and fast. You have Paytm's second quarter results where the company has reported a profit on the bottom line as against a loss, but that has a one-time impact, and as a result of which, despite the profitability number, the stock is at the low point of trade. The revenues have declined by about 34%, and there has been a one-time gain on sale of movie ticketing business to Zomato. Remember that deal which had happened, on account of which there has been a one-time gain which has reflected in the bottom line. Because it's a one-time gain, the net profit has been ignored by the street, and the current stock price is telling you that there has been weakness, at least on the top line front, which is a 34% decline too. But let's talk about Rajratan Global Wire. The company reported a mixed set of numbers. There was minor improvement in the top line. However, margins are still below that 16% mark as well. We have Mr. Sunil Chodia, who's the chairman and managing director of the company, joining us to discuss the quarter gone by in more detail. Thanks a lot, Mr. Chodia, for joining in. Always a pleasure speaking with you. You haven't yet uploaded the presentation volume details to the exchanges. So for the benefit of our viewers, if you could tell us what the volumes have been in the second quarter, the first half, and where does your guidance stand at when it comes to this year? Because earlier you had said you're targeting close to 1.25 lakh tons for the entire year.
Yeah, so Mangalam, this quarter we have done 26,500, close to that volume, and our first half volume stands at 53,000 tons. And I think we'll be able to achieve a target of close to 120,000, which I have been telling. 20% growth in volume this year we are targeting, and we are making efforts to achieve that.
All right.
That's a decline from the 1.25 that you were targeting earlier, right?
Yeah, that is because of the geopolitical situation, the numbers in the global market where we are exporting our product are not so good. And also for last 2 months, we see some pressure on the automobile sector and pressure on the volume in the tire business also. Yeah.
All right. Hi, Mr. Chodia. Good morning and good to see you.
Hi, Nigel. Hi, Nigel.
So 1.2 lakh is what we'll hold you at. And in terms of a revenue number, since you're pulling back your guidance by approximately 2.5%, 1,050 revenue should be possible?
No,
with
the
margins?
prices have gone down lately,
Oh.
so it will be close to 1,000 crores this year.
1,000,
We should be touching 1,000 tons. Yeah.
All right. You know what was impressive in
1,000
your
crores.
past quarter's numbers is at least the gross margins improved to around that 38% from around the 35.5%. Though EBITDA margins continue to be in that vicinity of around 15.5%. Earlier,
on a
you had
consolidated basis, yes.
Consolidated basis. Earlier, you had hinted that you would like margins to be in that vicinity, I think, of around 15 to 16%. So do you hold on to that guidance for the year? Given demand, given the operating leverage, should you be in that vicinity of 15 to 16%? I ask you this because first half of the year, it's 14.5%.
Yeah, so consolidated, we will still target 15 to 16%. And that is because there is a pressure in the margin in Thailand business. China is very aggressive in global market. So we are not able to achieve the targeted margin in Thailand business.
And despite that, you are confident of...
Despite that, you are 15, 16, yes.
15 to 16%. You know, on Thailand itself, you had said that you've changed your strategy. You're looking at market share more than margins. So how has that panned out? Because the margins have declined. Have we seen an increase in market share? Because last time, it was close to around 26%.
Yeah, if you compare, Thailand, our volumes have grown 27% in the first half compared to the last year. So we are doing that, yes.
All right.
So what does that market share number stand at right now? Because last was 26%.
In Thailand, last quarter, our market share was little above 30%. In Thailand.
Little above 30%. So you are gaining market share.
What about India, sir? I recall when the stock was getting a premium, you provide to the tire makers. But at one point of time, Raj Ratan Vaya was trading at a premium in comparison to even the tire makers. But that was because your market share was rock solid. This is on a stock market valuation perspective. Currently, what is the market share that you're holding? I think you had hinted at the start of this year it was 37%, if I'm not mistaken.
It's back to 42% in the last quarter. That is what data we collect. Yes, but we are in a competitive business. So our competitors have also increased capacities and there is a competition to gain market share.
So from a long-term standpoint, then what is your margin trajectory likely to be? Because it's competitive out there, for you to hold on to your market share, you'll have to give up some margins, right? So a sustainable basis over the next, say, few years, what are your margins likely to be? And Chennai plant, has it started producing finally?
It has started producing in last quarter. So that project will come up in phased manner. So first phase has started. And we have done around 1,000 tons of sales from Chennai in the current quarter, which is in the volume here. And going down the line, we will keep on increasing the sales from Chennai facility. The sustainable margins will come when we are able to sell major quantities in global market, for which we are making efforts. We have started a company in USA to market our products in USA. We are also have a representative office in in Europe. And there are some green shoots of approvals. And once we pick up the volume, and of course, this business takes time. Picking up volume will happen not in 1 month or 2 months. It will take 2 years, maybe 1 or 2 years. And that is when we think that we will be able to make a sustainable margin of 16, 17, 18. Yeah.
Okay, all right. You've got a strategy in place. Tough times are trying times for you, but you have battled it before. So we wish you all the best and we'll hold you to these numbers. 1.2 lakh tons, 1,000 crores of revenues, 15 to 16% of margins, and holding on to that market share of around 42%. Thanks a lot, Mr. Chaudhary, for joining in and filling us in with all of those details. Well, we'll slip into a short break, come back, and we'll focus on stocks and on market action as well.
And it's Wipro which is lagging behind. So Wipro's valuations are at a discount, and that's one of the reasons why we've seen the Wipro stock price do well post the numbers came in line with street expectations or marginally better.
So the government of India has a particular ambitious project wherein they want to connect all the villages through optical fiber cable. The tender were submitted by all the participants, including Polycab, and we are expecting the final conclusion by the authorities in the current month. We have participated in all the tenders, and it is now on the authorities to finally conclude and award the tenders. So the government of India has a particular ambitious project wherein they want to connect all the villages through optical fiber cable. The tender were submitted by all the participants, including Polycab, and we are expecting the final conclusion by the authorities in the current month. We have participated in all the tenders, and it is now on the authorities to finally conclude and award the tenders.
Formidable recovery from the lows for our indices. When we started, the Nifty was down about 100 odd points, currently sitting with a cut of just 50 points. And the reason why the markets have recovered is because of the Nifty Bank, just below the red line right now, had briefly moved into the green as well, led higher by ICICI Bank. So what we'll do is take note of the way the markets have recovered and also point out to the volatility that we've seen over the last couple of days and take your leave on this edition of Chartbusters. Thank you so much for watching. Trading Hour comes up next.
Yahya Sinwar is dead.
In one hand, I'm happy that Sinwar died, murdered, but in the second, I'm really scared. I'm scared about the 101 hostages. That some of them are still alive, because any minute that is passing by, they are in dangerous.
There were 6 opportunities to take out Sinwar many times years ago, and today it's an object that should have been done, but still the timing is frightening. because as we see now, there is a possibility that it will harm the hostages. Maybe they've been harmed already. Or
Good morning. It's a Tuesday morning. You're watching Trading Hour. I am Reema Tendulkar. With me is Sonal Boothra in the red, but markets are trying to recover from the lows. Benchmark indices are down nearly 0.2%, 50 points lower on the Nifty right now, 24,725. Sensex down 115 points. Mid-caps continue to bear the brunt of the selling pressure this week. Today it's down 1% for the week so far. It's lost more than 2.5%. So there's clear underperformance in the broader markets. But as we said, in the last 30 minutes, at least the fall seems to have been arrested. And now there is an attempt, a little bit of an attempt at a recovery. And banks, I think banks is where you are seeing a little bit of outperformance. ICICI Bank in particular is leading from the front. And IT, led by Infosys, is also a bit higher.
Yes, and some of these consumption names are also supporting the slight recovery that we're seeing in the Nifty. But of course, it's such a busy day, right, today, Reema. We are talking about earnings reactions. We are talking about that big deal in the cement space. Of course, we'll throw some more light on that. We are talking about that big listing, the Hyundai listing, though it has been muted. But nevertheless, it is the big event of the day that we are tracking very closely. Right now, that stock is down 4%. And we do have a lot of stock-specific action in the broader markets as well. We have earnings reactions coming in on Jana SFB. That stock is down around 12%. Weak set of numbers there. Then we do have some of the earnings that we'll be discussing now. City Union Bank, for instance, is up around 13%. Good set of numbers. And that stock is higher by 13%. We'll be discussing that with the management as well. The outlook going forward. But for now, let's do one thing. Let's get some corporate conversations going. Aurionpro Solutions is under pressure today following its Q2 earnings. The company's margin has dipped both on a YOY and on a quarter-on-quarter basis. To discuss the company's guidance and the outlook post this quarter, we have with us Mr. Ashish Rai, the Vice Chairman and Director at the company, joining in now. Mr. Rai, good afternoon. Good morning. Thank you so much for joining in today. Can you give us a sense of what your guidance is? Do you maintain that guidance that you had given earlier of revenue growth of 30 to 35% and EBITDA margins of 20 to 22%? How will H2 pan out versus H1?
Yeah, thanks. First of all, thanks for having me. It was a good quarter. I think guidance, there is no change. So the business is trending quite strongly. So we feel we will grow north of 30% on revenue. We'll keep EBITDA between 20 and 22 and PAT between 15 and 16. The business is trending very, very well. I think there is strong demand environment is fairly strong. H2 typically is stronger for us than H1. Right, so we'll accelerate into the second half of the year and we'll deliver the guidance.
So revenue growth 30-35%, margins 20 to 22%, and profit margins 15 to 16%. In the current quarter, though, we did see your margins decline, Ashish. Can you explain what led to that?
Yeah, so the PAT actually is expanded. PAT is at 16% plus. EBITDA, there is a slight decline in margins, but I think I've said this before. At our rate of growth, we've been growing at 34-35% for 4 years now. At the pace at which we are growing, it's hard to calibrate down to the fine point. So EBITDA will stay between 20 and 22, but from one quarter to the next, it will go up and down a little bit. And there'll always some items. So this quarter, we had in one of the subsidiaries, we had a forex loss of 4 odd crores. So I think that probably shows up a point decline. But I would not read too much into EBITDA numbers sort of dropping from one quarter to the next. The pace at which we're building product out, the pace at which we're scaling up, we will always have EBITDA sort of varying from one quarter to the next, but we'll stay within the band.
All right. You know, you are looking at market expansion. Currently, India is around 61% of your total pie. You have APAC at 31%, US at 7%. Once this expansion does come into place, how will this pie change? What are some of the steps that you're taking for this expansion into newer geographies?
Yeah, so great question. Look, on the banking side, the business has been growing now at 50% plus, and we've seen a very, very strong traction in terms of Middle East and Southeast Asia. We announced a number of wins. We announced a win recently in Saudi Arabia. We've got a number of wins coming in MEA and Southeast Asia. On the transit side, Americas has strong momentum. Of course, US, I think we've done very well. We've expanded into Central America, Latin America as well. US, I think over the next probably 4 to 6 quarters should go into double digits as a percentage. Right now, you're right, it's 7 to 8%, but it's growing slightly faster than the enterprise growth. So I think we should get into double digits pretty quickly. We are now starting to build out our expansion into Europe. So slowly over the next 4 quarters, we'll see pipeline build up that well. So Middle East and Southeast Asia already growing very, very strongly. US growing strongly. Europe is the next focus.
So can you tell us the growth rates that you are seeing in these various geographies in India, US, Middle East, or APAC as you call it? Is it possible to give us the growth rate? 30 to 35% is, on a consolidated basis.
Yeah, so look, at enterprise level, we're growing at about 33, 34%. I think US is growing faster than 50%. The Southeast Asia and Middle East are probably growing faster than 50%. So I think on the banking side of the business, we'll probably, US would probably be even much faster than 50%, right? We'll probably grow the business 70, 80% this year. So overall, I think the international geographies are growing, but the India growth is also very, very strong. Especially the transit payments business in India growing strong, the data center business in India growing very strong. So I think it's hard to say how the mix will change. If India continues to grow as strong as the rest of the world, will probably stay more or less in the same region. But really, I think all parts of the geographies are growing quite strongly.
So if US is 70, 80%, Southeast Asia, Middle East is 50% plus, if your overall enterprise guidance is 30, 35%, what is dragging your growth down? Is it India, which is growing slower than 30, 35%?
Yeah, so remember the banking side of the business is growing at 50% plus, right? And that is roughly 55% of our top line, right? And that will continue to grow pretty strongly. We are recalibrating parts of the other segment, which is the technology innovation group, especially on the smart cities side, which was a bet in India, which we've slowed down a bit, right? So which is what would probably be a headwind on the overall growth number for some time while we recalibrate that business for better economic profile and better margins, right? But even within TIG, transit payments will continue to grow strongly. Data center will continue to grow strongly. The smart cities and the government side is what we are recalibrating for margins, right? But banking will continue to grow at probably 50, 60%.
And the smart cities and government, the business which you're recalibrating, once again, just tell us those businesses and how much does it contribute to your top line?
So it's about a third of the TIG business, which itself is about 45%, right? So that's the slice which I've said before we've been recalibrating, right? And overall, I think the way we operate, the way to look at it is this. We are a IP-led products and platforms player where one has to be careful as you scale up, right? Unlike a services project where revenue is a function of staffing the team, in a product business, there's a lot of interconnected parts. So we've been very careful in calibrating our growth. So various parts of the business from time to time, we will end up, giving them a pause to recalibrate for capacity, recalibrate for product build-outs. Banking, for example, last year and the year before, we had slowed down quite a bit because we wanted to focus the capacity on building out the products. So I think we feel our sweet spot of enterprise growth is somewhere between 30 and 35%. We do not want to scale the business so fast that we take on risks when it comes to delivery reputation, all that stuff. In the product business, that's very, very important, right? So at various points in time, parts of the business will slow down, parts of the business will accelerate. So banking was slow last year and the year before. It's growing very fast this year, probably the next year, and we'll keep on pacing it. But at the enterprise level, I think one should expect 30% is where the sweet spot is.
Mr. Rai, quickly, if you can tell us if your acquisition Arya.ai, that one contributed this quarter, this had around 20 crore top line. How much did it contribute and what is the growth expected here?
Yeah, so I think the way to look at Arya.ai is a part of our bet on where enterprise AI is going, right? So there is obviously a lot of conversations around the frontier models and LLMs, etc., which have its own space. We believe as technology matures, a lot of value creation and hence a lot of value capture for vendors like us will happen on the application layer, which is where we're already very strong with the enterprise application stack we have. The goal with Arya.ai is to bring together a very mature enterprise application stack that we have together with a very mature ML capability, as well as new platforms that we're launching on Arya.ai side, right? So I think we've gone in terms of we want to really lead the world when it comes to fundamentally AI native enterprise applications as they mature over a period of time. We've seen, like, I think the demand for the offerings together. So it's important not to look at Arya.ai by itself. It's important to look at that together with the enterprise application stack. I think the demand is really something we've not seen before, right? So most of the successes we had, for example, in Middle East, Saudi Arabia, etc., that we announced, these are transaction banking offerings going together with the AI enablement that we offered through the Arya acquisition, right? So more and more, every single Orient Pro application, every single Orient Pro capability will go into the market with a very mature AI capability, even AI native applications, right? So the demand is really very, very serious, and I think we're capitalizing on it.
All right. Thank you so much, Mr. Rai, for joining in today. So that's the word coming in from Orient Pro Solutions. H2 is looking better than H1, and they maintain their FY25 guidance on the top line and margins as well. But to the big story now, consolidation continues in India's cement space, with Adani Group-owned Ambuja Cements all set to buy 46.8% stake in Orient Cement. Nigel joins in with all the details. Nigel.
Well, that's right. Another deal, another big day. And that's the big one that the street was waiting for in terms of consolidation. And that was the deal that was announced earlier today. Ambuja Cements will acquire 47% stake in Orient Cement. Out of the 47%, close to 37% will be from the promoter entity, and the other people were the public shareholders out there. Because of the size of the transaction, well, it will trigger an open offer for another 26% in the company. What about valuations? Well, they're paying close to around 8,100 crores of equity valuations for a capacity of around 8.5 million tons. They say that this entire transaction will be funded by internal accruals. What does it work out to then? 8.5 million tons for 8.5 million tons, you're paying 8,100 crores. The rough EV per ton is around $114 per ton. Remember, Orient Cement as well is virtually debt-free. So both the entities, the buyer as well as the seller, both of them are debt-free. What all does Ambuja Cements get? Well, they've detailed it in their press release. They're saying their market share improves by 2%. The capacity as well moves up by close to 8.5 million tons. That's the operational capacity. Another 8.1 million tons is ready to execute, with regard to projects. So that's why they're terming it as around 16.6 million tons. But they're also saying they're getting a mine in Rajasthan. And with that, they can expand by another 6 million tons. Remember, with this asset, there will come the WHRS facility, the captive power plant as well, and the renewable capacity. Just take a look at the trajectory of Adani Cement, from the time they've acquired the unit. From 68 million tons, they have pocketed Sanghi, Penna, and now Orient Cement. And post this transaction, well, the capacity will go to around 97.5 million tons. By the end of this fiscal, it will go to around 100 million tons. What about the guidance they're giving in terms of ramping up this asset? They are saying that the Orient Cement asset can give EBITDA per ton of close to around 1,500 rupees per ton, with ROC of around 15%. Interesting to see how they get there, but they're talking about cost optimization and rationalization of realization as well. So to sum things up, it's a win, win, win. Why do I say that? For Ambuja Cements, they move towards the 140 million ton capacity. For Orient Cement, they get a better promoter. Remember, this promoter entity couldn't really scale up the volume, so the new promoter entity in all probability could do that. And consolidation from a longer term perspective is viewed as a positive for the industry. That said, Orient Cement is under pressure today because the stock had already moved close to 20% in anticipation of this deal, from around 300 rupees to 360 rupees. Back to you.
Thank you for explaining it so well. Need to get into a break. We'll come back and talk commodities. Manisha Gupta joins in on the other side.
And the concern and the worry is very deep, and there should be a deal sealed immediately.
show what matters by your actions, not your words. And my actions are, I'm here, I'm in Pennsylvania, and I'm here for a very important reason, which is, I can't emphasize enough that Pennsylvania is, I think, the linchpin in this election. And this election, I think, is going to decide the fate of America, and along with the fate of America.
Welcome back. It's time to talk about the commodity space. Manisha is joining in now, and today we are focusing on metals. Manisha, how are the moves looking there?
Well, positive really, because tangible commodities do tend to do well when you have uncertainty in the global markets, and the metal prices, which didn't do well in this previous quarter, this quarter actually seems to be picking up quite strongly. Well, you are looking at China economic data coming in on the stronger side for the month of September. It also has been a rate cut from China that has been supportive. So a couple of metals that I'm looking at, one is zinc, which is trading at around 2-week highs right now. There also is a report from International ZN Link, study group, which says that they're looking at a deficit in this year when it comes to zinc to the tune of 164,000. They also believe that the global demand can gain up by nearly 1.8% in this year, and that has been supportive. Smelters also are cutting production because of lower availability of concentrate, so all factors on positive there. The other commodity or the metal that you need to watch out for is aluminum. That one is trading at a 4-month highs. There has been strong China demand. Shanghai open interest for the current contract is at all-time highs, and then the aluminum stocks in China have declined by nearly 20% from its March highs. So all positives there yet again. Also, there is risk on bauxite supply that is coming in from Guinea. Indonesia government in 2023 had banned alumina exports, so markets have been dealing with that shortage when it comes to alumina. Also, when you look at the alumina prices itself, we have seen those trading at record highs in the previous week, still holding around those levels at this point in time. That is because when you look at the ratio as well, that seems to have increased. Earlier in the month of Jan, it was a 15% when alumina was priced at $350 a ton. Currently, in the previous week itself, we've seen that ratio go up to almost 25% because the alumina costing is now at around $633 a ton. So these are a couple of metals that traders are quite positive on right now because of the individual fundamentals there.
Thank you very much for that. Get into a short break. We'll come back with more on the market. Stay tuned.
Western civilization. If they want to slow down everyone in Israel, you got to stop that. There's no way. Those people either need to be they killed or incarcerated, or they will simply try to kill more Israelis. I think a lot of what's happening there is people are being taught to hate. In Gaza from when they're like children, they're taught to hate. And that's really the thing that needs to stop for there to be, long-term peace, hopefully.
Yahya Sinwar is dead. He was killed in Rafah by the brave soldiers of the Israel Defense Forces. While this is not the end of the war in Gaza, it's the beginning of the end. To the people of Gaza, I have a simple message. This war can end tomorrow. It can end if Hamas lays down its arms and returns our hostages. Hamas is holding 101 hostages in Gaza, who are citizens of 23 countries, citizens of Israel, but citizens of many other countries. Israel is committed to doing everything in our power to bring all of them home. And Israel will guarantee the safety of all those who return our hostages.
Now, as Hyundai India finally made its stock market debut, it's worth remembering that the South Korean auto major is no stranger to the Indian market, and it closes in on nearly 3 decades of operations here. Now, the car maker is all set for a new chapter. Bajut Sanid is now revisiting its journey over the last 3 decades. He visits the production base near Chennai and brings us this story of Hyundai and its romance with Tamil Nadu.
28 years ago, a little-known automaker from Seoul, South Korea, decided to open shop right here. Today, Hyundai may be India's #2 auto manufacturer, but if there's one constant in the South Korean auto major's 3-decade-long journey, it's simply the fact that it stayed true to its roots in India at its plant in Irungattakote, near Chennai.
When I joined in 2001, it was 36,000 cars per year, but today we are at 765,000 cars. So the quality performance plays a very key and major role in establishing the volume growth.
As the cliche goes, Hyundai's Tamil Nadu plant has seen it all. From iconic launches like the Santro back in 1998, to the launch of the company's first ever compact sedan in the Accent back in 2014, to the start of its SUV era thanks to the launch of the Creta the very next year.
Creta launch. It was like a festival. So many, all the showrooms were bustling with customers, and like weekdays were like weekends. Customer used to wait in a long queue to experience the car.
In 2021, Hyundai celebrated a first right here where it all began. The company hit a production milestone of 10 million cars made in India, by which time it had already cemented its place as the country's second largest car maker. For Hyundai in India, the possibilities were endless.
You know, it was during the pandemic time that we launched the all-new i20 model, because almost we know that the entire nation, in fact the entire world operations have been stalled, and almost all our counterparts were shelving their new model launches and new model works. So, but we also have had our options to postpone the model launch, but you know, with Hyundai being the way we think, we like challenges and we would like to overcome it.
Hyundai's love affair with Chennai extends to well beyond the 4 walls of its plant. Only earlier this year, the company's flagship SUV product, the Hyundai Creta, became the automobile of choice to the greater Chennai city police, thereby strengthening the bond between the automaker and the city. Incidentally, Chennai is also home to Hyundai's hydrogen R&D ecosystem, where it has partnered with IIT Madras to invest 180 crore rupees towards developing a first-of-its-kind Hydrogen Valley Innovation Hub. Back at the plant, these production lines are all set for a brand new facelift as Hyundai's recently released pre-feasibility report mentioned an investment of 5,000 crore rupees over the next few years towards modernizing these trusty old facilities. This means an increase in the production facility from 5.4 lakh square meters to 7.2 lakh square meters, thereby adding to its present-day headcount of 18,000. This expansion comes in the wake of Hyundai giving its legacy plant in Tamil Nadu a whole new look as it gets set for the next wave of EV launches. The company is confident the road ahead will be a lot more exciting as it incorporates and adapts to new technology, evolving customer tastes, and uber-competitive market dynamics. In Chennai, Jude Sanath.
Okay, facelift for Chennai plant, that's the Hyundai story. But for now, we'll slip into a short break. Sunil Chari from Rossari Biotech will join in to discuss their Q2 performance and more. Stay tuned.
Yahya Sinwar is dead.
In one hand, I'm happy that Sinwar died, murdered. But in the second, I'm really scared. I'm scared about the 101 hostages. Some of them are still alive because any minute that is passing by, they are in dangerous.
There were 6 opportunities to take out Sinwar many times years ago. And today, it's an object that should have been done, but still, the timing is frightening because as we see now, there is a possibility that it will harm the hostages. Maybe they've been harmed already or it will happen. And the concern and the worry is very deep, and there should be a deal sealed immediately.
Welcome back. Well, let's talk about Rossari Biotech reported a steady set of Q2 numbers. Overall revenue rose 3% while operating margins came in flat at 13.2%. However, the textile specialty chemical segment is under pressure with revenue decline of 13% on a YOY basis. The company says export growth will outpace domestic growth going forward. To discuss more on this, we are joined by Sunil Chari, the Managing Director of the company. Mr. Chari, good morning. Thank you so much for joining in. I wanted to understand what's happening in the export markets. You talk about the fact that exports will outpace growth in versus domestic markets. How much exports are as a percentage of total revenues? They grew 32% in first half. What is the growth expectation in FY25? And are these freight cost issues causing any problems with exports right now?
Exports has been a focus area for growth, and especially in our HPPC segment. We feel exports will continue to grow, and our focus is on the US, the larger Americas, including North America and South America, and the Europe market. The focus segments besides home personal care is also agro and pharma and food processing. We see a very good demand and very good potential for growth in the coming quarters.
You say good growth. It was 32% in first half. Will you be able to replicate that in second half as well?
Our guidance has been 10% growth over last year. We do not know the geopolitical situation, so we would hold on to that guidance at this moment.
I thought the revenue guidance, sir, was 12 to 13%. So this 10% guidance is?
Yeah, the 12 to 13% is something which we would like to hold on to, yes.
Okay. But since exports is growing much faster, does it mean the domestic business is a bit subdued, and you're also facing some capacity constraints which you're addressing?
We have capacity constraints also, but we also have a constraint from ethylene oxide, which is our key raw material. We buy this from Reliance, and Reliance was to expand in April 2025, and they have delayed it, and that is one reason. But we still expect our non-ethylene oxide products, which are in R&D pipeline, to grow in the coming quarters.
Okay. So, you were talking about 12 to 13% growth that you'll see in exports, but domestic with ethylene oxide, there are some issues that you're facing. The other business that has been under pressure is the textiles chemicals business. That has continued to be under pressure. What went wrong this time? Is a bigger export contribution coming in from here? And what is the outlook? Will it continue to be under pressure in the second half as well?
Yeah, Bangladesh, is a good market for us, but the geopolitical situation in Bangladesh, there was a change in government, and things were a little slow, but I think they are falling back in line. India textile has also been subdued. But we hope the home personal care and performance chemicals and even animal health and nutrition should more than cover up for the slow growth in textile chemicals.
So in this home personal and performance chemicals, HPPC, which you call 60 to 70% of your overall revenues, you've said, the growth in exports has been higher also because you enjoy higher realizations and margins versus the domestic market. So can you tell us how much higher are the export margins versus domestic? And in the domestic market, are you seeing pricing pressure?
The FMCG, companies have been slower in the last quarter. As you all know, you cover all those companies. We see, I think, this Diwali season, we have good orders now. All our sites are doing well. The exports margin are generally 2 to 3% higher in gross margins than the domestic market. Even though our gross margins were higher, we had higher freight cost, and we continue to add a number of people in sales, especially services, and also R&D. These are two focus areas for us to grow. The new expansion, which is coming up also, needs a lot of people, which we are already taking now. This is something which we feel is investing for the future, and the future seems to be very bright.
So this domestic, in the domestic business, what was the volume growth in H1? And again, is there pricing pressure because FMCG sales have been slow?
Yeah, so this is something which is very heartening, is the volumes have been in the range of 10% growth. And if you see our last 6 quarters, every quarter we are growing. At 498 crores, we are the highest ever quarterly sales. Our institutional chemicals business is doing very well. The Rosari Professional, which we call, which is a 100% subsidiary, we are growing by leaps and bounds. In the PAT and EBITDA, we are also, doing very well. And I think we have the highest EBITDA ever in our history. In terms of also, we are at Rosari, we are at this moment sitting on about 40 crores of cash. growing at such a good speed, investing, and still being like a zero debt company is something which we are proud of.
Okay. All right, Mr. Chari, thank you so much for joining in today and giving us all those details. So that's the word coming in from Rossari Biotech. Steady set, and they expect growth to continue going forward between 12 to 13%. Time for a short break. Management of City Union Bank joins us next to discuss their Q2 numbers and the way forward.
Show what matters by your actions, not your words. And my actions are, I'm here, I'm in Pennsylvania, and I'm here for a very important reason, which is, I can't emphasize enough that Pennsylvania is, I think, the linchpin in this election. And this election, I think, is going to decide the fate of America, and along with the fate of America, the fate of Western civilization.
Welcome back. City Union Bank is fired up in trade after reporting the Q2 earnings. The bank's asset quality has improved. The net interest margins have came in, expanding to 3.67%. To talk more on the numbers and the way forward, we have with us N. Kamakodi, Managing Director at City Union Bank. Thank you very much, sir, for joining in. This is Rima here. So the first question is on loan growth. You've accelerated your loan growth to about 12% year on year and up 5% on a quarter-on-quarter basis. You've seen strong growth in the gold, NBFC segment, and plus in Q4, some of your retail products for home loans will also come out. So by the end of the year, what is your guidance on loan growth? And if you could give us the demand for the individual segments you operate in.
This question on what is our guidance, we have maintained that we will not give any specific guidance and all. But what we have told, particularly with the analyst in the yesterday con call, is that before the end of the year, we should be getting back to the industry level average growth. In fact, we had about 14% growth in the December 2022. For the December 2000 calendar year, there was some setback and we accelerated. We crossed double digit in the June quarter and we were able to firm that up with the 12% now. So going forward, we see definitely we will be able to get it back to the industry level growth rate. And this growth has basically come from our conventional, like say the sectors like MSME, gold loan, agriculture and all. And the new segment, whatever we wanted, like the retail loans and all, are yet to give their own contribution. And whatever growth we have achieved so far is purely from the traditional conventional sector where we were very strong in, and in the same sector only it is continuing. The other sectors, when they start contributing, the growth rate can further increase beyond this industry level growth rate is what we expect. And we are able to see the growth firming up with the existing MSME, secured MSME and gold and agriculture sector itself.
So, Mr. Kamakodi, when you say right now it's coming from the conventional sectors, the growth for for your loan book, going forward, how much will the new segments contribute to overall loan book? And which will be those segments?
They are all basically secured retail segments from the affordable housing, loan against properties and things like that. And in over a period of 3 years, our expectation is that it should be about 6 to 7% of our expanded portfolio is our expectation. It will be happening in stages.
Okay. Do you want to put some more color on 6 to 7%? How much next year? You launch it only in Q4. So how much in FY26? How much do you go up in FY27?
See, basically, we have explained that in terms of the contribution to the P&L. So, like say, first year of like say starting the product will be like say there will be some amount of cost which we have taken upfront, and it will be breaking even in the second year, and the contribution to the profit will come from the third year. So basically, since we say in like say 3 to 4 years time frame to get 6 to 7, incrementally it should be about 2-3% additional contribution to the growth should be what we should be expecting in stages.
All right. You had earlier guided for net interest margins at around 3.6%, but now we are also in a cycle where we might be looking at rate cuts. In that case, do you maintain this guidance for NIMs going forward? And what about your asset quality as well? Where does it stand? Do you maintain the earlier guidance?
Yes, all the guidances which we gave in the earlier, like say, calls, they and earlier quarters, they continue to hold. The net interest margin, like since the reducing interest rate cycle is probably expected to start little later, probably some advantage we are getting into. Whatever we said earlier that like say 3.6% plus or minus 10 basis point, whatever we communicated, they hold in net interest margin. And on the asset quality front also, we said we should be having about 800 crores slippage for the current year compared to 1,000 crores in the last year. All the guidances what we gave earlier, and we should be getting into the range of 1 to 1.25% in the net NPA for the current year, and all the guidances whatever we gave in the past, they continue to hold.
Okay, all right. I also wanted to understand on your advances, because they have improved 11.5% on a YOY basis, 4.7% on a sequential basis. This is also a number that the street seems to like. Can you give us a sense of what growth will come in here going forward, and which are the segments again which contributed to advances growth this time?
Yeah, as I explained to you earlier, whatever growth you have seen so far has purely come from our traditional segments like MSME, commercial trading, agriculture and gold loan. The same sector is expected to contribute, and we were growing, like say, below the industry level growth rate, and we are catching up, and we should be able to get the industry level growth rate before the end of the current year is what we have visibility, and what is that is the thing we have already communicated to the market.
Thank you, sir, for joining in. Have a good festive season. I wish you all the very best. Get into a break. We'll come back with more on the market. Stay tuned.
if they want to slaughter everyone in Israel, you got to stop that. There's no, there's no way. Those people either need to be they killed or incarcerated, or they will simply try to kill more Israelis. I think a lot of what's happening there is people are being taught to hate, in Gaza from when they're children. They're taught to hate, and that's really the thing that needs to stop for there to be, long-term peace, hopefully.
Yahya Sinwar is dead. He was killed in Rafah by the brave soldiers of the Israel Defense Forces. While this is not the end of the war in Gaza, it's the beginning of the end. To the people of Gaza, I have a simple message. This war can end tomorrow. It can end if Hamas lays down its arms and returns our hostages. Hamas is holding 101 hostages in Gaza, who are citizens of 23 countries, citizens of Israel, but citizens of many other countries. Israel is committed to doing everything in our power to bring all of them home. And Israel will guarantee the safety of all those who return our hostages.
Welcome back. You're still tuned into Trading Hour. Well, there's some more pressure that we're seeing on the markets right now. 140 points lower on the Nifty. The mid-cap index is taking further beating. So that one is down around 900 points. And Bank Nifty is the one which is leading to the losses that you are seeing. The index is down 360 points as we speak. And if we talk about the stocks which are leading to the fall that we are seeing from the top, something like an SBI, HDFC Bank, you have IndusInd Bank as well, which has led to the fall that we are seeing from the highs. There are also some of these consumption names, something like a Titan, you have Britannia. The other names are the likes of Asian Paints. So there are a lot of these heavyweights which are leading to the cuts that we are seeing on the Nifty from the highs of the day. With that, let's move on. Speaking at a Morningstar conference today, SEBI whole-time member Ashwini Bhatia raised concerns of the frenzy in the F&O space and said that F&O cannot be a national pastime. Listen into comments coming in from him.
India accounts for the largest volume of F&O globally. We are number one, and globally also, more than 50% of the F&O volume happens in India. This is a crown we do not wish to wear. F&O cannot be and should not be a national pastime, which actually means that savings of retail participants move into the pockets of institutional hands. So just look at the numbers we have told you. 3 years, 1,80,000 crores, and it has been losses for 93% of the investors. 1% make 99%. So your odds are terrible. The surprising part from SEBI angle is this. The moment we came out with the latest regulation, which kick in sometime in November, investors are protesting that, lot size 5 से 15 क्यों कर दिया? Investors are protesting कि आपने सिर्फ एक ही expiry हफ्ते में क्यों कर दी? Investors are also protesting upfront क्यों कर रहे हो, margining and so on and so forth. But finally, this is becoming systemic. As I said, this F&O cannot be a national pastime. You need to do serious investing. We want India to be prosperous. Wealth is being created very, very fast. And I think investors should participate in the wealth creation that is happening in the country.
All right, that's the comment coming in from the SEBI member. But with that, we'll wrap up. As we do that, here's a small programming note. As we prepare to ring in the festivities this Diwali, tune into CNBC-TV18's Market Movers Forum 3 p.m. onwards on the 24th of October, featuring guests like Ramdev Agrawal, S. Naren, Nilesha, and others to help your portfolio prosper this Diwali.
To those who would harm our hostages, I have another message. Israel will hunt you down and bring you to justice.
Stocks continue to trade with a downward bias, declines far outpacing advances. Realty and industrials are the big losers, even as IT and financials hold their ground. Adani Group's Ambuja Cement is set to acquire a 47% stake in Orient Cement from promoters and other stakeholders at an equity valuation of 8,100 crore rupees. The deal triggers an open offer to the shareholders of Orient Cement and sparks speculation over more M&A in the cement sector. Hyundai Motor makes its debut by debuting on the Indian stock exchanges after being the country's biggest IPO, but the stock lists at a discount to the offer price as analysts remain divided on growth prospects. And the CEO is confident of growth, sees more capital investments in India. SEBI member Ashwini Bhatia says that India shouldn't be proud of wearing the crown of the largest F&O volume market in the world. He advises investors to approach equities seriously with an eye on wealth creation and be wary of some SME IPOs. The regulator is preparing a discussion paper on that space. Hello and welcome. You're watching us here on Halftime Report on CNBC-TV18. I'm Mangalam Malu, with me Ekta Batra. It's been fairly volatile for the markets. You know, the only constant of the last two trading sessions has been the underperformance of the mid-cap index, down about 3% in the last two trading sessions itself. For the Nifty, you know, it's been yo-yoing between gains and lesser gains and then losses and then lesser losses. And it's a function of the Nifty Bank. If you look at it, the Nifty is down about 110 points right now. The Nifty Bank is down 300 points. An hour ago, the Nifty was down just about 50 points. The Nifty Bank virtually in the green. So it's been fairly volatile, fairly choppy, with the mid-cap index not doing too well, Ekta.
Hi, Mangalam. Yes, absolutely. We, in fact, have the BSE small cap index also, which is down around 2.5% in today's trading session. So maybe the BSE small cap index should come up for you. On a week-to-date basis already, in just two trading sessions, the small cap index has lost around 4% and on a month-to-date basis, it's lost around 5% So definitely a lot of pressure which is coming to the broader markets, and you can see that in the advanced decline ratio, which is extremely weak in today's trading session as well. Just to put it into perspective, yesterday it was on the declining side, and today it's 1:4 in terms of the BSE. So around 780 odd stocks which are advancing and over 3,000 stocks declining. But let's focus on the big listing today. The South Korean auto major Hyundai makes a lackluster debut on the exchanges. It lists at a discount of about 1% over its IPO price of around 1,960 odd rupees. Our colleague Parikshit Luthra caught up with the top management of Hyundai and began by asking him about how they see growth going ahead. Listen in.
We have a huge aspiration for the IPO because IPO is for our growth. That growth is with sustainability. And this is also we expecting growth to be with our investors. India market is fascinating, and we see this market is really fast growing. And that's why we put the highest strategic focus on here, which means we need a lot of investment with the importance of the proprietary prioritization of our strategies. But to drive this our investment, we need to have the leverage, the capital market as well. So that's why we set up the equity participation in the market, and we'll use the full commitment. We do execute our investment based on our plan.
Right. Any thoughts on why you chose this particular timing?
Yeah, because, well, I think we believe this is the right timing. We've been watching this market as we have been here more than 28 years. Yeah. And I think this is the right timing for building up the momentum. Yeah, because we are expanding our capacity. We build more capacity. And we are also extending our product portfolio. And the R&D investments is what we are putting out the best of our focus at this moment. And more than that, beyond mobility, we are also thinking how we can contribute for the energy sector. Well, those are the reasons why we select, and we believe this is the right timing.
Right. One question that a lot of investors are asking is, what does Hyundai India actually get from this IPO? Because this is an OFS with all the $3.3 billion in proceeds going to the parent entity. So what does Hyundai India really gain out of this?
Actually, well, this is a secondary offering, and well, the sharing out the parents' company, Hyundai Motor, the Korea. So that's why we expecting the cash, the capital, that flows into Korea. But definitely, we will reinvest those the raised funds, because we already committed our investment earlier this year. We talked to the local government, Tamil Nadu, and at that time we already confirmed that the 200 billion, the Indian rupee, is already committed. And also based on our the future investment plan, not only just for the the IPO raised funds, we definitely need more the capital to be injected for the growth of India.
Yeah. Right. One question that I'd like to put to all of you is that we saw the stock opening in the red, flattish opening, so to say. Was this a disappointment? How would you address this drop in the price at which the stock opened? How would you address that, Mr. Chang and Mr. Garg?
I think we see the potential, and we believe we can have the more longer-term view, because as we talked about the investment plan and the solid product lineup strategies, I think we can gain the future position more robust. So that's what we can deliver to the market. Yeah.
Right.
Maybe,
as management, will focus on the performance, on pursuing growth, quality of growth, like what we have mentioned as our part of our strategy. Of course, the price will always be decided by the investor. But I think single-minded focus on how to take the company forward, as President and CEO Jay also mentioned, I think that is going to be the goal.
Right. Mr. Kim, how would you address investor concerns if you had to give us a sense of the long-term commitment and how you will build the brand in India now over the next 10 years? How would you do that?
Our business model is built for long-term success. We have several focus areas in terms of sales. We are pursuing the quality of growth, focusing on profitability and the volume with our prominent product pipeline and healthy dealer sales network. In terms of a brand, we want to be a home brand, the most trusted brand in India, by implementing some India Connect marketing activities, various CSR initiatives. Also, we are focusing on the customer first, service number one, the driver. And then in terms of the electrification, we are developing an EV ecosystem. We are planning to launch 4 EV models, including Creta EV, for this financial year. Also, we are localizing our full EV supply chain. Also, we are investing in infrastructures. And then we are focusing on the export. We are positioning HMI as a production hub for emerging market. So we have a very healthy and balanced domestic and export mix, so which give us not only profit, but also it gives a natural hedge against some market fluctuation. We have a strong long-term strategy.
Right. When you speak about volume growth, Mr. Garg, what kind of volume growth are we expecting in FY25, FY26 and beyond?
Look, if you see the CAGR for the Indian industry, whether you take a 5-year period or a 10-year period, it has been about 5% in terms of volume. However, what is more important is how the average selling price has been going up. Like we mentioned earlier, we are pursuing that quality of growth. So volume is, of course, very, very important. But at the same time, the average selling price is important. The premiumization is important. Because India, if you see, is at the cusp of that growth. Because car penetration is low. At the same time, the per capita income is going up. People are wanting, the key buying decisions have changed from earlier only fuel efficiency or the price of the car to the design of the car. And that is where I believe Hyundai steps in. So we believe with the addition of capacity, which is almost, if you see, 30% capacity addition is happening for HMI in the next 3 years. And this is after a gap of more than 10 years. So I think this is a big moment for the growth of HMI going forward. And we believe that, yes, not only in terms of volume, but this strategy of premiumization, the strategy of adding features and then, meeting the expectation of the customers will help us to really sustain the volume as well as profitability.
But any numbers that you could give us, any percentages?
Look, future guidance is always, we resist from giving a future guidance, but we believe that we are in a position to really, grow in line with the market in terms of volume, and of course, always in terms of average selling price to continuously go up, because the product mix is continuously changing towards SUV, and the higher trim percentage is continuously going up. I'll give you an example. Higher trim percentage was 14% in 2019. Now it is 23%. Because we are adding more and more features. ADAS, we saw the highways being made, and today 8 out of 13 Hyundai models have ADAS. And the penetration has reached 29% in these models. So I think the opportunities will keep on coming. Infotainment is becoming very important. Software-defined vehicles are becoming very important. So HMC's strong prowess and R&D capabilities in these areas will help HMI to really leverage these opportunities.
Right. What would be your 10-year vision for Hyundai in India? You have one EV in the portfolio right now. You'll add another 4 by 2030. If I were to ask you about your vision for Hyundai India in the global scheme of things, Mr. Chang, what would that be?
Well, in terms of the production capacity that we are going to build, India should be one of the most important production the hub for us. To enable this, we also need to invest more and focusing on the R&D capability. That's why we are setting up the production capacity increase and also R&D reinforcement. Those are the two main pillars that can ensure the growth. But if we especially focus on the EV, I think we believe that India is also, thanks to the government, the very strong the aspiration for the decarbonization. I think this is another the momentum that we can build together with the steady government policy, with the consistency, and also infrastructure, where we also need to invest as well. And also, I think infrastructure building together, well, those are the things. The most important, the theme, strategy pillar for us as well.
All right, the management were so positive about the prospects of growth and the offerings that they have over the next few years for the Indian market itself. That's an exclusive coming in from Hyundai Motor. The street, however, awaiting better entry points for the stock price itself. That's the word that has come in from not just the management, but if you look at some of the analysis that we've heard from the experts this morning and all through the period of the Hyundai Motors IPO as well. We take a short break. On the other side, we have another management joining in. PJ Nath, the MD and CEO of Nelco, will join in to decode their second quarter performance.
So what's your bull case for India?
For India?
Yeah.
I don't know, maybe GDP per capita crossing $10,000. I feel like these things grow exponentially beyond a point when there is momentum behind them.
Yeah.
I feel like we need to be a lot more liberal as a country, and like what China did maybe in the 90s, they allowed people to go out there and build and make mistakes, and they were more forgiving as a government. I think we need that phase. I see a lot of people who have been punished for something around entrepreneurship. I think it should be that era of amnesty. If somebody has done something wrong, bring them back in. Like,
can I bring up an example? Are you talking about Paytm, for instance?
No, I'm not. I don't want to give it.
Welcome back. Well, for the markets, it is definitely weak, and there's further pressure, which you can see, in fact, in the mid-cap index, which is now at the low point of the day, down around 1.7%. So currently trending further lower for the advanced decline ratio as well. But let's talk about specific companies now. Nelco is in focus on the back of its Q2 numbers. The company saw a pickup in the revenue, but the margin declined both sequentially and on a year-on-year basis. We have with us PJ Nath, who's the MD and CEO of the company, joining in to discuss the outlook going forward and the performance this time round. Mr. Nath, thank you very much for taking the time out. If you could just start by talking about the margins, which have actually seen quite a significant decline as compared to what you have been reporting in the previous quarters. Q2 was at 13.1%. It's been declining in the past 2 quarters, but it's a multi-quarter low. So what led to this?
Good afternoon. Thanks for getting me in the show. As you said, our revenue has gone. Our revenue has gone up by 11% sequentially, 8% year on year, which is a very positive sign. The margins are lower. 2 reasons. One is that some of the revenue mix has changed. The other point is that we have made significant investment in terms of increasing our supply bandwidth capacity. In anticipation of some of the larger contracts that we are anticipating, which will be coming in. There's been a mismatch in terms of when the capacity has been brought and for the new contracts to get coming in and getting implemented. And that is why you'll see a temporary dip in terms of the margins going down. However, as we go along, as these new contracts keep coming, our capacity has already been augmented, and so therefore we start making more margins. So overall, we are bullish about the year as a whole. And I think in the past also I've said that every individual quarter may not be indicative of how the business is doing. So overall, from a year perspective, we are quite bullish, and the margins will go back to what we used to have earlier.
The margins earlier you used to have were above 20%, at least for FY24, and over the last 3 quarters we've seen them deteriorate. I take your point that you've been investing ahead of expected demand, ahead of expected utilization itself. But with all of that coming in, what would your quarterly run rate on the top line look like? One understands that maybe margins would glide back to those earlier levels, but over the last many quarters that I've been looking at, your top line on a quarterly basis has been hovering between that 75 crore to 80 crore at best, this quarter being 82.5 crores itself. So on a quarterly run rate, what is the top line that we can expect once all these orders start kicking in and your utilization increases?
So we don't give a future guidance in terms of revenue, but I can only say that Q2 has been a good quarter from us from the perspective of where we were earlier, and we see a positive momentum now. So we will see the revenues going up as we go along in the next 2 quarters and beyond that. So I don't want to give a specific number, but suffice to say that it will be growing. And I do understand what you're saying in terms of where is it hovering. It will go up. There's been some amount of lag in terms of some of the contracts coming in, but we see them happening now. As we have entered the month of quarter, in this particular quarter, OND, we see a lot of these orders coming in and getting implemented. And so you'll see a revenue growth for the next 2 quarters and a year as a whole.
So can we just drill down into numbers? Maybe if you could share some percentages with us and some targets with us. FY24, the margins were 18.5%. You're expecting to revert back to those levels?
Yes, we'll be in the range of 17 to 19%. So that's where we'll be eventually for a year as a whole. Yeah.
Okay. And when you talk about revenue growth in the next 2 quarters, you clocked in 11.4% on a year-on-year basis this quarter. So are you going to do similar levels? Is it going to be, can you share a range with us in terms of what we can expect on a year-on-year basis in terms of revenue growth for you in the next 2 quarters?
Yeah, that's like giving a future guidance, but I don't really want to give it at this point in time, except to say that it will be growing beyond what we had last year. And we'll keep talking about it as we go along. Yeah.
All right. Take that point. But your license for in-flight and maritime communication issued by the Department of Telecom, how much has that started contributing? Because you did say that this could be about 25 to 27% of your overall revenue can pick up in the next 1 to 2 years. So wanted to understand how that part has panned out and what's the pickup likely to be here?
When you say in-flight and maritime, that license has got 2 parts. One is the Aero IFC and the other one is maritime. So together it is that. We are hovering between 23 to 26, 27% for the IFMC revenue as a part of our total revenue, as a ratio of our total revenue. So that's what we've been doing. It has been a satisfying business for us so far. Where it'll have a significant growth would be when the domestic aircraft start offering Aero IFC services. We have done a lot in terms of creating the infrastructure. But it is also under discussion with the individual airlines, and they are trying to see what is a business model that can work out, a business case that can work out for them to offer this service in the domestic routes. So as and when that happens, there will be an upside. But as of now, we are in that range of 23 to 26, 27% of our total revenue coming from IFMC.
There was an issue which had taken place, I think, recently on your Intelsat satellite, one of the satellites that the company does use. Is there any financial impact of that? And can you tell us what the status is?
It is an unfortunate event, very rare event that a satellite is lost and it has not been able to bring back. So that's there. However, we have enough satellite bandwidth capacity. And so therefore, we are migrating all our customers who are on the specific satellite of Intelsat onto alternate satellite. So that exercise started on Sunday itself when we got this news. And we are taking care of all our customers. So we don't see any impact because of that on our customers, because we had adequate capacity to take care of all our customer needs.
Just 2 quick questions, or a 2-part quick question before we leave. One, government defense and enterprise segment, you are preferred partner. So how much does that account for in your overall sales? How much is that likely to grow to? And second, the big opportunity that everyone keeps talking about, right? Wi-Fi on domestic consumer commercial flights as well. What is the total addressable market here? And by when does this materialize in terms of numbers for you?
On the first part, so we used to do that strategic electronics business, but we have exited that. So we are completely a satellite communication service provider now. So from that perspective, we are looking at only satellite communication. So we don't look at earlier strategic electronic business, because VSAT business is far more profitable as compared to the strategic electronic business. So that's one. Second is in terms of the domestic aircrafts. See, that particular thing has been under serious discussion. So I'm not really, keen to put up a specific number, because there are alternate business models being looked at as to how to make it happen. So the whole thing will depend on what innovative business models are created, what kind of revenue streams are getting created, etc. So I would say it will take about another quarter or so before we are able to come up with what kind of a market revenue that it can give.
Okay, all right, Mr. Nath, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Nelco. That stock is down around 5% reacting to what has been a margin miss this quarter, despite the revenue picking up. But the company does expect the margins to probably revert back to those levels of 17 to 19%. We'll take a short break, but up next, we'll talk to the management of Supreme Petrochem to decode their Q2 performance. Stay tuned.
because I don't know the details of Paytm.
Okay.
But I wish there is that era in India like there once was in China, where we make the religion of the state for a decade, entrepreneurship. Everybody is allowed to try. They have access to capital. When they make mistakes, they are forgiven. They pay a fine. They come back. They try. That somehow leads India to that $10,000 GDP per capita, and I think that benefits the entire country overall.
Let's talk about the future in the context of what everybody is talking about, AI. So let's get down to it, and I'll start with you, because I know that you believe, and I think I tend to agree with you, that some of it has been misguided assumptions about what it could potentially do or how soon or whatever. Some of it you also believe is plain intellectual dishonesty in the claims that are being made by many, and I'm not talking in the Indian context, but in general at this point in time. I mean, everyone is AI's expertise at your fingertips, or AI first, and so on and so forth. Today, as you look at your business as well as you look at the adjacent ecosystem, what do you make of this?
There is insane amounts of hype, and the moment there are financial incentives attached to anything, AI was an academic dream 60, 70, 80 years ago, and it's evolved into business today. And there is absolutely insane amounts of hype, not just India, globally. But beneath the hype lies legit breakthroughs that have happened in the last 2-3 years. These large language models that all of us use in some form or the other daily now, these breakthroughs have come in the last 2-3 years. And these breakthroughs are legit. Doesn't mean that everything that is said out there is legit. So between the hype, froth and frenzy, legitimate use cases. And at Zerodha, we've started to use some of these things to solve internal problems. Something that a lot of tedium that 100 people were dealing with. We have one small little open source AI system running on one server.
You're the big open source guy, right? The big
Only
believer.
open source.
Only open source, yeah.
So this one system that costs us nothing to run is saving 100 people thousands and thousands of hours of work every month. And it's an open source breakthrough. It's commoditized. Now you can have the most powerful AI models, let's say large language models, at your fingertips at zero cost. You just need to have that tech know-how to use it. So it's been commoditized to such a large extent. When anybody says we are powered by AI, you have to take it with a giant sack of salt, because an 18-year-old teenager,
how giant?
big, an 18-year-old teenager who's tech savvy can start using these things. You can build a business out of it, tool out of it in no time. So it's commoditized to death already. And it's only been 3 years, the specific set of breakthroughs.
That brings me to the question of 14 years on, with the business that you've built, with the money that you're generating at this point in time, what do you see as the use of this? What do you see as the use of this organization? What do you see as the use of the money that you're making individually as well as at a company level?
Investing.
Welcome back. You're watching us here on Halftime Report. Supreme Petrochem is the next management on the show. The company has reported a good year-on-year performance, but weak sequentially. Exports remain subdued due to the ongoing crisis in West Asia. Rakesh Nair, who's the ED of Supreme Petrochem, joins us now. Thanks a lot, Mr. Nair, for joining in. And that really is the first question. You know, the Middle East crisis have impacted your exports in the second quarter. We haven't seen any remediation yet from that crisis. So in light of that, what is the guidance that you can give for exports this year and the overall guidance that you have for the entire year?
Thank you. Our exports are down, not only in this quarter, even for the first half they are down. And essentially because of the slowdown also in Europe, America, as well as in Turkey, which is one of the biggest markets, and the West Asia, coupled with the West Asian crisis. Now, going forward, we will be perhaps trying to recoup some of it by increasing our volumes in the domestic market. But then, as of now, unless we find that there is a uptick in the market in these continents, as well as the the West Asia crisis is resolved, the exports would be subdued.
Okay.
So what kind of volumes are you targeting for this entire year? Because earlier you had a 3.5 lakh tons sort of volume target. With the current crisis in the exports market, what is your target for this year?
We think that we will be able to touch around 340,000 tons.
Okay, 340,000 tons.
340,000 tons.
Okay, okay. I think you were targeting 350,000 tons before?
Yeah, that's right. And now we are targeting around 340,000 tons.
Okay. Is there a chance that there could be a lower target or a higher target from 340?
That's the target we have. We assuming that we are able to maintain the current rate of exports and also some growth in the domestic market. Domestic is doing all right because in the current quarter, domestic market had an uptick by around 5.5%. And in the first half of the year, the domestic market has done well. It has grown by almost 17% for us. And of course, the non-OEM sector in the current quarter did not do as per the expectations. But now the lean period will be over by the end of November or so. So the last 4 months of the current financial should take care of it, I suppose.
The reason I'm asking, Mr. Nair specifically, is to get a sense in terms of the demand environment that you're working in. Are you more negative about the demand environment at this point in time when it comes to, say, the export or even the domestic market? Are you neutral or are you a little bullish in terms of it picking up?
No, as far as the domestic market is concerned, we are bullish. As far as exports are concerned, barring the West Asia crisis or the European issues, otherwise the other parts of the world, the markets are fine for us.
Right. Let's talk about the operational side. How have styrene monomer prices panned out in the second quarter? How do they compare to the first quarter? What's the outlook here? And value-added product as well. You were expecting an increase in contribution coming in from that, and that would aid your margins. So on both these fronts, what's the update?
The styrene prices in this quarter were more or less stable. They were in a range, the 3-4% up and down. But as compared to the corresponding quarter of the previous year, this year the styrene prices were higher. But then during the quarter, they were stable. And as far as the value-added products are concerned, we continue to work on that, and we are currently in the same range of between 35 to 40%, depending upon the quarter to quarter and the market segments, which from where the demand comes in. But then around thereabout, we are there as far as the value-added products are concerned.
So, what's your outlook on margins in that front then? On account of stable raw material prices and stable contribution from value-added products as well?
Yeah, so as far as the annual margins percentage is concerned, I won't be able to give you any guidance on that. But then we hope to do better than the last year.
Okay, all right. You hope to do better than the last year. Just wanted to get a sense in terms of the domestic market a little more. Since you've given us your entire volume guidance, can you give us a sense in terms of the growth that you expect to exit FY25 with when it comes to domestic as well as export markets?
As far as the domestic market is concerned, I think we would be doing clocking a growth of around 8.5% or 8% thereabout. And the exports are concerned, exports would be negative as compared to the previous year.
Negative by how much?
The overall volume growth we are targeting to be closer to 5 to 6%.
Okay.
All right, take that point. Thanks a lot, Mr. Nair, for joining in. Just a final question, if we, you can quickly wrap it up. The ABS plant, when does that start contributing to your overall revenues and by how much?
The ABS plant would be completed by March. There has been a delay by almost 3 months there now, and because of some delay in receipt of equipments. We hope to complete it by March, and in the next financial year should see the volumes coming in from there and adding to our contribution. But in the full year would be the 26-27 financial year.
And what would the revenue contribution be on a 4-year basis?
On a full year basis, on the capacity which we are implementing, it should add around 1,000 crores to our revenue.
Okay. All right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Supreme Petro. Stock is just about lower by around 0.5% at this point in time. It's a lower volume guidance that they have guided for 340,000 versus 350,000 earlier. They are expecting the export markets to probably decline, but they're expecting the domestic market to probably grow around 8 to 8.5% for the year. We'll take a break, but a small programming note as we slip into a break as we prepare to ring in the festivities this Diwali. Tune into CNBC-TV18's Market Movers Forum, 3 p.m. onwards on the 24th of October, featuring guests like Ramdev Agarwal, S. Nareen, Nilesh Shah, and others to help your portfolio prosper this Diwali.
The next 14 years, for instance, for Zerodha mean from that perspective? Let me start by asking you.
Yeah, I mean, today I get really excited with all the startups we support. Like there were 150 investments from Rainmatter, and we've allocated like 750 crores or something like that. So, and Kailash gets really excited with the foundation. I'm also excited, but I'm not in it completely, because I still haven't yet found the cause that I really want to support, as in, something which is close to my heart. Yeah, so there also we committed a significant portion of our capital. I mean, the idea right now is to do 1,000 crores and then see how it goes.
Welcome back. Volatility for the market continues. The Nifty is down 150 odd points. The Nifty Bank down 400 points. The mid-cap index at a 1.8% cut at the low point of trade. Good time to get you an update coming in from the F&O pack. The reason why I call it volatility and intertwined volatility between the Nifty and the Nifty Bank should be up on your screen. You have the intraday charts of both the Nifty as well as the Nifty Bank come on your screen side by side, and you'd see, they have been following a fairly volatile pattern, and they have been pretty mirroring in the shape of those charts itself at the low point. Well, in the meanwhile, just keep an eye out on, Bajaj Finserv. There are news lines coming in from Bloomberg saying that the Allianz has mulled ending decades-old Bajaj insurance joint ventures in India. Remember, we in India know Allianz by its partner Bajaj Allianz. So let's see how that pans out. The stock in focus on account of this would of course be Bajaj Finserv. We have Bajaj Finance's results today and Bajaj Finserv's results tomorrow. So we will hear, if at all, there is any official comment coming in on it from either of the companies in their conference call or the press release post their earnings, more specifically likely on Bajaj Finserv. So Allianz mulling ending their decades-old Bajaj insurance joint venture in India could be a sentiment negative. The quantum of that we'll perhaps come to terms with once it is announced. And remember, this is news that is coming from agencies. So we haven't independently verified or have had any comment on the companies from this itself. But I'm sure our team has been reaching out to both these companies itself.
Yes, absolutely. And I was just reading that the company had received the certificate of registration from the IRDA all the way back on the 2nd of May 2001. So that's how long, this JV has probably been in existence. So that's big news, actually, which is coming in. And let's see. News, so there's no confirmation as of now.
There's no confirmation. We'll just get a little more in terms of details from that. But let's go back to the way the markets have behaved right now. At the low point of trade for the frontline indices, both the Nifty as well as the Nifty Bank and the mid-cap index, it's important to track where the Nifty goes from here, largely because Friday's low was just under 24,570. From there, it saw a bit of a bounce back, but now the 100-day moving average on the Nifty is 24,526. Can we hold around these levels or not is the big question. And the answer to that will be in where the Nifty Bank goes, because, the Nifty Bank has broken below its 50-day moving average, and now it's close to its 100-day moving average of 51,435, a mark that it crossed both, 50 and 100-day moving average on Friday itself. Active Nifty options, we've seen writers at the 24,700 call, writers at the 24,800 call, telling you upwards of 24,800 to 24,900. There would be some congestion for the Nifty itself, though they are pinning on support coming in around that 24,500 mark itself, which coincides with the 50-day moving average or the 100-day moving average on the Nifty itself. It is a Tuesday, Fin Nifty weekly options expiry. We have the 24,000 call extremely active and the 23,800 put, a level where we are on the Nifty Financial Services Index, which is equally active as well. So if there is a bounce which is likely in the market, it has to be from current levels, else there would be further lower levels that the indices would be seeking. Take a short break, come back. On the other side, we get you more on the markets and stock specific action.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com. CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats.
Welcome back. Well, definitely a bad day actually for the mid-caps, and we're just about trending lower. We have the mid-cap index, which is down around 1.8%. Lot of stocks under pressure on account of earnings. So Paytm is down around 6% at this point in time. Do watch out for that. But on the upside, what is managing to hold up in what is a weak market is Dr. Lal's Path Labs. It comes out with its numbers tomorrow. So that stock is holding with a gain of around 1% at this point. And in fact, a couple of others such as, Unichem Labs as well as Avenue Supermarts, that came out with numbers. But nonetheless, all of these stocks are managing to hold their head above the water. In fact, Unichem Labs is showing a good uptake of around 12.5%. So maybe there's something brewing that one needs to probably watch out for. But overall, it's definitely the texture of the market is just about becoming worse when you talk about the advanced decline ratio. It currently stands at around 1:5 on the Bombay Stock Exchange and 1:9 on the declining side on the National Stock Exchange. We'll take a short break. Be back with commodities. Stay tuned.
And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Why did Korean car maker Hyundai select Shah Rukh Khan as its brand ambassador? Well, to know that, you have to go back 26 years. It was 1997 and it had just been a few months since Hyundai had set up shop in India. At that time, the other Korean car maker, Daewoo, was having trouble in the India market as the parent company had gone bankrupt and that had hurt the image of Korean brands in the country. As Daewoo was getting ready to shut shop, Hyundai was just warming up to take off with the Santro. But how? No one knew Hyundai in India. The market was dominated by the likes of Maruti, Honda, Toyotas, Tata and Mahindras. In fact, when you said Hyundai, the other person thought you were mispronouncing Honda. The company hired advertising firm Saatchi & Saatchi for brand building. When the choice came for a brand ambassador, it is rumored that one celebrity who was in consideration was Jackie Shroff. Yes, our very own Jaggu Dada. The other name that came up was that of Shah Rukh Khan, who had super hits like Dilwale Dulhaniya Le Jayenge and Dil To Pagal Hai in his name. The company received feedback that he was the star of tomorrow, an unconventional hero, someone who appealed to the young India big time. So if Shah Rukh was the star of tomorrow, then Santro was the car of tomorrow.
इस दुनिया में बस हम दो हैं, दुनिया जिनकी दीवानी है.
With that, the Hyundai team started looking for contacts to reach Shah Rukh. It was actually one of the company's dealers.
Welcome back, and joining us on the show now is Atul Chaturvedi. He's Executive Chairman at Sri Renuka Sugars. Chaturvedi, hi, thank you so much for joining us. And to sugar first, and the crushing season in UP starts from first week of November. It would be by mid-November when we see Maharashtra and Karnataka get to it. What's your sense, initial calculations on what kind of crop are we looking at? Does this delayed crushing impact in any sense?
No, definitely. Second question first. In fact, the more we delay the crushing, the better would be the recovery. The sugar recovery will definitely improve much better. And as far as the crop is concerned, I think crop this year has been pretty good, whether it be UP, whether it be Maharashtra or Karnataka. So I would not be surprised if we probably have a crop which is in excess of what it was last year. So till now, I was talking to our cane guys yesterday, and they seem to be very, very gung-ho, and they were quite positive that this year our crushing numbers are likely to be much higher than what they were last year. So the rain gods have been Indian for a change, and we've had very good rains, right? And the spatial distribution also has been very good as far as sugar is concerned. So all the fears of the sugar numbers coming down, now I think that's all history. So we should have another good crop. Yeah.
Okay. Mr. Chaturvedi, how would you look at the year gone by? And we do understand that it has had its shares of up and down. Couple of things that the industry has been asking for. All of last year has been increase in sugar minimum selling price, revision in ethanol price. That is yet to come. What's your sense on when we could see that coming in? And what's your sense now in the year coming by?
Last year was a very topsy-turvy year. In fact, in December of 2023, when the government banned the cane juice ethanol and B-heavy ethanol, it came as a bolt from the blue for the industry. And the government's calculation was that the sugar production in the country is going to be suffering big time, and with the elections around the corner, they were worried on the inflation aspect. But nothing of the sort happened. And the crop last year was also pretty good. In fact, they probably discounted the late rains which happened in October and November. So we ended up having a sucrose production of close to about 34.5 and about 32 million tons as sugar. The net result of that is that now you are saddled with more than 8.5 million tons of sugar as the opening stock. And this is what has kept the sugar prices under a lid. In fact, I go to the extent of saying that sugar in India has been totally inflation-proof. So the other point as far as ethanol is concerned, so we've been asking the government that you need to jack up the ethanol prices. There's no reason why you should be buying maize ethanol at 72 rupees and making sugar suffer, and buying sugar ethanol at 65 and be heavy at 60. So I think the government has already lifted the ban, and the allocations for the next year have also been announced. But what is still expected is that the rate revision needs to be announced ASAP. Otherwise, it doesn't make sense, because FRP for the next year has already been jacked up by about 250 rupees a ton. So that doesn't work. Yeah, so I think the government needs to come up with this. Yep.
Another thing that, Ms. Chaturvedi, that the industry will look forward to next year perhaps would be the Sugar Control Act. The draft is something that we've all seen. We do understand that you as industry have given up representations as well. What on this can be anticipated now for the year to come?
As it is, sugar as an industry is very, very, very heavily regulated. So honestly speaking, I see no reason why they need to increase the regulation. There's nothing in the sugar industry which is not regulated. So by just adding something more into it, to me, it doesn't make sense. And as it is, we are talking in terms of ease of doing business, and this is contrary to what the government has been saying, that we would be insisting. So I hope this remains only as a draft and it doesn't come into being, because industry has represented quite a lot against many of the provisions which are being likely to be introduced in this. Yeah.
All right, so that's something that we'll keep an eye on. Mr. Chaturvedi, as always, thank you so much for joining in. Well, that's the view coming in, that the delayed crushing is actually better for the crop going forward, the recovery as well. So that's a positive there. But yes, there's so much that the industry still desires in the year to come. With that, that's all the time that we have on this show. But Business Lunch will take all the action ahead.
Rang up Saeed Mirza to arrange a meeting with SRK. King Khan needed some convincing according to sources and finally agreed. According to the company's former president BVR Subbu, the first agreement was typed out by Shah Rukh on his own computer with Hyundai officials in front of him at his residence. In 1998, Hyundai launched the Santro in India with Shah Rukh on the cover. The same year, SRK released Kuch Kuch Hota Hai. After that, there was no looking back. Shah Rukh stood by Hyundai and Hyundai stood by Shah Rukh for the next 26 years. He even agreed to shoot a commercial for the Santro Zing in 2002 despite being in extreme pain due to a back problem. SRK has launched all of Hyundai's marquee cars, including the Creta and the new Alcazar, a month ago. In fact, Hyundai also honored Shah Rukh by gifting him the 1100th unit of the all-electric premium SUV, the Ioniq 5, in December last year.
Stocks continue to trade with a downward bias, with declines far outpacing advances. All sectoral indices slip into the red while pain worsens in the broader market. Adani Group's Ambuja Cement is set to acquire 46.8% in Orient Cement from promoters and other stakeholders at an equity valuation of rupees 8,100 crores. The deal triggers an open offer to the shareholders of Orient Cement and sparks speculation over more M&A in the sector. Hyundai Motor India makes history by debuting on Indian stock exchanges after the country's biggest IPO. But the stock lists at a discount to the offer price as analysts remain divided on the growth prospects. The global CEO is confident of the growth and sees more capital investments in India. SEBI member Ashwini Bhatia says India shouldn't be proud of wearing the crown of the largest F&O volume market in the world. He advises investors to approach equity seriously with an eye on wealth creation, to be wary of SME IPOs, an area the regulator is preparing a discussion paper on. Hello, good afternoon. You're watching Business Lunch on CNBC-TV18 and I'm Vinny Motiwala. Look at the markets, not much of an exciting day because the Nifty as of now is trading at the day's lowest point, down 0.7%, 24,000. Around that 600 mark. 597 is what the Nifty is trading at. When you're looking at it, Sensex 2 is performing in line there and down almost 0.7% in a trade. Other than that, let's look at what we're seeing in terms of top losers today for the Nifty 50. We have M&M, SBI, L&T and Reliance. That's the one which is dragging the Nifty 50 today in terms of the point contribution that comes in. Broader markets, that is underperforming clearly the benchmark indices. So Nifty mid-cap down almost 2%, small cap down 3.25%. So a sharp fall in the broader markets is what we're looking at. PSU banks and Nifty Realty, those are the top sectoral losers today. Clear pressure there. Other than that, some trends that we're seeing is when you look at shipbuilder stocks. So let's pull up something like a Mascow Dock, Garden Reach, or even Cochin Shipyard. That's seeing a very sharp decline in trade as well. Mascow Dock, Garden Reach, all of them down 8% in trade. Railway stocks too under pressure. RVNL. Look at that. That's down almost 4%. We have Railtel under pressure, Jupiter Wagon, Ircon International, other names in the railway space that are under pressure. Earnings impact, City Union Bank and Varun Beverages managed to hold on to some green after numbers, while in the red we have 361 WAM, Paytm, Union Bank, among other names that are seeing some bit of a pressure due to earnings. Let's move on, and we had a debutant on the D Street today, Hyundai Motor. Those shares are under pressure because there was a tepid listing. Now, shares are listed at a discount of almost 1% that you could say to an issue price. Nomura and Macquarie are bullish on the stock, while we have MK that has initiated coverage with a reduced rating, citing lack of major launches and muted outlook. The global CEO said that they are very confident of the growth and sees more capital investments in the Indian market. The company also has many EV launches planned in the pipeline. Listen in.
We believe with the addition of capacity, which is almost, if you see, 30% capacity addition is happening for HMI in the next 3 years. And this is after a gap of more than 10 years. So I think this is a big moment for the growth of HMI going forward. And we believe that, yes, not only in terms of volume, but the strategy of premiumization, the strategy of adding features, and then, meeting the expectation of the customers will help us to really sustain the volume as well as profitability. We believe that we are in a position to really, grow in line with the market in terms of volume and, of course, always in terms of average selling price to continuously go up.
So if you see, okay, let's see, the market penetration is about 2%, yeah, but we are starting and we are putting the more EVs now. And up to year 2030, we are expecting about 5 EV models running in this market. We are expecting about 10%.
Okay, just a bit more in terms of the Hyundai IPO as well, right? Obviously, it was a bit of a muted move that came in from Hyundai today in terms of the listing that we saw. As of now, the stock is, clearly under pressure. We're seeing 4% downtake. It listed at almost 1% downtake. Now it's down 3 to 4%. And this is the largest IPO that we're seeing coming in for the Indian markets. And when you're looking at it, LIC was the biggest one, then came in Hyundai Motors. So yes, keep an eye out on Hyundai Motors. Going forward, we will keep an eye out on that. Let's look at quickly, what we're seeing in terms of the real estate names as well, because there's some clear pressure coming in on the real estate names. Let's pull up something like a macro tech developer that's under pressure. We have even something like an Oberoi Realty. We're keeping an eye out on all those real estate names because Godrej Properties also, let's keep an eye out on that. We'll be reporting its numbers also. So that is something to watch out for. Other than that, I want to talk about Amber Enterprises. Yesterday, we saw the stock up almost 20%. The company is expected to report its numbers today. But today, it's a different story. We have seen that, yesterday, the run-up that we saw today seems like that correction is again coming ahead of its numbers today. The stock as of now is down 12.7%. So there's some bit of a pressure. We'll watch out for what comes out in terms of numbers for this one. But nothing much of an excitement that we're seeing today in the stock price. But let's look at what the broader markets, I want to highlight something in terms of the broader markets as well and where they are headed. So as of now, we're seeing that, the Nifty mid-cap is clearly under pressure. And that is something that we're watching out for because every time we see that underperformance continues and comes into the Nifty mid-cap side. We've seen NBFCs also that today are under pressure. So keep an eye out on that. IT is the only one which was flip-flopping between the red and the green. Not much of an excitement that. But on that note, I think we'll just slip into a very short break. And after the break, we'll bring you what's happening in the world of cements, the cement sector consolidation. That seems like it's continuing because Adani Group's Ambuja Cement is acquired Orient Cement, some percent of stake there. So more details on that after the break. Welcome back. You're watching Business Lunch on CNBC TV18. And like we promised, we do have Nigel joining with us to tell us what's happening in the cement sector. Consolidation that is continuing in the cement space. And Adani Group owned Ambuja Cement has acquired 46.8% stake in Orient Cement. Nigel, what does this mean for Ambuja Cement as well as Orient Cement? What are we seeing in terms of valuation here as well?
Well, another big cement deal has been announced. Ambuja Cement is set to acquire close to 47% stake in Orient Cement. The sellers include the current promoter as well as some public shareholders. Now, this acquisition triggers an open offer. That's for around 26% from the public shareholders. The transaction is done at around 8,100 crores at a price of around 395 rupees per share. And Ambuja says the transaction will be fully funded via internal accruals. The deal is done at a valuation of roughly around $114 per ton. Remember, Orient Cement is also virtually debt-free. But the big question is, how does it help the acquirer, that's Ambuja Cement? Well, it increases their pan-India market share by close to around 2% as they add 8.5 million tons of operational capacity and also 8.1 million tons of ready-to-execute projects as well. In addition to this, they also get access to high-quality limestone mines in Rajasthan, and that can support an additional 6 million tons of capacity in North India. They also get access to Orient Cement's waste heat recovery system, the renewable energy capacity as well, and that's what will help in cost savings. Now, Ambuja Cement consolidated capacity has scaled up rapidly from around 68 million tons at the time of the takeover, with big acquisitions like Sanghi, Penna, and now Orient Cement, all of them getting added to the kitty. And now Adani Cement's consolidated capacity has moved to around 97.5 million tons in this month, and it will gradually move to around 100 million tons by the end of this fiscal. Ambuja Cement has laid out the guidance for Orient Cement. They aim to achieve EBITDA per ton of around 1,500 rupees per ton. That's by FY28. They're also targeting 15% ROCE. Well, to wind things down, how does it place and how does it work out for the industry as well as both the parties? It's a win-win-win for all stakeholders. Why do I say that? Ambuja Cements, well, they expand towards their goal of around 140 million tons, so they gradually move towards that. Orient Cement has been struggling to scale up in terms of volumes and profitability, so they get a stronger promoter. And for the industry on the whole, well, consolidation, it works better when you have a fewer number of players with larger capacity. So I say it's a win-win-win for all the parties.
Thank you so much for that, Nigel. A win-win-win for all the parties, keeping an eye out on that. But speaking at the Morningstar conference today, we had the SEBI whole-time member, Ashwini Bhatia, who raised concerns over the frenzy in the FNO space and said that FNO cannot be a national pastime. He also commented about the progress being made with regards to the regulation in the SME IPO space. So listen in to what he had to say.
India accounts for the largest volume of F&O globally. We are number one, and globally also more than 50% of the F&O volume happens in India. This is a crown we do not wish to wear. F&O cannot be and should not be a national pastime, which actually means that savings of retail participants move into the pockets of institutional hands. So just look at the numbers we have told you. 3 years, 1,80,000 crores, and it has been losses for 93% of the investors. 1% make 99%. So your odds are terrible. But the surprising part from SEBI angle is this. The moment we came out with the latest regulation, which kick in sometime in November, investors are protesting that, lot size 5 से 15 क्यों कर दिया? Investors are protesting कि आपने सिर्फ एक ही expiry हफ्ते में क्यों कर दी? Investors are also protesting upfront क्यों कर रहे हो, margining and so on and so forth. But finally, this is becoming systemic. As I said, this F&O cannot be a national pastime. you need to do serious investing. We want India to be prosperous. Wealth is being created very, very fast, and I think investors should participate in the wealth creation that is happening in the country. SME listings are closely monitored by exchanges and SEBI to ensure they don't engage in irrational exuberance, price manipulation, or fraudulent trade practices. We are working on a discussion paper on SME IPOs that should be coming out soon. But what we have seen is pretty disturbing. The way retail participation is happening, the number of times IPO issues are oversubscribed, the way market making happens, the way underwriting happens, and obviously we don't feel very comfortable about what's going on.
Okay, a small programming note as we slip into a short break. As we prepare to ring in the festivities this Diwali, tune into CNBC TV18's Market Movers Forum 3 p.m. onwards on 24th of October, featuring guests like Ramdev Agarwal, S. Naren, Nilesh Shah and others to help your portfolio prosper this Diwali. Welcome back. You're watching Business Lunch on CNBC TV18, and like you can see the flashes at your bottom of the screen, Alliance has indicated that they want to actively consider, getting out of the JV that they had with Bajaj and exiting from the JV. This is the word that's coming in from Bajaj Finserv. We will be keeping an eye out on more updates on this front, but as of now, this is what is the indication coming in, that Alliance has indicated that they are actively considering exiting the JV. And this is a decade-old JV that we're keeping an eye out on. As of now, Bajaj Finserv a bit under pressure, down 1%, but that's the market trend that we're seeing. But let's move on, and the Indian market has seen a spat of FIIs selling this month, who have withdrawn $10 billion from India in October itself. The month of October is now also to track to see the record monthly FII selling numbers. My colleague Prashant caught up and got in touch with Manish Chokhani to discuss the impact of the selling by FIIs and the slowdown that one is seeing in consumption, the effects of India's K-shaped recovery, and more. Listen to a slice of that conversation.
A bit like 2008, except the base is very different. Much larger. We're 3.5 times of that time. And also the fact that there's a lot of domestic money, otherwise this would have been a deeper correction. Yeah. But having said that, foreigners own 15-16% of India. So it's about $800 billion at least of stock which they have. So they've sold 10 billion. It's like poor chaps have traded 1% of what they hold. We shouldn't be grudging them that. In the context, in the last 6 months alone, we've raised $30 billion in our markets, of which 15 has come from companies raising it for building new capacities or whatever. Right. But 15 has actually been promoter and private equity selling. So if this sort of selling can get absorbed, it creates confidence that this is actually a two-way street. I'm not trapped like I'm in China or in Africa. The expansionist tendencies in businesses are going to come out of Asia now, largely, or maybe the Middle East. So the Middle East money, I think, is still coming with the sovereign funds and so on. But unfortunately, the Asians, and especially the Japanese, have still not come in big force. Portfolio flows from the West, FDI from Asia and Middle East. I think there will be significant money coming from there.
Okay, let's move on. And Prime Minister Narendra Modi today begins his two-day visit to Russia, where he will attend the BRICS summit in Kazan. This will be the first summit following the expansion of the group last year. The development of Global South reforms in the multilateral organizations like the UN, climate change and economic cooperation are expected to be on the agenda. PM Modi will also hold bilateral talks with Russian President Vladimir Putin and leaders from other BRIC countries. Moving on to some domestic news and news from Bengaluru, where heavy overnight rains has led to waterlogging in several low-lying areas. The weather department has also forecasted showers for Tuesday. As a precautionary measure, the Bengaluru Municipal Corporation has asked schools to remain shut. Meanwhile, the Karnataka government has assured it will provide compensation for losses caused by the heavy rainfall. Okay, and let's move on. And as we slip into a break, the biggest market experts will be joining us in CNBC TV18 studios. And this year, we are giving you a chance to meet your favorite market experts. 5 super fans will get a chance to visit CNBC TV18 studios on Thursday to interact with the biggest market experts. Write to us on our social media handles, tagging #25 years of CNBC TV18 to take your chance to meet the CNBC TV18 Market Movers Forum at 3 p.m. this Thursday.
Well, from a sector point of view, I think the challenge always was the FDI restrictions, as rightly mentioned by Shireen. I think what is important is there is some amount of clarity insofar as the regulations are concerned. I think that's one thing which is behind our back because that was also a concern. Multi-brand, single brand, I think what can do, who can do, all that is sorted. And I think the sector overall has been growing pretty well. So if you look at FY23, our e-commerce sector was actually valued at almost $80 billion. So there's been an increased amount of growth.
Indian aviation companies today and the regulator and the government is dealing with. In the last 4 days, we've had a situation of 20 plus hoax threats, bomb threats, which have not turned out to be, fortunately, true. But you've had them disrupt airline schedules, you've had them disrupt customer, travel plans, and it's a huge economic cost to an airline as well. Now, how do you deal with this at BA? I mean, how often is this an issue for you?
I think we've well-established protocols, not just at BA, but internationally with airports to deal with these kind of threats. And there is a kind of an assessment you do to understand whether it's a threat that, leads to the grounding of an aircraft or whether it's not something that's credible. I can't really comment on Air India's situation other than I think, airlines have to take the appropriate action that they feel is the right thing to do, and I would support whatever decision they take.
But is the threat assessment done at the airline level, or is it done in conjunction with the regulator as well as the
airport
security
and the airline
agencies?
and the security agencies will be, very much involved. And we use all of the assets that are at our disposal to make the assessments.
And is there an escalation that you've seen in this sort of a threat?
I haven't seen something on this scale in quite a while, but I couldn't really comment on the specific issues here because I'm not close to it. But other than we've well-established protocols that we enact to make sure that, we stay safe.
Online shopping is easy, fun, and can even be addictive, but it comes with its hidden traps. Who isn't familiar with messages or notifications urging to buy something we were not even looking for, or that we may have missed out on a limited time offer? These are what the Consumer Affairs Ministry calls dark patterns. It refers to user interface practices that can be deceptive and misleading. And almost every e-commerce platform uses these dark patterns, from your e-pharmacies to online marketplaces to food delivery apps.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Well, what a day, right? Today, we are seeing a second consecutive day of fall, and especially in the mid-cap side of things, 1,000-point cut yet again. The advance decline ratio absolutely in favor of the advances. On the NSE, it's 1:10. So that's the kind of cut that we are seeing right now. All the sectoral indices, they are reeling with cuts right now. Nifty is below that 24,600 mark. Does not look so good, at least for the broader markets.
Well, the screen doesn't look good at all. And like you mentioned, 1:10 is the kind of advance decline ratio that we're actually dealing with. So it's a very negative market. On the top of your screen, you can see how all of the indices are bleeding. And if you add the small cap index there, that too is down by over 3% in an intraday session. But quite a lot lined up on the show. Let's start off with the top headlines. Stocks continue to trade with a downward bias, with declines far outpacing advances. All sectoral indices slip into the red, while the pain worsens in the broader market.
Hyundai Motor India makes history by debuting on Indian stock exchanges after the country's biggest IPO. For the stock list is a discount to the offer price as analysts remain divided on its growth prospects. The global CEO is confident of growth and sees more capital investments in India.
Private sector lender City Union Bank surges over 13% after reporting its Q2 numbers. Asset quality improves while net interest margins widen sequentially. Management tells CNBC-TV18 that secured MSME, gold and agri will contribute to loan growth going forward.
Adani Group's Ambuja Cement is set to acquire 46.8% in Orient Cement from promoters and other stakeholders at an equity valuation of 8,100 crore rupees. The deal triggers an open offer to the shareholders of Orient Cement and sparks speculation over more M&A in the sector.
Bharat Enterprises slips over 12% ahead of its results. Stocks cools off after rallying 20% on Monday. Street expects revenue and EBITDA to surge over 30% in Q2.
All right, so we have spoken about how the markets are doing right now, but as we've been talking about the big mid-cap space and the fall that we've seen there, so let's go across to Hormaz now. He's taking us through the fall in mid-caps from the high made on September 24th this year. Hormaz, is that a long list?
It is a long list indeed, but you know, a 7% fall from the record high would not be concerning in a usual market. But for those who are used to waking up and seeing broader markets make new highs every single day, a fall like this would definitely set alarm bells ringing. And for the mid-cap index now, it's down 7% from the peak that it made on the 24th of September. And since then, only 20 mid-cap index constituents have delivered positive returns and 80 of them have delivered negative returns. And if you break those 80 down as well, the losses are not anywhere between 2 to 5%. Look at this, 11 stocks have loss of more than 15%, 24 of them between 10 to 15%, and 29 of them have seen losses of between 5 to 10%. Shows you the kind of fall that you had. Now let's look at the top losers since the 24th of September, and you'll have the usual suspects, the high beta names, Vodafone Idea, Cochin Shipyard, Suzlon. As fast as they've gone up, they've corrected equally fast as well. Bank of Maharashtra forms in this list as well, but the list doesn't end here. There are another set of underperformers like L&T Finance, MRPL, HUDCO. All of them have corrected anywhere between 15 to 20%. But if you look at the broader picture and take these underperformers from their own respective highs, the picture is even grimmer. Look at Vodafone Idea, down 56% from the peak that it made of around 19 rupees. Cochin Shipyard made a record high in the month of July. It has already halved in the next 3 months. MRPL, HUDCO also made a high very recently. It's down 44%. RVNL, the high-flying PSU2, is down 32% from its record high. Does not look good right now for the mid-cap index. It's down only 7%, but on a stock-specific level, the picture is even more worse.
Okay, all right, Hormaz, thank you so much for getting us that list. So big cuts that we are seeing in the mid-cap space. But for now, we'll take a short break. Management of Supreme Industries will join us next to discuss the Q2 numbers and the way forward. Stay tuned for that.
If I go back to financials is number one. Okay. This whole energy, renewable energy kind of is area number two. The whole hard assets is area number three. And in that, what else have I done recently? Let me think. So I have renewables. I have an airline stock, for example, believe it or not, that there is a, hopefully a revival in that as well. I mean, from an individual investor perspective, there's enough to do. And it's not a market which is going to crash and therefore you say, I want to sit on cash. Next Diwali, if we get double digits from the index, I would be surprised. I think at some point, and there are a lot of stocks. Even remember, we've spoken in the past about EMS. Some EMS stocks are down 40%. And it's not like the story is over there. Some of them are over 100 multiple, some of them are not.
Invest.
Welcome back. Well, as promised, Supreme Industries, which just reported its Q2 earnings. Remember, the company's net profit has declined 15% on a year-on-year basis, while its revenue too has declined. MP Taparia, the Managing Director of Supreme Industries, joins us now. Good afternoon, Mr. Taparia. Thank you so much for joining us. Anyway, we are looking at it, Q2 appears to have been quite a subdued quarter, and also there appears to be a guidance cut that you've taken as far as the full year volumes are concerned. Please take us through, what were the challenges you faced in the quarter gone by?
Challenges to our mind, they are all now behind. In the second quarter, the prices went up in the beginning of the month in PVC. Actually, our main raw material prices went up by 19%, and then by mid-August, it went down by 17%. That happened due to the Red Sea shipping blockage. There was very poor productivity of container movement, and the country depends on 66% on imported PVC, and out of 66%, 80% comes from Asian countries. The freight went up by even $160 per ton. So the local maker and everybody, the prices went up so cheaply for a short time, and then when the freight rate started coming down, the rates have gone down by 17.5%, I told. Secondly, government also reduced their infrastructure spending in first half of this year. Monsoon also was extended in the month of September, and that cumulative effect was that we had 0% volume growth, and because there was huge destocking throughout the value chain of plastic piping system. Now that huge destocking which took place, now they required restocking again. Now things are stable. The infrastructure spending also improved. The pricing of the raw material are at a low level, and we maintain they may either remain the same level or may slightly go up. So we anticipate good business coming in the remaining second half of this year. So overall, that's why we are required to reduce our guidance, which we gave earlier of 25%, that this year we may grow between 16 to 18% in plastic piping division and 14 to 15% overall company.
Okay, 14 to 15% overall growth is what you're expecting for the company, and in the plastic piping business, it'll be around 16 to 18%. That's the revised volume growth. Mr. Taparia, you spoke about how freight rates impacted the business in first half. While other things have improved, maybe the infra spending by the government has improved, monsoons normalized. Are you seeing improvement in freight rates as well? Because that continues to be an issue. How much of your export, how much does export contribute to revenues?
Our export is very minimal. We export below 3% of our turnover.
Okay, so is it the imports which is being impacted because of freight rates?
Import was affected because country on PVC raw material, country depend on country depend on 66% import, because country consumes 4.5 million ton, 1.4 million ton local production, 3.1 million ton imported. And out of that import, more than 80% come from Asian countries. And Asian countries, the container quantity was so low, the freight has gone up from $30 to $200 per ton.
Okay. Mr. Taparia, two-part question. Q1, volume growth of 17%. Q2, volume growth has stayed flat. Now, even with the revised guidance, Q3 and Q4 actually are asking for quite an implied steep ask rate as far as, year-on-year growth is concerned. So will you be able to meet that? Are you seeing enough demand on ground? And the second question is, earlier you had given an EBITDA margin guidance in the range of 15 to 15.5%. With rising input costs, will you be able to meet that particular margin guidance?
No, first I talked to you about the volume growth potential. Normally, second half, every year grows much better than first half. First half, the month of July, August, September, demand remained weak due to monsoon. Second half, after crops are harvested and the business season is fully in swing, so business always remains better than compared to first half. This year, the added factor will be that there is huge destocking took place, which will give bigger boost in the second half compared to first half. So we are very confident that whatever volume growth we have planned, we will achieve without any trouble. We have got capacity in place, and the raw material position also we are very well covered, so there is no issue. On the operating margin, we aim that we will earn this year also between 14.5% to 15.25%.
Okay.
And overall
14.5%.
14.5%
Yes, sir, go ahead.
to 15.25%.
Okay. 14.5 to 15.5% is the margin guidance that you have for FY25. Mr. Tapadia, last question before we let you go. What is the kind of capex that you have planned? Now, it's not only plastic piping business, you have forayed into different segments as well. Is the peak capex over? Will you be putting in more in terms of capex? And what are the plans of funding it as well?
We had a plan to have a commitment, including carry forward commitment of 1,500 crore this year. Our CapEx plan is going very smoothly. In the current year, we are going to make cash payment of around 1,000 crore. In first half, we already paid 427 crore, and the CapEx plan is all going to be met by our internal accrual. No debt. We got our own money in our account, and we'll be taking care of all CapEx plan from our own resources.
Mr. Tapadia, thank you so much for joining us. So quickly after declaring the results, we, wish you all the best for a much better second half of the year. Moving on, a small programming note as we slip into a break. As we prepare to ring in the festivities this Diwali, tune into CNBC-TV18 at 3 p.m. on the 29th of October to hear out the biggest of market voices giving their tips on how you can make your portfolio prosper this Diwali.
Typically, the Democrats have been warmongers. It's very, very sad to say, but because they tend to be kind of moralistic that we will go and support this. And the Republicans, which are more conservative and fiscally oriented, like this is why we're spending this money. And Trump just says it in a more blunt manner, that why should I be paying for Europe's war or for Taiwan's war? Let them pay their own bills. So I think if Trump comes, the way the betting markets now seem to be suggesting, you get a lot of these wars wrapping up quickly. There will be some negotiation and settled. But he's also a tariff guy and he wants Make America Great Again. You put tariffs up, it's inflationary. You cut taxes, it's inflationary. It's bad news for bond markets, as you said. It may be great for equities in the short run, but when you get inflation, you get rising rates and you get currencies weakening, which is why the trade this decade I still feel is hard assets and precious metals, gold, silver, uranium and stuff like that.
Welcome back. While it's a lot about the moves on the benchmarks and the headline index, it's a lot about individual stock reactions as well to earnings. So let's get to that. Our research team is joining in to give you a sense of what the results reactions have been like. Abhishek and Mangalam are joining us now. Let's start with Mangalam first up on Varun Beverages. It is trading in the green in an otherwise weak market. How do the numbers look, Mangalam?
Well, the numbers, despite the challenges that were there in the quarter, the numbers don't look very bad. It's a good performance that is coming from Varun Beverages. Why do I say that? Because if you look at it, 24% revenue growth is what the company has reported this time around, 4,800 crores on the top line. The EBITDA has grown by 30%. That means the margins have expanded from 22.8% to 24% as well. And the net profit too, as a result of which has shown a growth of 23%. The key internals, the overall volume growth this time around has been close to around 22% or 267 million cases. But that has also been led by acquisition. So the important number to look at would be organic volumes. International volumes have grown at 7.9%, India volumes at 5.7%. One would say, why is it that the India volumes have moderated? Because remember, this time around, there were heavy rains throughout the quarter. We've heard from, players like Tata Consumer and Dabur also speak about the beverages business not doing particularly well. And in light of that, if a company has grown volumes by 5.7%, it is a positive. What are the key triggers for Varun Beverages going forward? Commissioning of their greenfield plant in Congo, 7,500 crore fundraise via QIP, where they deploy that in terms of growth, an increasing share of revenues coming in from snacks, which is non-beverages business outside of India, and energy drink, which is Sting, which has been the growth driver for the company going forward as well. The only risk, the big risk is competition from Campa, which has been launched at a very disruptive price. We also have competition in the energy drink space. Earlier it was just Sting, and now everyone has launched their 5-10 rupee energy drink packs as well. And finally, increasing consumer preferences towards healthy lifestyle. So reducing sugar or sugary drinks is something we will look at as a macro underlying trend. But given the challenges during this quarter, Varun Beverages has actually gone ahead and done a lot better than what the street was fearing.
Thank you so much for that, Mangalam. No wonder then the stock actually is outperforming in an otherwise weak market. Well, moving on, Jana Small Finance Bank is slipping in trade after reporting its Q2 numbers. Abhishek is here with more details.
Well, stress in the unsecured segment or the rural segment has actually continued to weigh on Jana Small Finance Bank's results. So over the last 2 quarters, that is after Q4 FY24 to about Q2 FY25, if you take a look in absolute value, gross NPA has increased more than 50% for them, and net NPA has increased more than 90% for them. So gross NPA has increased to 755 crore from 494 crore at the end of Q4 FY25, while net NPA has increased to 247 crore versus 130 crore that it was there at the end of Q4 FY24. So in terms of Q4 FY24 to Q2 FY25, deposits have grown a little under 10%, while AUM growth has been just 6.7% in the same period. So in Q2 FY25, their AUM growth was about 17.3% YOY and about 2.7% sequentially. Their net interest margin declined by 30 basis points on a sequential basis, while gross NPA and absolute value increased by almost 17% quarter on quarter. In terms of ratio, gross NPA ratio is now close to 3% versus 2.6% in the previous quarter. And return ratios, if you take a look, that is ROA and ROE, are perhaps the weakest that you are seeing for a lender or small finance bank in Q2 FY25. So ROA is at 1.2% versus 2% in the previous quarter, and ROE is at 10.2% versus 17.6% in the previous quarter. So deterioration in asset quality and weakening of the return ratios has weighed on the stock performance in trade today.
Okay, that is about Jana SFB, a big cut that we are seeing on the stock. The other stock which is declining in trade ahead of its results, that's Amber Enterprises. But do remember, the stock was up 20% yesterday. Upasna is joining us with what to expect from the numbers today. Upasna.
Well, we're expecting a good set of numbers from Amber Enterprises. This time around, we're estimating revenue around 1,200 crores with a 30% growth uptick on a YoY basis, mainly driven by companies' consumer durables and electronics segment. We're estimating EBITDA around 84 crores with an uptick of 41% on a YoY basis, and EBITDA margins around 7% with an uptick of 60 basis points on a year-on-year basis. Now, margin improvement will be driven by mix shift towards components in consumer durable segment, and we are expecting PAT positive around 1 crore versus loss of 6.9 crore on a YoY basis. Now, there are various factors that we'll be closely watching out in the management commentary, such as demand outlook for RACs, outlook on electronic segment growth, margin improvement across the segments, revival in company's railway segment, and also
any commentary on update on export opportunities by the company.
Thanks so much for that, Upasana. It's been a volatile couple of trading sessions as far as Amber is concerned. An upper circuit yesterday and today down almost 10%. Well, moving on, my colleague Prashant Nair spoke to Manish Chokani, the director at Inam Holdings, to get his views on the big FII selling, consumer slowdown, and a lot more. Let's listen in to excerpts from that conversation.
A bit like 2008, except the base is very different. Much larger. We're 3.5 times of that time. And also the fact that there's a lot of domestic money, otherwise this would have been a deeper correction. Yeah. But having said that, foreigners own 15-16% of India. So it's about $800 billion at least of stock which they have. So they've sold 10 billion. It's like poor chaps have traded 1% of what they hold. We shouldn't be grudging them that. In the context, in the last 6 months alone, we've raised $30 billion in our markets. Yeah. Of which 15 has come from companies raising it for building new capacities or whatever. Right. But 15 has actually been promoter and private equity selling. So if this sort of selling can get absorbed, it creates confidence that this is actually a two-way street. I'm not trapped like I'm in China or in Africa. The expansionist tendencies in businesses are going to come out of Asia now, largely, or maybe the Middle East. So the Middle East money, I think, is still coming with the sovereign funds and so on. But unfortunately, the Asians and especially the Japanese have still not come in big force. Portfolio flows from the West, FDI from Asia and Middle East. I think there will be significant money coming from there.
Well, very interesting comments coming there from Manish Chokani. As we take your leave on this edition of Mid-Cap Radar, what we are leaving you with is a very red screen. The mid-cap and the small-cap end of the markets continue to take it on the chin and witnessing intense selling pressure with very weak and muted advanced decline ratio.
If I go back to financials is number one. Okay. This whole energy, renewable energy kind of is area number two. The whole hard assets is area number three. And in that, what else have I done recently? Let me think. So I have renewables. I have an airline stock, for example, believe it or not, that there is a, hopefully a revival in that as well. I mean, from an individual investor perspective, there's enough to do. And it's not a market which is going to crash and therefore you say, I want to sit on cash. Next Diwali, if we get double digits from the index, I would be surprised. I think at some point, and there are a lot of stocks. Even remember, we've spoken in the past about EMS. Some EMS stocks are down 40%. And it's not like the story is over there. Some of them are over 100 multiple. Some of them are not. typically the Democrats have been warmongers. It's very, very sad to say, but because they tend to be kind of moralistic that we will go and support this. And the Republicans, which are more conservative and fiscally oriented, like the...
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. And today on the show, we'll be focusing on the contribution of B30 cities specifically, and also talk about the T30 cities to mutual fund investments. B30 is beyond 30 and T30 is the top 30 cities. We'll discuss the growth in MF investments in the smaller cities, and also the steps needed to ensure that more attention is given by these geographies to mutual fund investments. Joining us today on the show is Sanchita Mukherjee of Talk the Walk and Kalpesh Asher of Full Circle Financial Planners and Advisors. Sanchita and Kalpesh, good afternoon. Thank you so much for joining in. And we have steadily been talking about that rising SIP number, rising AUM as well. So it's good to understand how does it differ in smaller cities versus the metros as well. So, lady, let me start with you first up. Can you explain for understanding purposes what are B30 and T30 cities when it comes to mutual fund classification?
Thank you so much, Sonal, for having me on your show. It's always a pleasure. And the classification of T30 and B30 is very unique and it's very required because essentially T30 means top 30 cities as per their allocation in the mutual fund investments, their penetration in the mutual fund industry. So that's the top 30 cities, which would typically mean your metros, your Delhi, Mumbai, Kolkata, Bangalore, Chennai, all of that. And the B30s would significantly mean beyond the T30s, which is beyond the top 30 cities as per their participation in the mutual fund industry. So this would mean 31 cities onwards would be the B30. Typically, again, your tier 2, tier 3 cities, wherein right now the industry is actually looking at these cities with a very interesting lens because that's where the rapid growth and the penetration is actually happening. So that is the B30 cities.
Okay, all right. So that's how SEBI classifies that. And now that it is out of the way, Kalpesh, let me come to you. Because as I said, we've been talking about mutual fund AUM that has been steadily increasing. How much do the smaller cities contribute to this? Are these cities big on mutual fund investing or is it some other asset class?
No, so actually, this is a very interesting point because the penetration of mutual funds has been more in the B30 part now. Because T30 is more or less, we know it's the established one and the real, I would say the cream or the real numbers come in when I think the B30 joins the party. So if you just see some number crunching, Sonal, we have that, 19% of the assets of the mutual fund industry came from B30 locations in September 24, and that's not a small number. And that talks a lot about how the mutual fund, I would say the syndrome or the concept of mutual funds has been lapped up by everyone. Second is that, the assets from the B30 locations have increased in 1 month from 12.16 to 12.59 lakh crore. So that itself is another, I would say, a step up going in the right direction. And it also talks about that people are not panicking in spite of the markets now, what we are seeing being volatile. In fact, August and September were all-time high, which we were seeing. And obviously, the cream or the attraction is in the equity-based mutual funds. So investors in that thing are in the B30 part are preferring the mutual fund, equity-based mutual fund schemes. So that is the numerical part. The other part which I would like to mention here is that assets from B30 have increased from 8.838 lakh crore in September 23 to 12.59 lakh crore in August 24, which is almost a year. And that is almost a rise of 50%. So we have a lot of, I think, things to look forward to. And B30 is making its presence felt.
It is definitely that 50% increase in assets itself is a testimony of how much interest we are seeing in mutual fund investments from the smaller cities. Sanchita, comment on this. What's your take? How are we seeing this increase in contribution coming in from smaller cities?
Oh, absolutely. I completely wholeheartedly agree with what Kalpesh just mentioned, and the figures are there for all of us to see and observe. The growth in the B30 cities has been very, very rapid. primarily because of many factors. One would be the increasing financial awareness and literacy campaigns, the advertisements by AMFI, Mutual Fund Sahi Hai, the whole focus on SIPs, the systematic investment plan, which is small regular investments into mutual funds. These have actually made quite a contribution. Also, the fact remains that B30 cities started off with a smaller base, right? So from previous years, the number of actual investors in B30 cities were small. So any incremental jump in AUM or investors actually is a very strong double-digit growth number, right? Whereas in T30 cities, what typically happens is because the market is quite saturated with savvy investors who also invest beyond mutual fund investments. They invest into direct stocks, real estate, gold, AIF, PMS, all of that. So there, this penetration in mutual funds incrementally is much lesser through SIPs and all because they're already there. The base level is quite high. So in B30 cities, also what remains to be seen is that there is a lot of digital penetration happening, especially in the age group of 25 to 40 years, who actually like the accessibility on digital platforms. And they are looking at many long-term objectives in terms of financial objectives like wealth creation, retirement, children's education. So typically what we are seeing that the AUM, even in the B30 cities, tend to be a little more longish with these kind of objectives in place. And given these objectives are there and the financial awareness has been spread by our regulators and apex bodies and by the industry, a lot of investors in B30 cities are actively participating now in this SIP journey.
That's right. And as you said, it's the digital medium which has definitely sparked the rally, or I would say sparked the interest that we've been seeing in this space. So Kalpesh, between the two, you spoke about how assets have grown in the B30 category, right? Where is AUM growth higher? Is it the B30 segment or the T30 segment?
No, so obviously on a percentage basis, Sonal, it's on the B30 cities. The ascendancy has been in the B30 cities. And even if you see that in September 2024 figures, almost 27% of the assets held by individual investors were from the B30 locations. So that's obviously a given that B30 is on the rise compared to T30. You can't take away what T30 contributes to the entire mutual fund space. But the rise and the rapidity which it is growing, B30 takes the cake. And here, if you see that, the share of the AUM which comes, it's just a bigger crunching, which we're doing again once here, that the share of AUM from locations outside the top 15 cities has increased from 29% to 35% in 3 years, which is quite a substantial rise. And on the contrary side, if you see that the two main cities of India, which is Mumbai and Delhi, the overall AUM has fallen between, almost from 46% to 40% during the same period. So you can see where the, the focus is or where the rise is coming from. And B30, again, I'd like to reiterate that there's nothing wrong with equity, forming the fulcrum of the investments here. But I think surely as awareness spreads, they will also be looking at other aspects of, the mutual fund space, which is the fixed income space, or investing in gold and all those things. So answering that question, B30 is surely a little bit step up than T30 right now.
No, of course, and it's just a start, right? So the start has been positive. So once they get used to the equity investment part, they can look at other asset classes as well to diversify their portfolio. Sanchita, now that we've spoken about the investment trends that are prevailing in these two segments, the B30 and T30, how do commissions work for distributors in both the cities? Do they differ or are they largely similar?
Yes, they do differ. In terms of our regulators also keen on increasing the footprints in the smaller, in the tier 2, tier 3 cities. So when we talk about commissions, it actually comes from a term known as TER, which is the total expense ratio. And in the total expense ratio, the cost which is incurred through the mutual fund house, a portion of it is actually given out to distributors in the form of commissions. So in B30 cities, the TER is allowed to be 0.3 higher than the T30 cities, and the additional cost is then given out to distributors and agents and MFDs so that they can increase the penetration in these cities and incentivized, and they're more charged up, more incentivized to add on to clients in tier 2, tier 3 cities.
Okay, all right. So this is how commissions also differ to ensure that there is more interest, at least, in expanding those products in the B30 cities. It's a very, very interesting discussion. We do have a lot more questions, but we have to get into a quick commercial break. On the other side, we'll continue our discussion with Sanchita Mukherjee and Kalpesh Asher on the contribution of the smaller cities to mutual fund investments. Stay tuned for that.
This money. And Trump just says it in a more blunt manner that why should I be paying for Europe's war or for Taiwan's war? Let them pay their own bills. So I think if Trump comes, the way the betting markets now seem to be suggesting, you get a lot of these wars wrapping up quickly. There will be some negotiation and settled. But he's also a tariff guy and he wants Make America Great Again. You put tariffs up, it's inflationary. You cut taxes, it's inflationary. It's bad news for bond markets, as you said. It may be great for equities in the short run, but when you get inflation, you get rising rates and you get currencies weakening, which is why the trade this decade I still feel is hard assets and precious metals, gold, silver, uranium and stuff like that.
Welcome back. You're still tuned into MF Corner. We still have with us Sanchita Mukherjee and Kalpesh Asher. We are discussing everything about how there's been a rise of mutual fund investments by smaller cities, also known as the B30 cities. What's the contribution that they're making in mutual fund investments? Sanchita, let me start with you. I wanted to understand that, yes, we've seen a growth. Kalpesh also mentioned how assets have grown by 50% in last 1 year. But are more measures, steps needed to ensure more attention by smaller cities in mutual fund investments, or the current steps taken by SEBI or the industry are enough? And how does it compare versus previous years? How have we seen it change, say, over a longer period frame?
That's a very valid question. And yes, definitely, there's been several key measures which have happened over these years by mutual fund industry participants and SEBI in terms of allocating higher commissions for increased penetration, increasing investor awareness and launch programs, workshops across tier 2, tier 3 cities, increasing the number of digital accessibility, the fintech platforms, also going in line with investor awareness, making them understand the validity of the SIP through AMFI ad campaigns like Mutual Fund Sahi Hai, understanding that, you can make small regular investments into mutual funds and create certain objectives for yourself, such as retirement planning, such as children's education and all of that. And yes, last but not the least, in terms of reaching out to the younger population, again, through various platforms, increased internet penetration and all of that. However, having said that, challenges do remain because the number of distributors who are there, who are also distributing other products which are not typically mutual fund products, understanding of equity as an asset class is still very limited in B30 cities and amongst the investor base. There is a little bit of a mistrust or trust when it comes to really understanding long-term equity investing and how to go about it would be another key challenge. Internet penetration and the digital infrastructure which is required for a greater penetration. And also last but not the least, what Kalpesh just mentioned, possibly designing products, which are not always equity oriented, but for more conservative investors, debt oriented, hybrids can be certain measures that can now be taken for increased penetration to B30 cities.
Okay, so take that point. As you said, there's one distributor maybe distributing or selling a lot of products. That does take away the expertise that we have been talking about. And I think the regulator has also spoken about it in greater detail. Kalpesh, come in on this. What's your take? Are the current steps enough or do you think more needs to be done?
Yeah, so I think it was well covered by Sanchita, but I would like to add 3 more points here, Sonal. First and foremost here is that the regulator SEBI also is on the verge of introducing a lovely concept, which is the sachetization of the SIP. And they're going down to bare minimum of almost 250 rupees as a minimum investment which a person can make. I think if that opens up, the retail investor in the B30 would be just, very happy to know that it is the small amount which he can even make his presence felt in the equity markets. So that is on the anvil. And if that happens, I think that is a tip of the iceberg. Even the mutual fund SIPs, what we are seeing, the 23,000 crore SIP monthly amount, I think that could go up by leaps and bounds. So that's one. Second is people should understand, in the rural area or in the urban area, that there's a difference between savings and investing. People, we are good savers, but the concept of investing still needs to be inculcated, and that needs to start in our education system itself, from the primary and the secondary level. If, the basic fundamentals of investing are taught to children, I think that will take the entire story on a different level. And last but not least, that all the distributors and all the, investment advisors have to work day in, day out to spread the message. Obviously, digital is the best way to do it, to investment awareness programs, be it digital or physically. Because the more you are in face-to-face with the rural population or the B30 population of India, I think it's better for the equity cult to grow in India.
No, that makes sense because with more awareness, we need to talk about everything. The returns that are possible, but of course the risks as well that could come with any sort of investments for that matter. Kalpesh, are these small city investors contributing or participating via the SIP route or the lump sum route?
No, I think they're doing it more through the SIP route because they know that they have to, first wet their feet into this. They are still not accustomed to the completely equity culture or handing over your money to an AMC. So I think they are more, a little bit careful, circumspect. But SIP is obviously the best way to do it. And the more they are aware of it, they'll be a little bit more, averse to the concept. And then lump sum would follow. Lump sum is happening, no doubt. But right now they're coming out of a culture where they've always been investing in fixed deposits or land or gold. And now to get into this culture, it's better that they take baby steps and they take small steps through the SIP route.
Yes, one step at a time is what they are going with as well. Sanjita, you know, Kalpesh spoke about statutization of SIPs. There have been a lot of conversations. Not everyone has done it, I believe. But do you think would it help if we gave more options on smaller ticket SIPs?
Oh, absolutely. And that would, like you mentioned, that would create a lot of awareness, a lot of interest, a lot of enthusiasm, a lot of participation. Because let's understand, even in the tier 2, tier 3 cities, you know, there are higher disposable incomes. And people are very, very aspirational. They are also looking at participating in this entire India growth story. So statutization of SIPs and in fact, actually reaching out to tier 2, tier 3 cities through regional brochures, regional language, financial awareness campaigns, workshops, access, both digital and physical would actually go a very long way.
All right. So definitely we talk about statutization that would help these smaller cities in terms of investments as well. You know, Kalpesh, ETFs, they are gaining popularity, but still you have to understand that even in T30 cities, we have not seen it so much. But what about small cities? And is there an age group which is looking at this asset class?
No, you're right, absolutely, Sonal, that even ETFs as a concept, leave alone B30, T30 also is not that, great friendliness with ETFs. And the simple reason here is that ETFs require demat accounts. And here we are trying to first inculcate that even mutual funds, people have to be told that you can do it physically, you can do it, offline, and it doesn't mandatorily require demat accounts at all. That myth has to be broken because still many people whom we find, they say, if I want to invest in mutual funds, do I require a demat account? No, because the mutual fund thing, if you want to penetrate, it has to be first on a standalone basis. And there are many pros and cons of investing through the demat accounts. So ETFs as a concept is very good, cost saving. We all know it mimics the benchmarks and all those things. But I think better, my personal opinion is that we leave that concept a little bit separate or isolated from the mutual fund story, which we are trying to inculcate into the B30, the B30 cities of India.
Okay. And Sanchita, what is your take? Do you agree with Kalpesh? It should be kept aside from the mutual fund investments, or it can be a part of when someone is looking at saving and then investing that money?
Yes, definitely. So I think a lot of 25 to 40-year-olds, again, the very younger population who are looking at lower cost options within the mutual fund space would like to typically go for ETFs. And they do that through digital infrastructure, through the various fintech and digital platforms which are available. However, having said that, the larger investor base, especially in the B30 cities, I think are very, very relationship based in terms of they like a personal approach. They would like to still take an understanding from a person than go for a low cost transactional advice which comes from a digital platform. So therein, I think mutual fund into diverse products, which is handled by a fund manager wherein they can understand the logic. I think they would be more comfortable because B30 investors are not yet typically that savvy that they would understand the concept of an ETF, which is more like a passive investment.
Okay. So ETFs, you know, again, as we've been pointing out, it's still in that phase where everyone's trying to understand it, even in the T30 cities. So, of course, for it to reach that level in B30 could take some time. But Sanchita and Kalpesh, it was such a pleasure to have both of you on the show today to understand something beyond the metros, right? Because that's where a lot of investments are coming from. And that's really where the investment cult is growing by the day. Thank you so much for joining us today.
Thank you.
Okay, with that, we'll take your leave on the show today. Stay tuned for Closing Bell to take you through the last hour of trade.
A bit like 2008, except the base is very different.
Much larger.
We're 3.5 times of that time. And also the fact that there's a lot of domestic money, otherwise this would have been a deeper correction.
Yeah.
But having said that, foreigners own 15-16% of India. So it's about $800 billion at least. of stock which they have. So they've sold 10 billion. It's like poor chaps have traded 1% of what they hold. We shouldn't be grudging them that. In the context, in the last 6 months alone, we've raised $30 billion in our markets, of which 15 has come from companies raising it for building new capacities or whatever. But 15 has actually been promoter and private equity selling. So this sort of selling can get absorbed. It creates confidence that this is actually a two-way street. I'm not trapped like I'm in China or in Africa.
Why did Korean car maker Hyundai select Shah Rukh Khan as its brand ambassador? Well, to know that, you have to go back 26 years. It was 1997 and it had just been a few months since Hyundai had set up shop in India. At that time, the other Korean car maker, Daewoo, was having trouble in the India market as the parent company had gone bankrupt and that had hurt the image of Korean brands in the country. As Daewoo was getting ready to shut shop, Hyundai was just warming up to take off with the Santro. But how? No one knew Hyundai in India. The market was dominated by the likes of Maruti, Honda, Toyotas, Tata and Mahindras. In fact, when you said Hyundai, the other person thought you were mispronouncing Honda. The company hired advertising firm Saatchi & Saatchi for brand building. When the choice came for a brand ambassador, it is rumored that one celebrity who was in consideration was Jackie Shroff. Yes, our very own Jaggu Dada. The other name that came up was that of Shah Rukh Khan, who had super hits like Dilwale Dulhaniya Le Jayenge and Dil To Pagal Hai in his name. The company received feedback that he was the star of tomorrow, an unconventional hero, someone who appealed to the young India big time. So if Shah Rukh was the star of tomorrow, then Santro was the car of tomorrow.
इस दुनिया में बस हम दो हैं, दुनिया जिनकी दीवानी है.
With that, the Hyundai team started looking for contacts to reach Shah Rukh. It was actually one of the company's dealers in Mumbai who rang up Saeed Mirza to arrange a meeting with SRK. King Khan needed some convincing according to sources and finally agreed. According to the company's former president BVR Subbu, the first agreement was typed out by Shah Rukh on his own computer with Hyundai officials in front of him at his residence. In 1998, Hyundai launched the Santro in India with Shah Rukh on the cover. The same year, SRK released Kuch Kuch Hota Hai. After that, there was no looking back. Shah Rukh stood by Hyundai and Hyundai stood by Shah Rukh for the next 26 years. He even agreed to shoot a commercial for the Santro Zing in 2002 despite being in extreme pain due to a back problem. SRK has launched all of Hyundai's marquee cars including the Creta and the...
The Hang Seng, though, is trading with gains of around 0.5%. The Taiwanese index is down 0.5%.
The last 6 months alone, we've raised $30 billion in our markets.
So on the way up, I mean, the closest is the 40-day exponential moving average, which is 25,092.
News that's come in there. Ambuja Cements will be acquiring Orient Cement.
It's absolutely flat. So 24,760 is where the Nifty is opening at.
Some normalization, quote unquote, in the profitability may be visible.
So yeah, it's ticked up into the green. It's slightly higher.
In the red, but markets are trying to recover from the lows.
More the trust brand in India by implementing some India marketing activities.
We are seeing a second consecutive day of fall, and especially in the mid-cap side of things.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, that's the day so far, and it is a tough day. And Surubi gave you the signal in the morning with the red color.
Didn't think it was that bad, though.
I have to say that the market on the Nifty is, as we speak, just now it's broken below a day before yesterday's low, which is Friday's low, which is 24,567. We are exactly at Friday's low right now. This is, of course, Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues, Surabhi and Nigel. Guys, hi. Good afternoon.
Hi. I'm just looking out to global markets to see sort of the color over there. But I think while some of the regional markets like Japan, etc. were down, what we're seeing on our screens is actually something very, very different. European markets, for the time being, there is some caution, but like 0.25% down, 0.5% down. What we're seeing specifically in the mid-caps today, second day running, there's a story that's playing out there for sure.
When you have one stock advancing for 10 declining, that's telling you the picture, right? And I'll tell you what, where we are placed right now, we'll be very lucky to get away with this sort of a cut, you know. So if the markets had to bounce all through the day, all those bounces have got sold into. But we need to bounce. We need to bounce from here. Otherwise, it's going to be not such a great close for today's trading session. So let's see how that goes. But no real place to hide today. Mid-cap index down 2%. Portfolio is not feeling too good. But I guess for a longer-term investor, some kind of nibbling, some kind of allocation could gradually take place if you're a longer-term investor. In the near term, though, the picture looks quite muddled. Earnings not picking up, FII selling as well, and no big positive cue is what we're seeing.
And, you know, Nigel, typically what happens is that you want to buy, but you're already in. I mean, you know, most people are already invested.
Yeah.
So the margin, unless you created some cash, it becomes very difficult. So, yeah, I mean, if you're sitting on some cash and if you have money to invest, maybe at the margin you start to nibble.
So, you know, the previous time we were at this 24,500. Personally, I put in, you know, SIP. I did a bit of a top-up, very, very marginal. But, you know, that's what I... But this time around, I'm just waiting by for a little bit because not sure where exactly. But otherwise, keep your SIPs going, start nibbling. It's for a longer-term investor, I think so. The easy money has been made.
Absolutely. And, you know, so just a little bit of here and now. You've got absolutely crunching fall in mid-caps and small caps. And, you know, really gut-wrenching because 10:1 declines outnumber advances. And it's been that way for the last many hours now, right? So some 3,000 stocks are down, some 300 stocks are higher. That's the kind of separation between what's down and up. So 2% cut in the mid-cap index, 3% cut in the small-cap index. You know, I wrote this 15 minutes back that Nifty needs to defend 24,567 and it's not being able to, at least right now. We are around that level. Friday's low, 24,570 or so is where we find ourselves at. So we'll see. And of course, for the Nifty Bank, that level is 51,000. Which is, we're not there yet, about 500 points away. The Nifty Bank right now is down about 400 points. So if you want to look at sectors, it's PSU banks, real estate and metals. These are the three areas which are seeing the maximum amount of fall. But it's not really a sectoral kind of play as well. It's not even about results. I mean, the results, there are result reactions both on the upside and down. This is City Union Bank and there is something on the downside. It's more broadly, really under pressure kind of a day. So you got that working as an overlay for pretty much everything, good and bad. Surabhi.
I'm just looking at the stock price sort of decimation on the screen that's going on as we speak. Mazgaon Dock has fallen 9%. You have names like 361 Wealth Management. Now here you can argue that sure, I mean, earnings were a miss, but down 6% over there. Look at Garden Reach down about 9.5%. Amber is down 11%. Gravita. Nigel, I think, spoke to the management earlier on. You guys had them on Chartbusters, right? I mean, the numbers weren't looking that bad or anything. There's 11% decline coming through on Gravita. Jana, again, you can argue that there are asset quality issues on Jana Small Finance Bank. But it's like Prashant said, it's more than earnings today. This is a wider decline at work. And look at the micro cap index, the Nifty micro cap. Look at the Nifty small cap index. They're down about 3.5% each. I don't know, Prashant, I mean, we'll discuss this as we go along. The commentary that came in from Mr. Ashwini Bhatia, the SEBI whole-time member, he was again sounding very cautious on the BSE, you know, SME space, SME IPOs and what's going on over there, talking about F&O and how it can't become a national time pass. But I'm not sure if that has triggered this or whether this has become a bit of a self-fulfilling prophecy because we've had the large cap selling for the last many weeks now. And maybe it's just, you know, eventually mid-caps also start to cave in. Not quite sure.
I think it's the latter because I don't think this is that those comments of...
and that's not new, right?
Not new because look, F&O, the rules are already out. There's nothing new which is on the anvil.
Exactly.
SME, there is something which is coming, which you confirmed. That a discussion paper on... And we are having that discussion at 2:50. We have a guest joining us on that SME issue. And but I don't think that is really causing the fall. It's just a fall. It's not helping the mood. I mean, if you at the margin doesn't help.
But it can't be the cause, exactly.
No, absolutely.
You know, on Gravita, just to cite it as an example, the numbers were actually pretty much okay. There was a small miss on the volume growth front. But the problem is the stock in the last 1 year has more than doubled. So that's why, you just want to take some money off the table. And that said, for someone who's believing that, in fact, there is a longer trend in terms of a recycling trend that will take place, a big shift from unorganized to organized. Case in point, this industry, just to cite an example, more than 70% is unorganized right now. So gradually that industry will move to organized, and then there'll be fewer players out there. So that could be a reason. So from the lows of the day, the stock is actually up close to 8%, from the lows of the day. So someone who is selling is because they're sitting on a lot of profit and there's a mild miss out there, and maybe they want to book some profit. While someone who still has a longer term view from here on, they could have bought that dip today. Just citing an example, just another instance, Strides Pharma for very, very long it disappointed. Then the numbers gradually started coming. Take a look at the stock. I don't think there's any big news flow that's come in there, but take a look at the intraday chart of the stock. Slammed. It was in the green just a short while back. Slam, it's down close to around 4%. So I think some money being taken off the table on some of these liquid names.
I think Prashant picked the pulse very aptly in the morning. And he said that when you could be a long-term investor, you could be believing in the India story, etc. But when you're seeing the value of your investments erode 5%, 10%, and you're holding that Mazgaon, you're holding a Garden Reach or a Gravita, and you're seeing, that value dip on a daily basis, at some point in time, you just throw in a towel and say that, I want to preserve the money that I've made. That's the sentiment and the mood that the market is in. So what do you do now? How do you navigate this sort of a market? Mitesh Thakur is our first guest on the show. Mitesh, floor's open. Levels, what are you tracking? Trades, indices, stocks?
Good afternoon, Surbi. So, been maintaining a very cautious view on the index, saying that the structure has weakened and there's a higher chance of us eventually breaking below 24,750, 800 zone, which appears to be going through. Now, once this level is gone, which was the first important pivot, and this is also the level from where the, where the rally started post the 6th, 7th of September, and then we made a fresh high. So once this level is gone, I think we will now look at lower levels. So 24,350, 370 was my first minimum target, which I think the markets might do very well. Test it in a day or two, and then 24,200, 24,100 is the zone where a couple of weekly supports kick in. So these are the two levels in the downside. But what is more important is that while you can always look at lower targets, the structure being weak means that this will be a market which will see a lot of supply pressure at higher levels, and therefore the texture, and which is what I said about 10 days back also, that the texture has changed from buy on declines to sell on rallies, exit, and wait out for the entire correction to play out. It could be a time-wise correction if we don't break 24,350, 200 zones. Or it could be a price-based correction if we start breaking below that and head towards the 200-day average on the Nifty, which is at about 350, 400 levels. So that is the way we are placed right now. Not trading the index, but on the stock side, looking at slightly more aggressive positions on the short side and less and conservative positions on the buy side, and mostly trying to play through the option route. Having said that, the calls that I have right now, sell on Jindal Steel and Power. I think that's something which is just about to break the 200 average at 917, and the weekly pivot of 920 is already taken care of. So we'll suggest selling once it breaks 914, 913, then keep a stop at about 927 and look for a target of 875 to begin with. And the other one which I have on the list is BEL, which I would recommend selling for targets of around 260 and keep a stop at about 277.5.
Okay, all right. Mitesh, thanks very much for the advice. Right now, we'll come back to you in a bit. Let's also address the big story of the day. Hyundai Motors India. What a day to list, right? Well, the shares have been under pressure. It was a tepid listing as expected. And then you have a market like this with sentiment and mood as sour as it is. Let's go across to Sudarshan to get a roundup of brokerages. Lots of new initiations on the stock as well today. Over to you, Sudarshan.
So after being in India for almost 3 decades, Hyundai India has today made its capital market debut. The stock has listed at a minor discount of 1% to the issue price of rupees 1960 per share. But through the day, in line with market moves, stock has remained under pressure. Brokerages do remain positive on the stock. We have 4 brokerages initiating coverage on stocks, with 3 of them having a positive stance, while 1 finds the stock expensive at current levels. Take a look what they say. First is Nomura. It has a buy call with a target price of rupees 24.72 per share, implying upside of more than 30% from current levels. Even on the earnings front, it expects a healthy growth. It sees margin rising to 14% by FY27 from 13.1% FY24. And earnings CAGR seen at 17% over FY25-27, aided by 8% volume CAGR, which is likely to be driven by new launches. Two main reasons for healthy growth that Nomura has pointed out. First, premiumization and companies' ability to predict consumer trends. Macquarie too has an outperform call with a target price of ₹22.35 per share. Its target price implies PE of 28 times for FY26 and 25 times for FY27. As per Macquarie, Hyundai deserves to trade at a premium versus peers. And the reasons are, first, it has favorable portfolio mix, and second, premium positioning and market share has stabilized or improved from recent lows. Another brokerage that has a buy call is Motilal Oswal with a target price of ₹2345 per share. Motilal expects company to see 17% EPS CAGR over FY25-27, aided by its diverse portfolio mix, which covers 87% of India's passenger vehicle. Also, parent company's inherent strengths can be effectively leveraged by Hyundai India. One brokerage with a negative stance on the stock is MK. It has a reduced call and target is ₹1750 per share, implying downside of nearly 7% from current levels. And three reasons that MK has pointed out are, first, rich valuations, second, muted outlook, and third, higher royalty payment to parent company. On the back of these reasons, MK expects 5% EPS CAGR over FY24-27.
Okay, all right. Sudarshan, thank you very much for the perspective over there. Well, earlier in the day, we did catch up with the top management from Hyundai, both, of course, the global management as well as the India head over here. The global CEO is quite confident of growth and sees more capital investments in India. The company also has many EV launches in the pipeline. Take a look.
We believe with the addition of capacity, which is almost, if you see, 30% capacity addition is happening for HMI in the next 3 years, and this is after a gap of more than 10 years. So I think this is a big moment for the growth of HMI going forward, and we believe that, yes, not only in terms of volume, but this strategy of premiumization, the strategy of adding features, and then, meeting the expectation of the customers will help us to really sustain the volume as well as profitability. We believe that we are in a position to really, grow in line with the market in terms of volume and, of course, always in terms of average selling price to continuously go up.
So if you see, okay, let's see, the market penetration is about 2%, yeah. But we are starting and we are putting the more EVs now. And up to year 2030, we are expecting about 5 EV models running in this market. We are expecting about 10%.
Okay, so that's commentary coming in from Hyundai on their debut, the stock market debut, that is. Well, let's get to our next guest on the show. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is joining in. Gurmeet, where do we even begin? I don't know what stock to talk about. Let's start with the market as a whole. And this mid-cap fall that we've been seeing 2 days in a row, what are you hearing from clients? When typically, this market for the longest time has been buy the every dip market. So it's after a very long time that we're seeing this sort of behavior play out. Even though domestic institutions have been buying, to be fair, they're sitting on cash levels, they're buying every day, offsetting their FPI selling. But what are you hearing and, what's the sense out there right now?
So every correction is unnerving. I think we've seen actually one after a long time, and that's why I think the reaction is what it is. I don't see any panic as such. I think the discussion is still on, how much to put at what levels. And typically, we have seen how large IPOs, have this uncanny ability to lead the correction, right? We've seen that with so many IPOs starting from Reliance Power in 2007, Coal India, Paytms, and now Hyundai. I think Hyundai didn't leave anything on the table, and I remember our discussion saying that there's no rush to subscribe with the IPO. My sense is typically when you see a bit of a sell-off in mid and small cap, that's usually the last leg of the sell-off. But you never know. I think this kind of selling is unusual. I think October, today's number included, they will cross $10 billion of selling in October alone. Last time you had $8 billion was in COVID in March 2020. So, any market, 10 billion outflow in like, let's say 20 days, or let's say 12, 13 trading days. I think we've done better, thanks to, as you rightly said, the buying cushioning by DIIs. I still think this is a buy on dip market. I think this is where you get more bargains. And a lot of these stocks, look at auto index had doubled. Nigel was discussing recycling themes. Those stocks had doubled. A lot of places we haven't questioned the fact that small mid caps also went up 100% in the last 12, 18 months. So some bit of a pullback is normal, and I think it will bring sanity to the market.
Gurmeet, hi, afternoon. But as you said, there is no... At the margin, are you hearing, especially mid and small caps, it's just, I mean, some fund selling, anything, any market intel in that sense that you're picking up? What's going on? At the margin, is there a new reason, or is it just profit booking across the board?
Prashant, I would say some bit of rotation. I think because, people have made money, some bit of rotation is of course happening in places where you have made, 2, 3x, some cases 5x, in a lot of small mid-cap counters. So I think some bit of rotation is happening. But when you have such a broad-based selling like this, it typically doesn't help. And I think we've been getting a lot of liquidity last week or so, and we've been trying to deploy it every fall. And we have seen it all. I mean, we have seen a 10% correction virtually every year in my last 20 years, except for these last 18 months. And still, it's not 10% from the peak, mind you, right? If you still calculate, I think we're still about 8%, 9% from the peak. So I think it's normal. Only thing you have to be now careful is that you may not have the same kind of a rebound broad-based. I think because the earnings are soft, and that is where you're deploying is more important rather than just buying the dip. So wherever there is earning support is, I think, where you should be more anchored to. So where you're deploying in this dip to me makes more relevance than just buying blanket and basket just because the stocks have corrected 20-30% in some cases, because a lot of the stocks still trade at very high valuation. Nifty small cap after this fall is 33 times, and you're not expecting more than 5-7% EPS growth in that space. So you have to be careful in terms of what you're buying in the
a day like today, Gurmeet, people say, right, if you bought Royal Enfield in this year and, instead of that, you bought the stock, then you would make so much returns. Someone who has a Sandro, a Creta, they'll be very happy today. They will be driving home in that, and they didn't get IPO allocation, they'll be even happier, on a day like this. So, that's the phase of the market. And I think for the Hyundai management, the couple of things that they should not have done is that big dividend payout that they took back, 15,000 crores, and increasing royalty and coming at these valuations. So maybe that's hindsight, but that's about that. Well, let's move on then. We have Hormuz, who's standing by to take us through the fall in mid caps from the highs that we made on September 24th. Hormuz, interesting list coming up. Take it away.
Usually when you see a fall of 5 or 7% from the peak, that is not a cause of concern whatsoever. But for those who are accustomed to seeing mid caps and small caps making new highs every day, wake up, see the indices make a new high and go back to sleep and repeat the action, this would cause some bit of flutter for those kind of market participants for sure. The mid-cap index made a high on the 24th of September around 60,900 odd levels. Since then, 80 stocks of the mid-cap index have delivered negative returns from those levels. Now, this fall is not just a 3 to 5% fall. If you break those 80 stocks down, you would see 11 of them have declined more than 15% from the 24th of September, that is. 24 of them have declined between 10 to 15%, and the number is even more for a 5 to 10% fall, which is 29 stocks. Now, which are those names that have seen the biggest fall since the 24th of September? The usual suspects, right? Vodafone Idea, Cochin Shipyard, Suzlon. The higher they went, the faster they went, the faster they've come down as well. And the list doesn't end there. There are names like L&T Finance, there are names like MRPL, PSUs like HUDCO, GMR Airports also forms a part of this list. All of them down anywhere between 15 to 20%. Now, this is on the index front. Now, if you take a look at specific stocks, that picture looks even more grimmer because Vodafone Idea is down 56% from the peak of 19 rupees that it had made earlier this year. Cochin Shipyard made a record high of near 3,000 in July. In 3 months, the stock has halved. HUDCO, RVNL, a high-flying PSU as well. IPO price of around 20 rupees, a record high of 650, down 32% from those levels. But this is on the index front, it's just a 7% fall. But if you pick up specific stocks and you see that, the picture looks a lot more darker, and that dark is a lot of red.
Oh, absolutely. And those are crunching numbers, really. I'm just thinking of, all the PSU funds and the mid-cap funds that were launched, not even active on the passive side, and what investors might now be feeling or going through. Hormuz, thank you for that. Those numbers really tell a story. The Nifty, just to complete the picture, the Nifty is down about 6.5% from the peak. The mid-cap index is down 7.5%, a little more than that for the small-cap index. Gurmeet, let's start with the PSU fall, right? Because now on some of these names, like Horma's pointed out, it's crunching. When you see a stock crash 50% in 3 months, and a lot of investors haven't seen it, right? You and I and most of us here in the studios, we've seen enough cycles, but a lot of new investors haven't. So what would your advice be on navigating the PSU space now?
Subi, to be fair, these ship companies also went up by 6x in a year, right? And that's what I'm saying. We're seeing the fall. We never question outperformance. We always question, corrections and underperformance. Once you start questioning outperformance, that's where you make better allocation and reduce concentration risk. I think there's a lot of value in PSU banks, in my view, if you want to divide it, right? I think a lot of them trade below book value. We've seen with some quarterly updates like Bank of Baroda. I think they've been good updates. There will be a lot of treasury gains with 10-year yields falling 30 basis points. There is some PSU banks which are exhibiting good growth in granular deposits, so that will get reflected in NIM. Credit cost looks pretty contained now. I think there is a structural turnaround in credit underwriting there. So I think there is value there. We find a lot of value in some defense names like HAL, Bharat Electronics. I think there has been a healthy 20-30% correction, but you have order book visibility for next 6-7 years. HL, for example, it's almost now touching almost 1.5 odd lakh crores in terms of visibility over the next 3-4 years. Similarly, we find some value in selected names in railways. For example, look at Titagarh, almost down 40% from the peak, but you have 900 Vande Bharat, you have metro coaches, you have a backward integration they have done, and so many things offers you value. So you got to be selective here and cherry pick in terms of what has visibility of earnings and growth, and not just buy the blanket. A lot of the not so good PSUs went up because in general PSUs got re-rated. And I think that's the point I made earlier. Be a little selective, focus on earnings. I think there's a lot of value now on the table.
PSUs remind me of one of those parties, and I don't know this, right? When you were at the hottest club in town and you were overstaying the welcome because the deadline's over, but people still want to get in because it is the hottest party in town. But the moment the cops come knocking at the door, the slightest trouble breaks out, everyone's rushing to the exit at the same time, right? And I think maybe that explains this big fall, 30-40% fall that Horma's just pointed out on some of those PSU names.
Well, but I think Gurmeet is sounding fairly optimistic as well about the future. He's talking about allocating money. He's saying that flows haven't stopped and they are nibbling in as well. Gurmeet, there's a big meeting with regard to what Zomato wants to do on their fundraising plans. And Nimesh had hinted that maybe, in fact, they want to bring that FI holding a little bit lower. The DI holding goes up, more amount of domestic holding, which benefits them ultimately. The stock currently is at the low point of the day. That's a theme that is gaining a lot of traction. Look at the demand for the unlisted Swiggy. Your view on Zomato in this sort of a backdrop at around 250?
Very constructive, Nigel. For example, if you see, they are already talking of 1,000 dark stores by next year. And if you see, for example, I think there's a pressure on the hybrid model. Quick commerce will do well. The traditional retailers organizers will make a comeback. I think this 24, 48-hour delivery, likes of Big Basket, etc., need to probably reinvent, because in tier 1, quick commerce is eating them. Imagine DMart saying that, a 40-year-old business getting disrupted by a 2-year business. And this is what tech can do. And if you see in US, for example, the online consumption in the last 2 decades went up from 5% to 35% now. And you have 8 companies which are $1 trillion. So we don't have an Amazon, we don't have an OTT like Netflix. We don't have our tech companies technically there, right? And I think Zomato has that chance, provided they stay focused on asset allocation. And in this game, because they're raising money, other than the holding, the one guy who actually goes up to 60, 65, then eventually tends to eat everyone. We've seen that with Amazon. So I think even if you see Zepto is raising money, Swiggy's raised money and now probably due for the IPO. So if you see in Blinkit now, even in Blinkit, their market share is now 40%. They are priced about 3-4-5% better. And in youngsters, we follow very engagement trends. I think that seems to be emerging as a preferred choice. So maybe to cover your dark spots, you can probably see Swiggy and bit of an allocation to Zepto. There's a lot of action on this market, but we are adding Zomato. So food delivery will grow maybe 4-5% Q&Q. I think it's the e-commerce, quick commerce business which I expect good growth, also contribution margin picked up a bit.
Okay, all right. Gurmeet, we'll leave it there. Good conversation as always, and good perspective. Thanks very much for joining us. We'll take a quick commercial break here. We'll come back in a bit from now with more coverage on markets. Also, we'll be joined by Vineet Arora from NAV Capital on the other side. We'll talk markets, but we'll also talk about, SEBI's sort of comments from the whole-time member at SEBI, Mr. Ashwini Bhatia, on F&O and SMEs. The discussion paper on SMEs is due. Vineet is someone who invests in that space, so we'll ask him that. Stay with us.
Month ago. In fact, Hyundai also honored Shah Rukh by gifting him the 1100th unit of the all-electric premium SUV, the Ioniq 5, in December last year.
investing.
Welcome back. Here with us on Closing Bell. Continues to be quite a difficult afternoon of trade. If you look at the Nifty now, 266 points. It's just getting deeper and deeper. Now there's a huge amount of momentum on the way down. So that level that Prashant was speaking of, the lows that we were discussing, last week's lows, history, completely history, 24,520 on the screen, and we still have half an hour to go. Well, let's look at one particular development that's been, in the limelight today as well. And this was a comment made at a Morningstar conference earlier. SEBI whole-time member Ashwini Bhatia raised concerns over the frenzy in the F&O space. He also said that F&O cannot be a national pastime. Not just that, He commented about the progress being made with regards to regulations in the SME IPO space, which has come under increasing scrutiny. It's been under the scanner, so it seems that more regulations could be in the offing. Take a look.
India accounts for the largest volume of F&O globally. We are number one, and globally also more than 50% of the F&O volume happens in India. This is a crown we do not wish to wear. F&O cannot be and should not be a national pastime, which actually means that savings of retail participants move into the pockets of institutional hands. So just look at the numbers we have told you. 3 years, 1,80,000 crores, and it has been losses for 93% of the investors. 1% make 99%. So your odds are terrible. But the surprising part from SEBI angle is this. The moment we came out with the latest regulation, which kick in sometime in November, investors are protesting that, lot size 5 से 15 क्यों कर दिया? Investors are protesting कि आपने सिर्फ एक ही expiry हफ्ते में क्यों कर दी? Investors are also protesting upfront क्यों कर रहे हो, margining and so on and so forth. But finally, this is becoming systemic. As I said, this F&O cannot be a national pastime. You need to do serious investing. We want India to be prosperous. Wealth is being created very, very fast. And I think investors should participate in the wealth creation that is happening in the country. SME listings are closely monitored by exchanges and SEBI to ensure they don't engage in irrational exuberance, price manipulation, or fraudulent trade practices. We are working on a discussion paper on SME IPOs that should be coming out soon. But what we have seen is pretty disturbing. The way retail participation is happening, the number of times IPO issues are oversubscribed, the way market making happens, the way underwriting happens, and obviously we don't feel very comfortable about what's going on.
Okay, well, those are absolutely clear-cut, sharp words coming in from Mr. Bhatia there at SEBI. We have Vineet Arora, Managing Director at NAV Capital, joining us. Vineet, good afternoon. Good to have you with us here. I believe NAV does invest in SME companies. So to begin with, for us and for our audience, if you can give us a sense of, NAV Capital in terms of SME exposure and what kind of investments you do. And then let's talk about, the comments from SEBI that a discussion paper is around the corner.
Yeah, so we've been very active on the SME space for past 2.5 years. We've done about 60 IPOs as anchor investors. Probably by far we're the largest institutional investors in that space in India. And we do believe in that space. We've also done a bit of mainboard. In fact, last month there were 47 IPOs in India, and we participated in 16 of those as anchor investors in the IPOs. And we continue to hold those positions. If to look, we talk of froth in the market. What Mr. Bhatia has been telling was talking of a consultation paper. But to me, it's literally like, liquidity and participation go hand in hand. SMEs or small caps or micro caps never had liquidity in the market. As the participation came in, liquidity came in. Now, as it is growing, we are literally stifling it. In my view, what we are doing is literally stifling something which is just mushrooming up. NAV continues to look at small cap, micro cap, because we strongly believe that no large cap was born as large cap. All these companies were a micro cap or a small cap or SME at one point of time. This became big.
no, obviously you start small and then you grow and become large. But what is the, in your opinion, are there any things which need to be tightened in the SME space? Since you know this inside out, right? As you said, you're one of the largest institutional participants in the SME space over the last couple of years. Is there any lacuna which needs to be plugged? What would those be specifically? Or do you think it is just SEBI trying to temper the enthusiasm? I mean, because it's probably gone a little too far and it's a regulator trying to do that. What's the sense?
If you look at the data, SMEs, we've had 1,080 IPOs since 2012, which is a 12-year period. And in all, they've raised about 21,538 crores to be precise, as of now. Compare this to Hyundai IPO, which raised 27,000 crores in one IPO. So what kind of frauds we're talking of? This is a sector which is very, very important for India to achieve its vision of $30 trillion economy. It provides 40% of India's employment and contributes about the same to the GDP. So number of companies which have hit the markets is not even a fraction of what it can hit. If we can have 5,500 companies on the main board, we can definitely have 6,000-7,000 on SME space. And of the 1,080 companies which have listed, about 320 have actually migrated to the main board. So, in my opinion, the regulator should act as an enabler and not to stifle the growth. Here, we're acting in a bit of haste where we are coming up with, NSE came up with this regulation where they need to have free cash flows for the last 2-3 years. Now, how can a company which is investing and growing have free cash flows? I mean, that is very archaic. That's literally, making sure that the companies which need capital don't get capital, whereas the whole vision was that the companies which actually need capital to grow and who don't have access to capital can come to the SME platform and take capital. That, I think, is getting stifled. Having said that, yes, there are issues in the sector. There have been some very expensive IPOs, where the SEBI should probably increase the disclosure requirements, put more onus on the merchant bankers on the disclosure side, tighten the market making where some bad practices have been going on, which Mr. Bhatia did point out. So those things, yes, I agree we should do. But we should not do something like FCFE, which totally becomes stifling for the sector.
No, and lots of numbers you've given us. 1,080 SME IPOs since 2012, 21,500 crores raised, and 320 have migrated to the main board. Would you have a... Sorry?
319 to be precise.
319, okay. Would you have a sense of out of these 1,080 companies, how many are how many are below the IPO price? How many are above the IPO price? I mean, any broad... How is the segment done?
About 900 listed with a positive gain. And my sense would be a similar number would be above the IPO price. Like if I look at our portfolio of the 60 companies that we've invested in, if I look at today, probably about 5 are below the IPO price, and we've exited all of them. But the number is about 10% ballpark, give or take. So 90% is still trading above the IPO price.
Okay, fair enough. You talked about increased disclosures. One thing which I think you would have also heard and has come up is that exchanges approve these DRHPs, right? Approve the companies as they come to the market, unlike the main board where it's the regulator, you've got to file with the regulator. Does that, how it's done, does it need a relook, or do you think it can be done with strengthened systems at the exchange level?
I think we should strengthen systems at the exchange level. The whole idea was to make it easier for these smaller companies who don't have the wherewithal to raise capital on the exchange. Once we move to SEBI, SEBI is a regulator. Its job is to enable the legislation and make sure, it's followed. Exchanges are both NSE and BSE have done a fantastic job so far in the segment in terms of promoting the segment, creating a marketplace for them. And I think they are very well equipped to actually handle that. So that should remain with NSE, both NSE and BSE in terms of, approving the IPO process, because they're set guidelines which they need to follow.
Okay, all right. A good discussion, Vineet, and I hope we can speak again soon. Thank you for joining us with that perspective. Appreciate it. So that's Vinit Arora of NAV Capital with some thoughts. We'll go into a break right now. We're going to come back. But as we go into a break, I just want to play out these sound bites from the Petroleum and Natural Gas Minister, Hardeep Singh Puri, and what he had to say about all of the talk around city gas distribution companies. And of course, whether they will or will not raise prices to compensate for the cut in APM gas allocation to them. Listen and take that break. We'll see you on the other side.
This things keeps happening up and down here like that. What is the issue?
But there's an expectation that companies may raise prices.
They will, sir. Which one? Which one? Tell me. Who's raising? Who's here raising prices? Are the OMCs are not raising prices? No. ध्यान से I don't want to. यहाँ के आप तो ब्लॉक कर दिया यार. थोड़ा आगे आ जाओ. हाँ थोड़ा.
If you can just field the question again. There is an expectation that they may raise prices.
Tell them to talk to us directly, not come through the press.
Welcome back. Well, the markets have gone ahead and broken the 100 DMA as well on the Nifty. We plot the 100 DMA and this selling has come in the last 20 minutes yet again. So any kind of bounce is getting sold into. And as I said at the start of the show, we'll be lucky to get away with a close, at around 2:30 p.m. Heading to 3:30 p.m., well, it's got a little bit worse. And now we have breached that 100 DMA as well. But let's hop across to Nimesh. Nimesh, It's that sort of a day. What's the flow picture looking like? Big selling is what we're seeing at the low point of the day and really nowhere to hide.
Absolutely, Nigel, nowhere to hide, and especially the pain is in the broader market stocks. Look at the small cap index, that's down 3.5%. And now I'm seeing clearly there is capitulation signs in the broader markets. A lot of stocks are hit 10% down circuits, and a lot of small and mid caps are under pressure today. From a flow perspective, again, I've been saying this for a while now that DFIs continue to be net sellers. Even today, the feedback is that the buy-sell ratio is close to 1:2 on the sell side. But I spoke to a lot of large HNI investors, some mutual fund managers as well. A couple of reasons why we are seeing such a sharp fall. And if you look at it, India is actually underperforming the global markets as well. And this is specifically India reason. One, there is lack of buying interest now. There is a bit of momentum which is broken in the broader markets. Two, and the bigger reason is the earnings. I had flagged off the Q2 preview, and it was expected to be the worst in the last 3 years in terms of top line growth of just 2% or 3%. Now you are seeing actual numbers, and that's why you're seeing sharp reactions. Look at, we are just flashing SRF numbers, a big margin miss, a big top line miss as well, and that's been the trend across a lot of companies and sectors. So I think earnings, disappointment has been the biggest reason for such a sharp fall in the broader markets and in the large cap names as well. From a flow perspective, as I said, there is selling pressure, but financials and healthcare stands out in terms of sell flows from larger institutions today. And again, the feedback seems to be very clear that even from a domestic flow perspective, the flow is now clearly shifting from value to quality. When I mean value to quality, I guess all the value stocks, which is the PSU basket, all the momentum names, which is the broader market stocks, money is clearly shifting from there to quality where there is to hide in terms of earnings. Look at what happened to HDFC Bank, strong earnings, and that's not fallen much. Today, City Union is a classic example, a small hit, and you've seen a big reaction to that as well. So clearly, Nigel, the feedback seems to be market is panicking more to earnings, which has been a disappointment, and of course the flows are not supporting as well in the broader markets.
Oh yeah, absolutely. It is looking quite dire at this point in time. Nimesh, what about individual stocks? I mean, the whole market is a talking point today, but any individual names, any chatter?
Well, I've struggled to find out few names, but nevertheless, a couple of names to talk about. The first name is Green Panel Industries. We had flagged off an initiating report a couple of days from a domestic brokerage firm. The stock has been in that range for a while now, but now understand there could be a large block deal in Green Panel very soon. So that's the first name. The second name is BHEL. Within the PSU basket, this is one stock which has been underperforming for the last couple of days. Even today, after a 8% fall, you're seeing selling pressure from larger FIs. So it looks like some larger institutions are aggressive sellers in BHEL even at this price. And the last is ITD Cementation. Again, the stock from the top it has corrected almost 10%, but the stock also had rallied in anticipation of a deal which looks like is round the corner now. So been under pressure of late, but the street is anticipating the corporate development very soon in ITD Cementation.
Okay, all right. ITD, that deal perhaps round the corner, as Nimesh points out, imminent. Nimesh, thank you very much for that. I mean, it's a down and out and how kind of a market, and we lots of individual names, etc. Of course, also on the in correction mode. We'll take a quick commercial break. Okay, I think Mitesh is with us with a quick buy today or sell today, buy tomorrow kind of trade. Mitesh, what do you have? Mitesh, you'll have to unmute yourself.
Now I'm audible?
Yeah,
this is good.
Please.
Yeah. Sorry. So SRF is something which I would recommend STVT with a stop at 2200 and a target of around 2140, 2130 on the downside. Practically, I think the entire market looks weak, but I would be slightly cautious on sell side. I will not be very aggressive in the quality terms purely because of the fact that we are now hitting oversold levels. So a gap up can always happen, but yet the trend is on the downside, so we'll go with sell calls. So SRF is one, and the other one is Voltas. Keep a stop at about 1807 and look for a target of 1775.
Okay. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Sonal. She's here to give us a brief insight into those numbers that were flashing on the screen, SRF's numbers. Sonal?
Well, you know, SRF, it's a weak set, much lower than what the street was working with. And it's not only a YOY decline, even a quarter-on-quarter decline is what the street doesn't seem to like. And we've seen that on weak earnings, reactions have been quite sharp as well. If we talk about the numbers, the net profit has declined by 33%. The revenues are up 7.8% on a YOY basis, but they've declined sequentially. Even the EBITDA has declined sequentially. And if we talk about the margin number, it has come in at 15.7%, which compares with a poll of 18.5%. That too has come off on a quarter-on-quarter basis. Now, we were expecting the chemical segment not to do well this time, and that has exactly what has happened. The chemical segment has seen an EBIT decline of 30% this quarter. That's a YOY decline. While the packaging segment, as expected, has done well. There's an improvement of around 6.5% as supply has improved. But the technical textile segment is absolutely in line with estimates of a decline of around 4%. Now, going forward, for a company like SRF, which had given a guidance of around 20% growth in their chemical segment, that is something that needs to be looked at properly, because there is an expectation that they could go ahead and cut that guidance. So management commentary for the second half will be very important to watch out for SRF. But on the whole, the numbers look disappointing, much lower than what the street was working with.
Okay, all right. Thank you very much for that, Sonal. Appreciate it. Well, we'll step into a break, but here's a programming note. The biggest market experts will be joining us on CNBC-TV18. And this year, we are giving you a chance to meet your favorite market experts. 5 super fans will get a chance to visit our studios here on Thursday to interact with the biggest market experts. Write to us on our social media handles, tagging @25 years of CNBC-TV18 to take your chance to meet CNBC-TV18 Market Movers Forum at 3 p.m. day after tomorrow, that is this Thursday.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com. CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. foreseeing change, growth and transformation.
Okay, welcome back. 6 minutes to go for market close. Jay Bala is with us of cashthechaos.com. Jay, good to have you with us here. I think today you can say, I told you so, because you got that fall. And so what next from here, Jay? Your thoughts, Nifty, Bank Nifty first, and then we'll talk about mid caps and small caps.
Yeah, that's right. Good to be here, Prashansi. We had discussed on the 1st of October that there's a possibility of reversal has arisen for the market because time cycle had completed on the September 27th, and later on it took out the support at a key support that I had pointed out. And on the day itself, I had pointed out that if it takes out that key support, we are looking at the market going back to the post-election low of about 21,800, and that looks more and more the most logical price objective for the markets. And if you look at the small cap, large, mid cap, and the micro cap, they've all broken down, and many of them are clocking head and shoulders top, and the price objectives remain much lower from current levels. And I had anticipated the short-term bounce to come through for the Nifty, but whereas for the Nifty, the bounce has been lacking, and in fact it surprised me to the downside, whereas it came through for the banking index. So that tells me the market is actually weaker. The nearest support for the Nifty is actually at 23,890 to 23,800. And for the banking index at about 49,500. I'm still anticipating some bounce to come through, but the fact that the Nifty broke the October 7th low without giving a chance, that's a bit of a surprise and pointing to weakness.
Okay, by the way, if it's any comfort, I'm looking at global screens and they're all flashing red as well. So we're not isolated in this global fall, you could say that. The CAC is down about 0.6%, ditto for the FTSE. Some of the peripheral European markets like Italy, etc., are down about 0.7%. And let's look at the pre-open rates. So yeah, right now the pre-open rates in the US suggest that it'll be a bit of a cautious start, but 0.5% lower. Lot of major earnings in focus later tonight on Wall Street as well, including the likes of IBM, Tesla, and a couple of others are coming out today. Okay, Jay, so what should be done? What is the approach? Would you venture in with any longs at all right now? Would you stay away? I mean, so what's the strategy in terms of either an index trade or stocks?
Yeah, the best to do is to wait for a bounce to come through and then look for resistance to be hit and then take a short position. But even at current levels, a couple of stocks look weak and they may drop even if the market were to bounce. I have two picks for today. One is BPCL. It's a short with a stop loss at about 355 and an objective of 270. And Bosch is another one. I have a short with a stop loss at about 39,088 with a price objective about 31,000, maybe even 29,800. The Bosch has completed a move from the 2022 low and is clocking a reversal on its weekly time frame. So, this might be one of the stocks that going to probably fall sharper, but be measured in your shorting positions.
All right. Jay, hi, good afternoon. Congrats first on getting the call right. You have been sounding cautious the last few weeks and credit where it's due. So good going on you. I want to understand support levels. Nifty, Nifty Bank, as well as Nifty IT Index. On the Nifty, I think you briefly mentioned 23,900. Could you confirm that and also tell us about supports on the other two, the pillars of the Nifty?
Yeah, that's right. See, the support for the Nifty is 23,890 to 23,800. And a bounce should come through from there, and then a greater decline should ensue after that. For the banking index, the support is at about 49,500. And post that, we are looking at a decline, once again, close to the June 4th low after a small bounce. The Nifty IT index, the support comes at about 41,000. If that's taken out, the next support is at 37,700. So 41,000 is absolutely key. If it takes out that, it's an indication that a medium-term trend reversal might come through, but that confirmation will come through only at about 37,700. But we'd be cautious out here.
Jay, I think last time we spoke, you were cautious in US markets as well, right? I mean, that's the other shoe which is not dropped. And I hope it doesn't
That's
drop.
right. I
But what's your
pointed to-
sense? Yeah.
That's right, Prashant. I pointed to time resistance coming through for the U.S. markets on the 21st of October. We had if you look at the Dow futures, it's come through. It's had a bearish engulfing reversal yesterday, and if we have a follow through today, because one day doesn't make it a trend, if we have a follow through today, there's a great probability that the U.S. markets will also start correcting, and that correction could take the US S&P down somewhere close to about 4,900 to 4,800. And the more important thing is the Nifty topped on the 27th of September. And that's the exact day the US dollar index also bottomed. And the US dollar index has rallied for the last 15 of the last 16 sessions. And that's after clocking a fresh 52-week high. That's a very, very rare event. And each of those 15 sessions, the US dollar index closed much above the open or very close, just above the open. So that's sending you a very strong signal for the dollar index. And once again, the low for the US 10-year yields, that's also registered important low on the 17th of September. And we might actually have a trend change here, but need a little more confirmation.
All right, Jay, thank you very much for joining in with that perspective today. Let's quickly wrap out what has been a really, really bad day for the bulls. A crunching 300-point fall, which has seen the Nifty break a lot of important levels. Last week's low has gone, the 100-day moving average has gone, and the close is going to be below the 24,500 mark. Just quickly recapping the biggest losers on the large cap screen: BEL, M&M down about 3.5%. Adani Enterprises, Coal India, these are cuts of around 3 to 4% each. SBI down about 3%. Tata Steel, Hindalco. It's all across the board, really. There's been no hiding place. Reliance, L&T, a lot of the big boys under pressure as well. In fact, only two stocks have managed a little bit of green on the Nifty. One is ICICI Bank, and Nestle is just barely green, 2 rupees. That's it. That's the green you're getting on Nestle. Other than that, the entire index has closed out in negative territory. But the biggest story is obviously on the mid-cap screen. Look at the cut there, 2.5% gone on the mid-cap index. And check the small-cap index as well. The small-cap index has seen a near 4% decline today. An extremely negative advanced decline ratio. A long list of losers. Masgao Dock, 9% down. Supreme Industries, 11% down. AB Real Estate, 10% down. Amber, 11%. Garden Reach, 12%. Gravita, 10%. IFL Securities, I could just simply go on and on. Jana Small Finance Bank. I mean, we're talking 9, 10, 11% average cuts on the mid-cap space. And the PSU part of the market has been particularly impacted today in the fall. A pretty wide fall all out. And the Bank Nifty also going home with a cut of 650 points. Tough day. Well, with that, it's curtains on this edition of Closing Bell. But we'll see you immediately on the other side in just a minute. Markets forward. We'll take the action ahead.
For a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air. Online. On social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
If I go back to financials is number one. This whole energy, renewable energy kind of is area number two. The whole hard assets is area number three. And in that, what else have I done recently? Let me think. So I have renewables. I have an airline stock, for example, believe it or not, that there is a, hopefully a revival in that as well. I mean, from an individual investor perspective, there's enough to do. And it's not a market which is going to crash and therefore you say, I want to sit on cash. Next Diwali, if we get double digits from the index, I would be surprised. I think at some point, and there are a lot of stocks. Even remember, we've spoken in the past about EMS. Some EMS stocks are down 40%. And it's not like the story is over there. Some of them are over 100 multiple. Some of them are not.
It's a sharp fall on Dalal Street led by small and mid caps. The Sensex and the Nifty end 1% lower, but the small cap index falls almost 4% and the mid cap index falls over 2.5%. PSU banks, realty, metals lead the slide.
Adani Group's Ambuja Cement is set to acquire 46.8% in Orient Cement from promoters and other stakeholders at an equity valuation of 8,100 crore rupees. The deal triggers an open offer for shareholders of Orient Cement and sparks speculation over more M&A in the sector.
Hyundai Motor India makes history by debuting on the Indian stock exchanges after the country's biggest IPO. But the stock lists at a discount to the offer price as analysts remain divided on its growth prospects. The global CEO is confident of growth and sees more capital investments in India.
Hello and welcome to Markets Forward. A crunching blow for the bulls where a lot of important levels have been disrupted today. We have plenty to go over, tell you all about the massive selling that we've seen not just in large caps but in the broader markets as well. I'm Surbhi Upadhyay and with me on the show as always my colleague Nigel D'Souza. Nigel, what a day. I wasn't thinking so much when I wore the color, but unfortunately for the bulls, I guess this was the color of the day.
Well, today, if you just look at the chart all through the trading session, any kind of bounce got sold into. Yeah. And it was that sort of a day. Today is one of the weakest sessions actually I've seen in a very, very long time. Because we didn't get that fillip, even that 30, 40 point fillip, even towards the end of trade. The last tick as well, virtually at the low of the day. And if you just pull up a chart, you'll see that the Nifty breached the 100 DMA on a closing basis. So now we're trading below crucial technical levels as well. But you look at the Nifty and you'll say, Nigel, what are you talking about? We were down 1.3%. How bad is that? Well, you take a look at the breadth of the market. You had only one stock that was advancing for close to 10 stocks that were declining in trade. And the crisscross lines, well, they were far apart all through the trading session. And that's where the pain is. But to give you three big points in terms of why is the Nifty seeing correction? From the recent peak, we've seen a decent correction now. Earnings, well, they have missed estimates. We're getting more misses rather than more hits. And in the US markets, actually the opposite is happening. That's why India is underperforming the globe. In the US markets, out of all the companies that have delivered numbers, 75% actually have beat estimates. Over here, the ratio is actually in favor of the number of misses. The rally as well, year to date or in the last 1 year, has been very, very swift. Headline index has moved up. The mid and the small caps have rallied 20-30% as well. So there is that temptation to book some profits. And particularly, some of them are getting a little bit nervous in this sort of a market. So there is selling on the screen. And finally, the biggest possibility is the FIIs. They're underweight. They're moving, to the lowest percentage of Indian holdings that we've seen. in the last many years, it's now down to around 15 to around 16%. And in the month of October, they've sold $9 to $10 billion. And that's intense selling that we are seeing. So those are the top 3 points, which will be, as you mentioned, the color was red on the screen, and no bounces is what we saw. No real place to hide.
No, absolutely. And the nature of the fall was such that today, I mean, stocks across the board were falling 9-10%. Yeah. It's not just one stock falling 10% or 11%. We can start rattling the list and it would be running into, many names out there. There were some earnings disappointments as well, and we'll get to that as we go along. Stocks like SRF, for instance, reacting to negative earnings, or Supreme Industries, or Paytm for that matter. But it was more than results, really, a lot of the factors that Nigel alluded to. And the fact is that now there is a rush to book whatever profits are left, because the Nifty, let's remember, is down about 7% from the peak. The mid-cap index is down almost 8% from the peak. So the numbers are not looking very good if you've been holding on to a lot of those mid-cap names. So we'll talk about this as we go forward. Today, categorically speaking, I mean, the PSU space was singled out a little more than the rest of the market. Both the Nifty PSE index and the PSU Bank index, those indices were down between 3 and 4%. But, I mean, they're not the only ones. The entire market was down and out, and that is what we will track as we go forward. So we'll bring in Hormaz, because he's been looking at a lot of the numbers and the data today and over the last couple of days in terms of the individual stock action. Then, of course, we focus on some individual names as well. Ambuja, as we told you in the headlines, because of the big deal. City Union Bank, very few specks of green on the screen today, and City Union Bank was one of them. We'll tell you why. Paytm came out with numbers, so it makes it to our buzzers list as well, as like I said, names like SRF and some other earnings reactions. And, of course, we look out for some important cues from tomorrow's session, including the major earnings. But let's start first by dissecting what was really a complete sea of red. Hormaz, over to you.
Maybe our stylists preempted the color of the market by giving us our wardrobe for the day. But indeed, it was a sea of red across the benchmark indices or the broader markets. Earnings reactions were extreme yesterday. They were extreme today as well. And Supreme Industries could possibly be the accident of the day. 10% lower after the guidance cut that they did. Aditya Birla Real Estate as well, another 10% gone after the results. Jana Small Finance Bank, some asset quality concerns coming in there. And Kajaria Ceramics as well, reacting to results. The result reactions are plenty, including Paytm and SRF that came out. But the one positive earnings reaction was City Union Bank. Amidst all the sea of red, City Union Bank stayed where it was, 12% higher at the end of the session. Positive commentary coming in as well. Analysts expecting the stock to touch levels of up to 200 rupees as well. You mentioned PSUs, they were under pressure. Shipbuilders were the ones leading the fall in today's session. Mazgaon Dock announced a stock split, announced a dividend, but still ended at the lowest point of the day, 11% lower. Cochin Shipyard is half from its peak. Garden Reach, BHEL, HAL, all of them seeing severe losses in today's session as well. PNC Infratech continues to decline, another 7% gone in today's session after the 20% fall seen yesterday, and the stock has lost almost 3,000 crore in market cap over the last 2 sessions. High beta sectors like real estate as well selling off in today's session. Almost all real estate index constituents seeing losses of anywhere between 4 to 6% in today's session. And lastly, stocks seeing movement on the back of volumes, and they were predominantly to the downside in today's session. And look at these Jupiter Wagons, Amber Enterprises numbers have just come in, L&T Finance, Jindal Stainless, all of them 7 to 12% fall on very, very strong volumes. Back to you guys.
All right, thanks for a lot for that, Hormuz. Well, let's get in our guests. We have Jay Bal of CashTheChaos.com and Gurmeet Chadha, Managing Partner and CIO of Complete Circle. Hi, gentlemen. Thanks a lot for joining in. Well, Jay, you have been cautious on the markets. You'll be feeling good. But if you're short on the index, what do? What are the targets? And at some point of time, will you be looking to cover those short calls that you have taken or those puts that you have bought?
Yeah, already I'm lightening. I mean, I'm advocating lightening the put that you've taken from the beginning of October. And although the supports coming at about 23,890 to 800, we don't know the extreme short term what the markets are going to do. This kind of extreme negative breadth usually brings about a very short term bounce. But in my opinion, the markets aren't done with the decline, and the next bounce is probably going to bring in a larger decline. In fact, the Nifty was supposed to bounce back to about 25,500. It broke the October 7th low of about 25,567 and change, and it's come below that. And while the banking index is behaving as expected, it's also looking quite weak. And the most important takeaway of today is the deterioration of the breadth. We have head and shoulders breakdown on the Nifty mid cap Nifty next 50, and Nifty small cap, and so many other indices. So this is not going away, and it's not going away easily.
Okay, all right, got that, Jay. Well, Gurmeet, I wanted your view on the big cement deal that was announced, but let's run our viewers through the contours of the deal. The big deal today was Ambuja Cements went ahead and bought 47% stake in Orient Cement. Most of the stake was sold by the promoter entity, which have 37% stake in the company. Because of the large transaction, it triggers an open offer, 26% stake. What about the valuations? 8,100 crores is the equity valuation for a total capacity of around 8.5 million tons, which means on an EV per ton basis, it's around $113, $114 on a per ton basis. Orient Cement, remember, is debt-free, and Ambuja Cement says that they'll fund this transaction via internal accruals. What else does Ambuja get? Market share goes up by 2%. They'll get the 8.5 million ton operational capacity. They can add another 8.1, and they said since they have limestone, they can look to add another 6 million tons in North India. How does Ambuja Cement's trajectory move in terms of the capacity addition? When they took over the company, it was 68 million tons. Now, post these transactions, Sanghi, Penna, as well as Orient, they'll move to around 97.5 million tons and puts them on course to head towards that 100 million tons by the end of this year. They've laid out a guidance. They want to take the EBITDA per ton to around 1,500 rupees and the ROC to around 15%. It's a win-win-win situation. Ambuja gets the capacity they're looking for. Orient gets a better promoter. And for the industry, consolidation is good news because in the longer term, that's what bodes well. Gurmeet, what do you make of this deal and how are you all approaching the cement space?
As you said, Nigel, seems to be a win-win. Valuations are roughly now hovering between $100 to $115 a ton. But I think till the time this consolidation takes in, I think the volume numbers have been a touch soft. While, Ultratech, for example, in second half is now guiding for better revenue, but that's also more price-led. So consolidation eventually will lead to better pricing too. But seems to be a good acquisition, and I think we are probably moving towards two large players, one with probably 200 million tons, and other probably targeting 120, 130 million tons over the next 3-4 years. We are positioned in the way we have Ultratech and Ambuja, in some portfolios. We are also trying to see if there is any special situation in terms of more acquisition targets, especially down south. So we have small exposure to Saga Cement. Valuations is very, very, it's almost at $40, $45 a ton. They acquired AP. AP was a great acquisition for the price they got. I think with some stability, and hoping some better quarterly numbers, I think that should also be for grabs. A lot of large players have also taken stake there, and it seems to be at $40 a very, very good acquisition candidate. We'll see how it goes.
Okay, that was indeed the big deal of the day. Let's move on now to some very sharp earnings reactions that came in, starting with Supreme Industries. This stock collapsed about 10% in trade after coming out with weak numbers and guiding for a more subdued performance even going forward. There is a guidance cut that the company has gone ahead with. Upasana has more details here. Upasana?
Well, Supreme Industries reported a weak set of numbers, missed the street estimates on all counters. Revenue stood at 2,273 crores with a downtick of 2% on a YoY basis. EBITDA margins are also under pressure, down about 140 basis points at 14%. And PAT stood at 219 crores with a downtick of about 16% on a YoY basis. Now, it is important to note that company has cut its volume growth guidance in plastic pipe system segment to 16 to 18% versus 25% guided earlier for FY25. It says that the plastic pipe system business growth was severely affected due to extreme volatility seen in PVC resin prices. This segment also saw huge inventory destocking, and there was also a surge in freight rates impacting the overall export volumes. As of now, export stands less than 3% of the company's overall sales mix. Now, going forward for FY25, company is given an overall growth guidance of 14 to 18%, and it is expecting margins to range between 14.5 to 15%. So all in all, weak set of numbers coming in from Supreme Industries in its Q2 FY25.
Well, thanks very much for that, Upasana. But Supreme wasn't the only stock that disappointed. There's a long list in terms of earnings misses as well. But let's look at some numbers from the BFSI space. And the one green tick, like I said, that we had in the market today was City Union Bank. The stock was bid up because it managed to showcase pretty decent asset quality in an otherwise concerning environment. We have Abhishek joining in to tell us more about this one, and also Paytm. With Paytm, we're going back to the red color because Paytm was down after coming out with its Q2 performance. So Abhishek, let's go step by step, starting with City Union.
Well, City Union Bank showed two key trends which were on the opposite side to the industry. One, the industry is seeing a declining net interest margin while they saw improvement in their net interest margin, and the other point that slippages are rising for many lenders, but for City Union Bank it has declined, and that was rewarded by the investors in trade today. So the net interest margin has come in at 5-quarter high of 3.67% versus 3.54% on a sequential basis. The NII growth was about 6.8% quarter-on-quarter, and that led to profit growth of 7.8% on a sequential basis. The annualized slippage ratio declined quarter-on-quarter to 1.47% versus 1.53% in the previous quarter, and the asset quality also saw improvement with gross NPA ratio coming down to 3.5% versus 3.9% in the previous quarter. Macquarie has written on City Union Bank they have an outperformance rating with a target price of 185 per share. They say that the growth engines are back in City Union Bank. They expect ROA to remain at around 1.5 to 1.6% level despite higher credit costs that they anticipate for the bank going forward. So risk reward looks favorable right now given the potential ROA trajectory as well as the growth potential that the bank is showing. With reference to Paytm, there was one-off income that aided in terms of profitability. However, employee expenses are down very sharply. So total income grew by 12% sequentially. EBITDA loss narrowed down to 186 crore versus 655 crore in the previous quarter. Employee expenses were down 30.3% YOY and about 12.5% to 13% on a sequential basis. So exceptional gain of about 1,345 crore has come in Q2 FY25 for them. They reported a net profit based on this exceptional gain of about 930 crore versus the loss that they had of about 840 crore in the previous quarter. So X of one-off gains that they had in this quarter, their losses would have narrowed down to a little more than 400 crore when compared to 840 crore in the previous quarter. Gross merchandise value, that's improved by about 4% on a sequential basis. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, SRF reported another weak set of numbers in the second quarter. The earnings were well below expectations. Net profit was down 33%, came in at around 200 crore, which was lower than the CNBC-TV18 poll of around 290 crores. The margins, that was a disappointment, came in at around 15.7%, which compares to around 19.7%, or that's a 400 basis points decline. Revenues were up 7%, but the EBITDA declined by close to around 13.4%, coming in at around 538 crores. However, the management sounded positive on the second half of the year's numbers. While the performance this quarter has expectedly been subdued, the company believes the worst is over and the worst is behind. They expect to start seeing an improvement from the next quarter onwards with the likelihood of a strong finish to the year. Overall, the order book remains strong is what they say for the chemical sector, and a better performance is what they're anticipating.
Okay, all right. So long list of earnings there. We'll have to thank both our guests for the quick take today. I unfortunately can't go into too much of detail because of the earnings. Thank you very much, Gurmeet, as well as Jay, for joining in. We have to slip into a very quick break, come back on the other side with the top corporate voices of the day and the events to watch tomorrow. Welcome back. You're with us in Markets Forward. Let's look at Zomato. Now, the company has reported a nearly five-fold increase in profits in the second quarter to about 176 crore rupees. The food aggregator has reported a 68% increase in revenue to nearly 4,800 crores. From reporting an EBITDA loss of 47 crore rupees last year, Zomato has now swung into a positive EBITDA number of 226 crore rupees. So the positive performance continues, but the other big announcement obviously is the fundraise, and this is a CNBC-TV18 News break getting confirmed. The company's board has indeed approved a fundraise worth about 8,500 crore rupees, and Nimesh alerted us on this possibility earlier. The story's come through now. Nimesh, congratulations on that, and you know, what additional details are you picking up?
Well, you know, so again, the news break is confirmed. The board has approved, Zomato's board has approved $1 billion fundraising via QIP, so which is around 8,500 crores. I understand now that the results are out, it's an impressive results. Maybe, you know, in the next few days or maybe the QIP will get launched. Again, you know, the most important aspect of this fundraising is that while the street was a bit surprised at why they're raising money because they're already sitting on cash, the most important you know, trigger for the fundraising is they wanted to bring down the FDI holding to below 50%. I understand this QIP will be largely, you know, fundraising which will happen to the domestic investors, by virtue of which the domestic holding will go above 51 and the FDI plus FI holding will fall below 50%. Once the fundraising is done, I understand the board, the Zomato board is likely to write to RBI requesting the cap of FDI at 49%. This is going to be very important for you know, Blinkit, because Blinkit falls under the FDI regulation. So once the FI holding is below 51 or below 49 or less than 50, you know, you will see a bit of relaxation in terms of FDI regulations for Blinkit. That's been the key reason that the board today has approved a fundraising of $1 billion. And I understand from sources that largely the fund will be raised to domestic investors so that the combined FI FDI holding finally falls below 50%.
All right, thanks a lot for that, Nimesh, and congratulations on that big news break. Moving on to India's largest public offering. From Hyundai Motor India, they made a tepid debut on the bourses today. The stock listed at a discount of 1.5% to its issue price. The stock, though, continued to slide, ending the day over 1% in the red. Brokerage firms including Nomura and Macquarie, they are bullish on the stock. They have issued buy calls on the stock. However, MK initiated coverage on the stock but believes that the stock may fall 11% from its IPO price earlier today. We did also speak to the top management from Hyundai, the global CEO, who is confident of growth and sees more capital investments in India. The company also has many EV launches in the pipeline. Let's hear them out.
We believe with the addition of capacity, which is almost, if you see, 30% capacity addition is happening for HMI in the next 3 years. And this is after a gap of more than 10 years. So I think this is a big moment for the growth of HMI going forward. And we believe that, yes, not only in terms of volume, but the strategy of premiumization, the strategy of adding features, you know, and then, you know, meeting the expectation of the customers will help us to really sustain the volume as well as profitability. We believe that we are in a position to really, you know, grow in line with the market in terms of volume and, of course, always in terms of average selling price to continuously go up.
So if you see, okay, let's see, the market penetration is about 2%, yeah, but we are starting and we are putting the more EVs now. And up to year 2030, we are expecting about 5 EV models running in this market. We are expecting about 10%.
All right, that was Hyundai India making its debut on the street. Let's take a note of the top corporate voices we picked up during the course of the day. First up, CG Power. The management has told us that the margin dip seen in the second quarter was a one-off, but the margins can actually go back to 15% levels over the next 1 to 2 quarters. On the QIP and the fundraise, the MD says that 1,300 crore rupees will be used for acquisitions, while about 1,500 crores will go towards capex in the existing business lines. He adds that earnings can compound at 30% over the next 3 to 5 years.
We also spoke to Gravita. Well, they in fact said, they spoke to CNBC-TV18. The lead volumes growth disappointed in the second quarter. The company's CEO, Mr. Yogesh Malhotra, expects 25% volume growth in the next few years as regulatory tailwinds play out. He also adds that margins will hover around these levels but will improve as the revenue mix changes. He also guides for ROCE at around 20% and working capital days coming in closer to around 65 to around 70 days.
And before we go, let's tell you about all the key events and the earnings to watch tomorrow. Abhishek has the details. Abhishek.
Well, to begin with, economic data will be out for Singapore CPI tomorrow. So that is estimated at minus 1.1% versus plus 0.09% that it came out last time around. Euro data with Euro area consumer confidence, that index will come out with the numbers estimated at minus 12.5 versus minus 12.9% that it came around last time. US home sales data September number will come out estimated at about 3.9 million units versus 3.86 million units that it came last time. So with reference to India, minutes of RBI monetary policy meeting will be given out tomorrow evening. Watch out for that. And in terms of the results, watch out for AU Small Finance Bank, Bajaj Finserv, Hindustan Unilever, as well as SBI Life, TVS Motors and United Spirits. All of them will be coming out with their Q2 FY25 performance tomorrow. Back to you.
All right, thanks a lot for that, Abhishek. Well, on that note, though, we'll have to wrap up on this edition of Markets Forward. We'll be back, though, with more news and updates on the other side.
Typically, the Democrats have been warmongers. It's very, very sad to say, but because they tend to be kind of moralistic that we will go and support this. And the Republicans, which are more conservative and fiscally oriented, like this is why we're spending this money. And Trump just says it in a more blunt manner, that why should I be paying for Europe's war or for Taiwan's war? Let them pay their own bills. So I think if Trump comes, the way the betting markets now seem to be suggesting, you get a lot of these wars wrapping up quickly. There will be some negotiation and settled. But he's also a tariff guy and he wants Make America Great Again. You put tariffs up, it's inflationary. You cut taxes, it's inflationary. It's bad news for bond markets, as you said. It may be great for equities in the short run, but when you get inflation, you get rising rates and you get currencies weakening, which is why the trade this decade I still feel is hard assets and precious metals, gold, silver, uranium and stuff like that.
Hello and welcome to Business 360. I am Ashmit Kumar and here are the headlines that we're tracking this evening. The sell-off intensifies on the Lal Street. Sensex and Nifty lose over 1%. Mid-caps plunge once again with the index declining by 5% in the last two sessions. Rupee hits a record low against the dollar. Hyundai India lists at a discount after making history as the country's biggest IPO. Hyundai's global CEO plans to double R&D capacity in India, expects electric cars to account for 10% of sales in India by 2030. Adani's Ambuja Cement acquires Orient Cement for over 8,000 crore rupees. This is the third major cement acquisition by the Adani Group in the last 10 months, following Sanghi Cements and Penna Cement. Germany's Allianz is planning to end a 23-year-old insurance partnership with Bajaj Finserv. Allianz says it is actively considering an exit from general and life insurance joint ventures. CNBC-TV18 News Break confirmed the board of Zomato approves a $1 billion fundraise, likely to take domestic shareholding above 50%. Zomato reports a 5-fold increase in Q2 profits, even as it warns of heightened competition in quick commerce. Shares of Paytm's parent company slides over 5% after a disappointing second quarter. Revenues declined by 34%. Sale of ticketing business to Zomato helped turn a profit. Without the deal, losses would have widened by 70%. Government sources say profits of city gas distribution companies are likely to normalize after a reduction in allocation of cheap gas at administered prices. Petroleum Minister Hardeep Puri dismisses speculation surrounding city gas distribution companies hiking prices.
F&O cannot be and should not be a national pastime.
SEBI board member Ashwini Bhatia defends imposing stricter rules on futures and options, says F&O cannot be a national pastime and calls on investors to make serious investments. Israel declares a state of emergency in capital Tel Aviv after Hezbollah claims to have hit multiple targets. U.S. Secretary of State Anthony Blinken arrives in Israel to hold talks. More than 100 people killed in Gaza overnight and 13 killed near a hospital in Beirut as Israeli airstrikes continue. PM Modi arrives in Russia to attend the BRICS summit. All eyes on a potential meeting between China and Xi Jinping after both nations agreed to resume patrolling the contested border after 4 years. No official word from the Indian government on a possible meeting with the Chinese president. Indigo and Air India received a flurry of hoax bomb threats yesterday. More than 130 flights have received hoax threats in the last 8 days, plunging the aviation industry into a state of panic. Well, the stocks got battered on the Lal Street. The Nifty fell by over 1% to breach the 24,500 mark, ending at its lowest level since August of 14th. The mid-cap sell-off also intensified. That index saw cuts of over 5% in just the last two trading sessions. 13 lakh crore rupees of investor wealth has been wiped out in 2 sessions. Prashant Nair is joining us now with more details. Prashant, a troubled week here for the market. Tell us more.
A crunching fall for the markets, especially in the broader markets. Mid-caps and small-cap indices selling off between 2 and 3%. For the Nifty as well, it was actually pretty tough. Especially, it became especially tough in the last 50 minutes of trade. And we basically on the Nifty broke below the lows of last Friday. Remember, last Friday is when you had that big cut and that 300-point rebound from the day's low. That is gone. For the Nifty Bank, a little better at the margin because of private financials like ICICI Bank and HDFC Bank, which did not fall much. ICICI actually was slightly higher. Mid-cap and small-cap indices are up on your screen as well. Other than that, sectorally, pockets of weakness, PSU banks, real estate and government companies. The Nifty CPSE index was a big pain point as well. Now, large caps on the Nifty, BEL was a big cut. Mahindra & Mahindra lost. Adani Enterprises, Coal India, State Bank of India and Tata Steel are some of the biggest losses that we saw on the Nifty. In terms of, as I said, very few gainers, actually 1 or 2. ICICI was one, Infi perhaps flattish. and one or two others. Otherwise, it was broadly a clean down day. Broader markets, 10:1. 10 declines outnumbering 1 advance. I mean, that essentially is the market